US tariffs that are going away, the tariffs that are here to stay, and those that are potentially on the way after US President Trump threatened nations that would play games following the Supreme Court's ruling last Friday. CNBC's Steve Leisman has more.
With the Supreme Court striking down President Trump's emergency tariffs, but the president promising a whole new series of import taxes, economists are expecting somewhat less inflation and a reduced hit to growth this year. But the impact will still be there, and there will be greater uncertainty until the administration details the new sets of measures. Erica York from the Tax Foundation writing, "The Supreme Court ruling was welcome news, but the economic pain is far from over. The Trump tariffs amounted to an average tax increase per U.S. household of $1,000 in 2025. Now, with the IEEPA tariffs being ruled illegal, the president's remaining new tariffs will result in a household burden of $700 in 2026. Treasury Secretary Scott Bessent saying Friday that the administration planned to raise as much revenue through the new tariffs as with the old ones. But most think the effort won't fully succeed. Goldman Sachs, for example, believes the effective tariff rate will fall to 9% from 10%. It said 60 to 70% of the tariff price hikes have already been passed through to the consumer, raising core inflation prices by 0.7%. But Goldman doesn't believe there's much more left to pass through. Economists also don't think businesses will roll back prices. Barclays writing, "We doubt that businesses which recently raised their price due to tariffs will lower them back. They would likely wait for more clarity on the future tariff rates." It's the lack of clarity that may take the biggest toll. Businesses now brace for a renewed period of uncertainty over what tariffs will be in place and over what time, along with potential legal challenges. As for the Fed, they're likely to take the administration at their word, which is that they want to raise as much revenue from the new tariffs as they did from the old ones. So that means little change in the outlook for Fed policy. Steve Leisman, CNBC Business News.
Steve Leisman, thank you for that update there. Let's now listen into some market expert reactions on their outlook on the U.S. markets with the recent tariffs and AI fears weighing in.
I think it's an incremental reason to be anxious, as is Iran, for example. But again, I think it's noise, right? Especially when I go to tariffs. The ultimate thing you do is you go to the fundamentals. Right now, we have consumer confidence and ISM manufacturing at relative highs. Why is that? It's the implications of the big, beautiful bill. It's a second year of 12 to 14% earnings growth. In a sense, although this is negative for the deficit, this is actually more of a fundamental and technical tailwind to to getting to those earnings numbers. So I think ultimately this year is going to be driven by the AI story.
Take a short break. Cues from the commodities market on the other side. Stay tuned.
One of the factors that investors are holding on to is the dividend yield as well as the cash flow yield. What is it at currently?
5%.
5%. All right. Got that. Abhishek, request you to hold on to that thought. We got a couple of queries as well coming in there, and we want to discuss your top picks. For the time being, we take a short break. Come back. We continue our discussion with Abhishek. You'll get a lot of your answers to your queries. Stay tuned. Welcome back. You're tuned into Finding Alpha, and we have Abhishek of Nomura who's helping us out with everything tech. And as you all would want to know, there are a couple of queries as well that have come in there because you all want to know which stocks are best placed. So let's get straight to the first query that's come in. We have a query coming in from Rakesh Arora, who writes to us from New Delhi. He wants to know the top IT stocks to invest in. And he's broken it up into three buckets: large, mid, as well as small cap stocks. Abhishek, what's on your radar?
Sure. So I think in the large caps, we like Infosys and Cognizant the most. We think they will continue to gain market share. They'll grow at a rate which will be higher than the peer average.
Okay.
In the mid cap, Coforge is the preferred pick. We think the company's ability to deliver mid-teens growth exists. And some of the large recent acquisitions, will help.
Welcome back. On to updates from the commodities market. Manisha Gupta is here with the latest. Manisha, good morning. What are you tracking today?
But I'm looking at the gold prices, Hormuz, where we have seen 2% of gains in the overnight market. When the day started in the China state, it was $5,200 an ounce, but it has gone in for some profit taking at this point in time. It is volatile ahead of the U.S.-Iran talks. The military buildup in Middle East is keeping the prices supportive. And then from U.S., you have the implementation of 15% global surcharge under Section 122. And the U.S. seems to be considering further tariffs under Section 232 as well. So that is what will keep markets are slightly nervous in the day-to-day as well. We've also seen the silver prices going for some profit-taking, same is the case with copper as well. But what seems to be holding well is the energy markets. Crude is holding around 6-month highs, heating oil prices trading at a 13-week highs, and somehow the global trade seems to be doing well, especially for larger ships. You have Baltic Dry Index also trading at a 3-week highs. There is stronger demand for large ships carrying iron ore, coal, grain shipments, and that is where the support is coming in from.
Manisha, thank you for that update there. And since we're on the subject of gold, listening to some opinion on the prices and the factors driving it from Ruchi Sharma, the chairman of the Rockefeller International.
I've been quite bullish on gold for many years, but what I have to admit, given the parabolic price action of the last few months, is that it is totally disconnected from any fundamental story, which is that what drove gold historically, there were factors such as real interest rates, inflation surprises, and also of late, since 2023, central bank purchases looking to diversify outside of the US dollar. All those factors have slowed down or can't explain what's happened to the price of gold over the past few months. It's being driven entirely by financial flows with massive ETF buying that's going on. And people are coming up with all sorts of stories to say why gold should be going up. For some people, it's dollar debasement. Other people, it's the US deficit. Other people, it's the uncertainty unleashed by the Trump administration. And yet what's unique about gold is that all other assets don't reflect any of this kind of risk premium.
With that, we take your leave on this edition of Power Breakfast. From me and the team, thank you for watching. Bazaar Morning Call on the other side to set you up for today's trade.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Rima. Guys, good morning.
Hi, good morning. Would you call it a perfect storm today? We've got Trump-related confusion, AI-led disruption, there's the State of Union address, the monthly expiry today back home. It's all coming together, and the picture, at least on Wall Street, wasn't pretty.
Yeah.
Trump and tech, top of mind.
Yeah. Trump, I think, I don't know, that tweet was, but it was expected, right? I mean, I don't think there was anything which was, we were expecting, a cuddly Trump, and then suddenly he's become hostile or something. I mean, that's Trump.
And we've learned to deal with it over the last 1 year, right? It started.
I mean, what is he saying? He's basically saying, don't go back on the deals you've made.
Beware.
Right? Yeah, exactly. So otherwise, I'm going to impose. He loves tariffs, and we've known that for 30 years now. So that's not going to change overnight or over the weekend or whatever.
I thought Rima was going to say anything but cuddly.
Okay, all right. Well, that's essentially the tweet that I'm talking about. That's from, of course, the Truth Social feed of President Trump. Now, let's just quickly run you through what you need to know as we begin this new trading session. It's lower. S&P down 1%, NASDAQ down at about 1.33%, the Russell 2000 down about 1.5% across the board. Now, markets continue to punish, and I think this is the bigger one compared to Trump or anything else, which is this tariff business. I mean, of course, it's important, but I think the bigger overlay the markets are worried about is AI. And markets are continuing to punish companies that could be losers in the AI revolution, or at least what they perceive to be losers in the current AI revolution. Now, take, for example, IBM, 13% lower. It's the largest single-day fall since 2000. And we can go into details about why IBM was picked out last night specifically, but that was what it was. Now, you had the EU, which froze the ratification of the US trade deal until Trump has solidified his tariff plans, which is, you said 15% and then you want to impose more. So, EU is saying, decide what you want to do, and then we will kind of go back and look at the trade deal, not an agreement. No agreements have been signed. Agreement requires parliaments to approve on both sides. So we'll just look at the deal once again and then take it to our individual parliaments. Of course, in EU, you've got not one parliament, but many countries got to approve this. Now, President Trump, in that social media post, warned countries against backing away from recently negotiated trade deals. I don't think, at least till yesterday, we've not heard from any country, right? Except EU, which I just read out what they said, but no country in Asia, for example, or elsewhere, essentially saying that everybody's quiet. Everybody's waiting for this thing to play out in the US. You figure out your issues. Why step forward? And I think that's a wise thing to do, even from an India perspective. Why go out there and say, it's a court system in the US, it's legislative action next, whatever follows. So wait for it, and then, of course, come back and do what needs to be done. But in any case, I think this was just a warning shot. President Trump, of course, lashing out. And I think we will hear more lashing out later tonight, which will be tomorrow morning for us at that State of the Union address. Now, in terms of price action, 10-year yield was down 5 basis points, about 4%. Dollar index rose because it was risk off. So about 0.35% on the dollar index, 97.7. Gold futures saw a 3% move, back about 5,200. Silver, by the way, at about $86, $87 still. Bitcoin tumbled below $64,000. And as I said, the big address is going to be President Trump, and he's going to be addressing he's got that State of the Union address with the Supreme Court judges right there, as is custom, and expect him to lash out. Of course, he's angry, as you can see from that Truth Social, with regards to what the courts have done or struck down. Now, the other thing, and this comes back, of course, to the AI thing, right? The software ADRs and the software companies in the US all sold off again. Infi was down 5%, Wipro was down 3%. And of course, the others that we track regularly, EPAM 6.5%, Globant was down 9%, Accenture was down 6.5%, Cognizant was down 6%. So, it doesn't seem to be a floor at this point in time with regards to software companies. And, underlying fear is the same, but it gets stoked once in a while with a forward-looking piece, some commentary, and the market's, of course, hungry for any kind of wisdom on this in terms of how this will play out. So anytime you've got some definitive analysis, or at least what looks like definitive analysis, which is presented to it, I mean, I think it acts. And I think that is what we are seeing with companies in the software space. That's what we saw with companies in the SaaS space, you know, even the product companies like IBM, etc. Now, that told, let's just quickly wrap up the levels. Yesterday, of course, was a very good session for the Nifty. Broader markets also did not do all that badly. But we did not come up to, as I've been saying, we're in a small downward sloping channel. We did very well, but we did not touch the upper end of that channel, which is the same level I put out yesterday. 25,840 is that level. We need to get past 24,840 for this momentum, to whatever little momentum we have to sustain. Otherwise, you risk going back down again. And that going back down again, it's just slightly changed because it's a downward sloping channel. 25,245 is that level on the downside for the Nifty, which becomes critical. So roughly 25,300, 25,800. That's the range that we're talking about. GIFT Nifty will give you a quick sense of how we're likely to start, and then we'll pick it up from there. It's 100 points lower. I wonder whether this AI losers trade, or companies which are perceived to be losers from AI, will that same story, will the markets continue to sell off aggressively on that same story over and over and over again? Or it's a matter of readjustment, and that perhaps causes a fair bit of pain in the interim. So lots to discuss, lots to talk about, but it's a 100-point lower start as indicated by the GIFT Nifty. What's the F&O positioning and the stats looking like? Nigel has walked across to the wall. Nigel, over to you.
Well, that's right. Global markets in a bit of a tizzy. The tech, tripping continues out there. Trump's tariffs as well weigh. And Trump's commentary with regard to geopolitical tensions continues, with regard to Iran as well. So all those factors put it together, the global markets in a bit of a tizzy. An expiry factor here in India will add to the volatility for our Indian markets. The good news is that we had a positive FI flow number, and that's a decently large number as well. You could say it was, partly due to the MOC buying towards the end of trading session as well, and maybe a couple of large deals. But you got a large FI buy number, and you like that. The DIs, they are the ones that have been backing up this market. They lightened themselves a little bit, but net, you had a positive institutional number of close to around 2,000 crores in yesterday's trade. The Nifty rollovers, well, that's going to be important because today you have the expiry that plays out. Well, on the Nifty, the rollovers are a little lower than what we have seen in the past, getting into expiry at around 53%. In the past, we've seen something like around 57 to around 59%. Well, the Nifty Bank rollovers actually are a little bit higher at around 63%. Normally, you've seen around 57, 58% on that one as well. So a mixed bag coming in with regard to the rollovers. In the index futures, well, the FIs added more longs than shorts in yesterday's trading session. And now the short positioning in percentage terms at around 71%. That's the lowest we've seen in multiple months. Close to around 8 months, we haven't seen this sort of a number of the short positioning at around 71%. The FIs, they added more longs than shorts, even on stock futures, in the ratio of close to around 3:1. The PCR is at around 1.06 since we had action both on the call as well as on the put side. And a couple of strikes should come up for you. 25,750 call, 25,600 put. Both of them saw a fair bit of open interest addition. But this one's going to be important given that the markets are a little bit of a soft spot. So you had the 25,600 put. The premium has come down to around 50 bucks. The average would be close to around 75 to around 90 rupees or thereabouts. So in terms of a support level today, 25,500 is important because you have such big open interest built up at around 25,600 level. However, on the upside, well, yesterday's high becomes the first reference point closer to around 25,771 or thereabouts. The Nifty Bank, that was a little off color yesterday. You had a couple of banking names that did sell off. But till the 20-day MA is, protected, which the reference point is at around 60,300, you'll believe that, in fact, this one will have to fight back for the bulls if we have to see a recovery from the lows. The IT index, as you all mentioned, that could continue to see some pressure. I'll tell you what, the recent low was ballpark around 31,300 to around 31,400. Today, that level could get breached. But I think that from the lows, because of the dividend yields, because of the percentage terms as well, like we saw a couple of weeks ago, we could see some kind of support coming in there. That 31,300 was the recent level from where we did bounce off.
Thank you very much for that. And today is the Nifty monthly expiry. Yes, and this month, the Nifty IT index is down in this series. It's down about 16-17%. Wow. Yet the Nifty has been resilient and is slightly higher because banks are doing well. The banking index is up about 2.8%. Autos is up 5%. PSU Banks is a subset of banks is up 9%. You've got consumer durables up close to about 8-9% at an index level. So despite the IT fall, at a headline level, the markets have been resilient in this series. The Nifty IT index is down 16-17%. By the way, China has opened up after a long 9-day lunar holiday, and it's opened up in the green. It's got a gain of 1%. Kospi continues to hit record high levels on the back of the chip rally, 1.5%. The only index which is weak in Asia right now is Hang Seng, and that's got a cut of about 1.5%. Taiwan continues to power on. Jahangir Aziz is now joining in. He's the head of emerging markets economic research at JP Morgan, one of the sharpest minds when it comes to macros in India, emerging markets. Jahangir, thank you very much for joining in. Well, we've been dealing with tariffs now for close to a year, but the chaos and uncertainty just continues. Give us your updated assessment of the situation right now.
Look, we've been flagging this for a while now. So, conversations with you and your co-anchors running for almost like 3-4 months, this was always a very clear possibility that the IEEPA tariffs would be invalidated by the Supreme Court. Now, it took some time. The hearing was in November, and we have only got the judgment only last week. But this was something that the market had anticipated. In fact, the poly market had 75% probability that this was going to happen. And also the steps that would immediately follow, which is use Section 122 as the first reaction. That too was anticipated by the market. So I think in the market per se, even though there is heightened uncertainty, I think the level of concern is far less in the sense that it has proceeded broadly according to what people had assumed would happen. I think what happens now is, where does Section 122 roll into? What happens to 301, Section 301 and Section 232 as it is used to essentially take over from Section 122 when the 150 days are over? And I think that's where the concern is and the uncertainty is.
Yeah. Jahangir, that tweet, that post which President Trump put out, right, which is, beware and any countries which decide to change up or back away from deals. I mean, what did you make of it? I don't know why, but many people on social media were saying, well, this is directed at not this one. This is the wrong one. This is not the social media post. This is something else. This is with regards to U.S. politics. The one where he's talking about any country which wants to play
with the
games.
ridiculous Supreme Court decision. That one. Yeah.
That one. We'll put that up.
Look,
right. Many people were saying that's to do with India. I mean, I don't know why. Did you read it that way?
No, I did not. Look, I mean, India is important, but it's not that important that he has to tweet about India, about tariffs in general. So I think it was meant for European Union, which is the one which has the largest trade deficit with the U.S., is the largest trading partner. It is the European Union where the U.S. has blamed it for dragging its feet all of these months because it wasn't signing the trade deal or wasn't completing the trade deal. So the problem, Prashant, is the following, right? You have trade deals, but none of the trade deals are trade agreements because none of these trade deals have been ratified either by the trading partners, parliaments or legislatures, or by the US Congress. So if you do not have a trade agreement, you just have a trade deal, and the legal basis of that trade deal is invalidated, then I'm guessing so is the trade deal. So I think it has to be negotiated. We will have to see what are the tariffs under sections 301 and 232 that are used to replace it. The ability to engineer or to calibrate section 301 and section 232 to conform to specific country circumstances is far more difficult than IEEPA tariffs and far more cumbersome and time-consuming. So I don't think it's going to be an easy task to have country-specific negotiated deals, the manner in which IEEPA tariffs were used. I think it's going to be a long, drawn process, and we'll have to wait for a considerable period of time before we get any kind of clarity on what the final quote-unquote trade deals are and whether they ever get converted into trade agreements.
Yeah, just one point. So what you're saying, we'll live with 15%, maybe an extension of 15%. So 15% for the rest of the year, that is what you should assume?
No, I think 15% for 150 days. It is very unlikely that after 150 days, the U.S. Congress is going to extend the timing for 150 days.
15% till late July, and by then these 301s will kick in. That's what you're saying?
Or 232s, whichever ones they want to use for whichever countries.
But the final end state tariffs will be around where they are, before the Supreme Court ruling. That's the way to look at it, you're saying?
That's the way we are thinking about as a baseline. That ultimately you are going to end up somewhere in the same vicinity. You know, the specific items may be different. Gems and jewelry might be slightly different from what we have now from agricultural products, etc. But I think on average, that's what we should be looking towards.
Hi, Jahangir. Good to see you. And Jahangir, from an India perspective, we waited a long time to get some kind of a deal. And once we get the deal, there's so much of movement. What do you think? We're better placed now in comparison to what we got earlier this month? Or, because there's plenty of debate out there, a lot feel that we are actually not better placed in comparison to the rest of the globe. Well, there's a very, very strong thought as well that we are much better placed. Your take?
Look, I mean, we had average tariff about, 19%. If you take all the tariffs together, we are probably going to pay about the similar amounts. Remember, the tariffs that we were paying prior to this, under the different most favored nation status categories, those tariffs remain untouched. This is the tariff over and above that. So, we are probably going to pay slightly less than that. 15, 16, 17%. We haven't really worked out the average tariff rate with the exemptions. These tariff rates are slightly lower. And my guess is that in some categories, and this is where things become interesting, some categories, such as textiles, gems and jewelry, machinery, especially the smaller machineries, non-electronic smaller machineries, where India actually exports a lot to the US. My guess is that you are going to see in these 150 days a significant import front-loading taking place, and that will be good for Indian exports in these categories. Now, in the long term, Nigel, we'll have to wait and see where the dust settles.
No, absolutely. Jahangir, lots of questions, a lot more questions, but we can go on and on, right? But you can go in so many different directions on this one. Thank you very much for joining us. And it's an interesting time, too interesting, I dare say, and not a moment to rest. Thank you for being here with us, as always. Well, time for a quick break. We're going to come back in just a bit from now. Lots of stock-specific action that we'll get to individually. Yesterday was all about single stocks, right? Big four losers were all news-related. We're going to look at Bharti and Pace Digitech and Sigma Advanced Systems, Patel Engineering, Vari Energy, Lupin, JSW Infra, Chalet Hotels, Fractal, and MobiKwik that are on our radar on the back of positive news flow. And we'll, of course, also look at the stuff on the flip side, on the other side, in just a bit. Coming up with our research team.
Welcome back. You're tuned in to Bazaar Morning Call. As promised, let's go across to our research team who's standing by with the CNBC TV 18 list of stocks for the day. Well, Rima, let's start off with you. Bharti Airtel's in focus, not for pure telecom, but an eye on NBFC space.
Absolutely. So Airtel Money, which is a subsidiary of Bharti Airtel, is now planning to go big in the financial services sector. So the company has announced plans to scale up to build an NBFC platform, and it's going to put nearly 20,000 crore rupees over the next few years into this NBFC. Of that, Airtel will contribute 70% of that 20,000 crore kitty, and the balance will come in from the promoter group, Bharti Enterprises. Now, what has changed? Now, Airtel Money, up until now in India, was operating as an LSP, a lending service provider, which basically means it facilitated loans on behalf of banks and NBFC. It did not directly lend, but it had facilitated about 9,000 crore in terms of disbursements. But now, when it becomes an NBFC, it will be able to directly lend. They got their NBFC license from the RBI on the 13th of February. So now they can directly lend on its own books. And what are the synergies with Airtel? Because Airtel has about 368 million plus subscribers. They have their telecom data, they have their call patterns, recharge behavior, payment history, which helps them assess the credit history, which can potentially maybe, keep the delinquencies in check, make sure the asset quality remains in check, and plus they can directly start selling to that 368 million in terms of subscribers. So it's a positive for Bharti Airtel that is seen as the next growth engine for Bharti Airtel, and it is potentially one scaled up negative for other NBFCs, say a Jio Finance or a Bajaj Finance. But of course, today is only the first step. They've incorporated an NBFC and they have committed 20,000 crore in terms of capital to build this NBFC.
Got it. Okay, all right. Thanks a lot for that, Rima. So Bharti Airtel will be a stock in focus. But Ria's joining in with a few more stocks that she has an eye on. Morning, Ria.
Well, good morning, Nigel. All of these stocks today will be in focus on the back of order wins. The first one is Space Digitech. They have received an order worth 159 crores from Reliance Industries to supply lithium-ion battery packs, and this will be completed by the end of August of this year. Sigma Advanced Systems has won an order worth roughly 100 crores from the Ministry of Defence, and this is to build to-spec systems, control electronics, as well as actuation solutions across missile systems, naval systems, as well as airborne applications. Patel Engineering as well will be in focus. The JV has emerged as the L1 bidder for a 133 crore rupee project. The company share in this is rupees 68 crores, and the scope of work includes civil construction for key components in an irrigation project, and this will be executed over a period of 48 months. The last stock is Vari Energies. They have received an order for a 500 megawatt for supply of solar modules, and the order for this delivery for this is scheduled in FY27.
All right, thanks very much for that. Well, more stocks with news flow. Vinny is here with exactly that. Vinny, over to you.
Hi, morning. So first, let's start with Lupin. The company has received the EU approval for biosimilar ranibizumab, which is in vials as well as syringes form. Now, ranibizumab is mainly used for an eye condition. Lupin is obviously partnered with Sandoz for this one, and they are the 7th competitor who are actually entering this EU market. EU market size is around $800 million. Analysts are expecting 100 million as peak sales for Lupin, and in terms of EBITDA, it could contribute around $25 million. This could be for Lupin by FY29. So green expected here today. JSW Infra, that's the next one, as its arm has gotten a completion certificate for liquid cargo berths at JNPT. And with this, now the operational capacity for JSW Infra and the subsidiary will increase from 177 metric ton per annum to 181.4 metric ton per annum. So green here as well. Chalet Hotels, that's another one, green expected here. They've approved the development of 330 rooms for luxury hotel as well as a commercial and retail space which is there, which is going to be of around 36,255 square feet. This is in Hyderabad. Investment is of around 600 crores, and this would be company's 3rd hotel that would come in Hyderabad. Fractal Analytics, that's an other one that could see some green on the screen. They've launched a PI Evolve, an evolutionary agentic engine which is designed for autonomous machine learning and scientific discovery. So that is why this will be in focus. And lastly, one more quick important update there. Wholly owned subsidiary of the company has received approval from BSE to commence its stockbroking business, and this would come in on the BSE platform from 24th of February 2026. That's today. So important step for moving good there in the right direction.
Got it. Okay, all right, Vinny. Thanks a lot for that. Well, here's a quick recap of all the stocks we just covered, the ones with positive news flow first. Bharti Airtel, Pace Digitech, Sigma Advanced Systems, Patel Engineering, Vari Energies, Lupin, JSW Infra, Shali Hotels, Fractal and Athletics, as well as one, MobiWick Systems. All of them to react to positive news flow, though the market's expected to open with a bit of a gap down. That said, let's hop across to Manisha. Manisha, what's the action in the commodity space looking like? I noticed quite some big moves. Gold is glittering yet again, while Bitcoin slam dunk out there.
Oh, yes, it is. Overnight has been strong gains. We started the Asian markets at $5,200 an ounce, and plus that, a bit of a profit taking coming in for the precious metals right now, but the money clearly seems to be flowing in energy. Take a look at the crude oil prices. $72 a barrel is a 6-month highs for this one. The investors are monitoring the US-Iran talks and the kind of military buildup that's happening on ground ahead of those talks as well. And not just crude, you have the heating oil prices trading at a 13-week highs. The Baltic Dry Index has hit a 3-week highs. That tells you that there's a strong demand for larger ships which are carrying iron ore, coal, grain, etc. When it comes to base metal prices, well, it is copper that should be on your screens. 2% up in the Asian markets right now. The Asia clearly seems to be buying onto this one. There is shifting U.S. trade policies which seem to be unsettling markets. So whether it is about Section 122, Section 232 that the U.S. is working on right now, and the impact that it can have, especially on copper, which is on the critical mineral list, would be an important thing to see. So 2% of gains coming in for copper in Asia right now.
All right, got it. Thanks a lot for that, Manisha. Well, for the time being, I think we'll slip into a short break. On the other side, Mariresh Joshi of MarketSmith India is waiting for us. He'll help us out with some fundamental stock talk.
Welcome back. A quick check on Asia before we proceed. Japan was shut yesterday, and that's opened up with a gain of about 3/4 of a percentage point. China is the one to watch. Chinese markets have opened up after a 9-day Lunar New Year break, and they've opened up with strength. Taiwanese markets powering ahead. It's a 2.5% rally. Kospi continues to hit record highs on the back of the chip rally. Hang Seng is the only one which is down 1.8%. Some healthcare stocks in the Hong Kong market have been weak, but analysts point out that it's largely on account of some rotation taking place internally. But net-net, we've got some cuts coming through on Hang Seng. The GIFT Nifty implied open suggests a downtick of close to about 100 odd points. But markets, the Indian markets, have been showing strength for the last couple of trading sessions. So the question is, if we have a gap down, will that be bought into? Keep your eye out on yesterday's intraday low on the Nifty, and that, I think, is a level of about 25,609. The encouraging bit is that the FIs were buyers in the cash market, and they bought about 3,500 crore in the cash market. But where was the big delivery action? We had a lot of big movers, but what about the ones which saw heavy volumes? Harmis is now joining in with that list.
Morning, Rima. And the moves on the stocks were pretty significant in yesterday's trading session, but the delivery volumes, well, they flattered to deceive on most of these names. And DWE Development Engineers is one such name. The stock over the last two sessions has been buzzing, was up 10% on Friday, was up another 11% in yesterday's session as well. Now, Monday's volumes on the stock were the highest on record. Of course, it's a recent listing. It's not a very old listing as well. Now, over 5.5 crore shares were traded yesterday, now compared to a 20-day average, which is only 3 lakh shares. And because of this heavy quantum, only 3% of the total shares traded were marked for delivery. So as a result of which, only 19 lakh shares were marked for delivery here compared to a 20-day average, which is around 75,000 shares. And if you take a look at Monday's turnover, as a result of these very heavy volumes, which is around 1,400 crore rupees, almost 1,500 crores, which is almost 2.5 times its free float market cap, which is around 550 crore rupees. Newland Laboratories was one such name. Of course, all of these CDMO players did well in yesterday's trading session. It snapped a 3-day losing streak, the biggest single day gain since July of last year. Monday's volumes were the highest in 3 months as well. The 2.5 lakh shares were traded. That was almost 5x of the 20-day average. And here too, only 12% of the shares that were traded were marked for delivery. Then only 31,000 shares for delivery, the 20-day average being 13,000 shares. So here as well, around 2x of the average delivery volume. And HAL, of course, the news flow driven move, and despite the management clarification yesterday, the stock failed to see any recovery, still ending around 3.5-4% lower. The volumes on Monday were the 4th highest in the month of February, with close to 40 lakh shares that were traded yesterday, the 20-day average being around 21 lakh shares, so double its 20-day average. And here 35% of the total shares that were traded were marked for delivery. There are 13.5 lakh shares on the delivery front, the 20-day average being close to 8 lakh shares. And the stock is at a very important level here, that level of 4,000, which is it managing to hold on to by the skin of its teeth. And it's significant because it has not closed below that level since March of last year. So you need to keep an eye out on that 4,000 level for HAL.
Got it. Okay. All right. Thanks a lot for that, Hormuz. Well, we'll slip into a short break. As promised, Mayuresh is waiting for us on the other side. Welcome back. Hope you're having a good morning. Give you a quick update. Global markets in a bit of a tizzy. Tech sold off overnight. Trump's tariffs continue to worry, and you don't know what's going on the geopolitical front. Put that together, GIFT Nifty suggesting a 110 point downtick to kickstart trade. But Mayuresh Joshi is with us to help us out with how do you approach various stocks. Hi, Mayuresh. Good morning. Hope you had a good Monday. It's going to be a topsy-turvy Tuesday. But help us out with a couple of stocks then. You know, IDFC First Bank, there was a 590 crore fraud that was detected at Haryana. The stock yesterday got absolutely pummeled. You know, the management tried to reassure investors. They had nothing of that. You know, so that stock was under pressure. And UPL, well, they were expected to announce some kind of value unlocking. They announced something. The street clearly was not impressed. They said that the debt issue is not really addressed. And how does it benefit minority shareholders? Those were the questions that, you know, the street was asking. Post this fall, any of the two do you like?
Morning, Nigel. No, so I think for IDFC First Bank, I think for any bank for that matter, I think trust becomes a very important factor. And you've probably seen this in the recent past on what has probably happened. IndusInd Bank a few quarters back, Axis Bank in terms of their NPA reporting mechanism, and it took a knock after that. But I think such trust issues obviously create a trust deficit in terms of not just the stakeholders for the bank itself, but investors within the bank themselves. And therefore, I think for the trust factor to come back, what really comes out of the audit that will probably happen, what kind of a regulatory action can one expect, is something to be watched out for. As seen in the past, I think it is an obvious reaction that the stock will go through a consolidation phase till all these things probably get cleared out. And though valuation-wise, I think it now trades around 1.2, 1.3 times forward book, and would become attractive if it falls further as well. I think this is a major issue that the bank and the management has to probably tackle. So I think it might go through a consolidation phase. So I think it's a wait and watch for IDFC First. For UPL, you're absolutely right. I think the restructuring exercise that the management embarked upon and the debt levels probably remain constant, both on a standalone and a consolidated basis as well. Nothing really has changed from a leverage perspective, even after the restructuring is largely done with. Obviously, I think the expectation in terms of the parent probably now having the formulations business, they're having a very elongated target as far as revenues are concerned. But EBITDA margins still remain in those higher single digits, where the belief of the street is if that probably does not happen, then there might be a case or a chance of a de-rating happening on the core business itself. With the restructuring, what happens to the holding company and the holding company discounts? So I think all these questions to be answered. The stock has taken a knock. Obviously, I think from a price damage perspective, a large part of the price damage is done. But like IDFC First, this might also go through a phase of consolidation.
So no recommendation to buy on UPL right now. And when we go through consolidation, does it sell off more if someone owns UPL? What would the advice be?
Morning, Rima. So again, I think it's a perspective, right? I think if you've got a 2-3 year view, I think the model probably is still intact. It's just a question in terms of how the revenue and the cost synergies will play out, as the management has pointed out. If they point out and it happens in terms of reported numbers on a structural basis, and you see that structural improvement happening in the next few quarters, you might slowly and steadily have some element of re-rating happening in the counter. So I think if you have that genuine 2-3 4 year view, those investors can probably hang in. If you're here for a quick trade, I think maybe the stock might just frustrate you a tad bit.
Okay, Mayuresh, we'll leave the conversation here for now. We've got to address Bharti and its NBFC plans. They've got the RBI license for an NBFC. They can now start lending on its books, and the company has committed 20,000 crore rupees over the next few years. 30% will be funded by the promoters, 70% by the company itself. Gaurav Malhotra, Executive Director at Axis Capital, is now joining in. Gaurav, give us your initial thoughts. How much of value will this create for Bharti Airtel, and will it be a big negative for other NBFCs listed here? Or too early to worry about that?
Yeah. See, the way to think about it is very simple. There's 20,000 crores of equity to be put in that entity. 70% from Bharti, 30% from the enterprise level. And this 70, so that's 14,000 crores over a few years. Now, this 20,000 crores will be levered up, say, 4-5 times. So essentially, you're looking at a disbursement AUM of around 80,000 crores to 1 lakh crores, right? As and when you build up to that 20,000 crore level. From Airtel perspective, I think so we'll have to see how this sort of plays out. See, the way there are 2-3 things to sort of note in digital lending. One is that the two major issues with digital lending are first, obviously, cost of user acquisition and also, credit risk assessment. Now, from a user acquisition, Airtel obviously has hundreds of millions of users. And from knowing your user, also Airtel has that understanding, right? Even these users start using Airtel quite regularly. Now, this is on the theoretical side. Obviously, once you start lending, the key watch factor will be the delinquencies, right, of how that book is shaping up. And that will only come through over a period of time. We also will have to see what kind of credit products the company is going to be, focusing on. Is it like shorter term BNPL? Is it longer tenor? I think so it's a little too early on the whole to really make a value judgment on how big this business is going to be. Reasonable size, but one has to see reasonable in context to Airtel's size, right? That's the way I would sort of think about it.
And would shareholders be happy that 14,000 crore is committed by Bharti Airtel from the company to this business, which in a way is sort of unrelated?
See, the company has been talking about building up the Airtel Money business in a substantial way, right? So this is part of that. And the way to think about it is the company has alluded that this 14,000 crores will be injected over a few years. So assume, say, over 3-4 years, the company generating around 50-60,000 crores of free cash flow every year. So it's from that perspective, it's not that big in the overall scheme of things. And besides, like I said, company has been talking about building Airtel Money. So it's not as if this is something completely which was not expected.
So is Bharti a more compelling buy with this news in its kitty, the fact that NBFC also potentially unlocks value at some point of time? Like, for instance, Airtel Money in Africa, they're looking at an IPO. Maybe a couple of years down the line, once this scales up, this also turns out to be a value unlocking opportunity. So does the thesis for owning Bharti become stronger on the back of this news? And would you have, any numbers on how they can scale this up?
See, to be honest, I think so from a value unlocking perspective, this is going to be very back-ended, right? The bulk, it's just too large a business, right? Airtel today is just too large a business for a relatively new business to come and, become a reasonable part of the overall pie. So this is going to be pretty back-ended in terms of, how big it becomes. Yeah, so that's the way I would sort of.
Any concerns?
See, we'll have to see what is the delinquencies in this business, right? It's very easy to lend money. It's difficult when you have to take back money. So you'll have to keep a check on what are the delinquency rates for this business.
Have they announced who they're hiring to lead this?
No.
I think in a finance business, that is going to be critical, right? I mean, depending on who they get to run the business, at that last point, you can give money out easily. But
I think they're banking on the fact that they have telecom data for 368 million subscribers. They have the recharge data, etc. So in a sense, they are better placed to assess the credit risk based on the data that they already have from so many. And the cost of acquisition of subscribers is also going to be low.
I'm late on my Airtel bills regularly. So will I get a loan? I think.
You won't get.
Gaurav, sorry?
You won't get.
I won't. No. I was just saying that I am actually, but so am I credit worthy? I mean, can you make a credit worthiness assessment based on a phone bill? I don't know, but there's lots of other stuff as well, right?
So see, there are two things, right? See, if you have a credit score, then it's very easy to pull in a credit score. Yeah. The challenge with all this lending happens when you are a new to credit customer, right? And then a company has to use that alternate data to try and decipher how good or bad you are. Oh. In theory, all this data is useful. Now, the way to think about it is, can you scale how much you can scale it up and how much you can scale it up without putting a pressure on your NPAs? I think so those are the two sort of key to think about.
Yeah. A good chat, Gaurav, and I wanted to talk more on the other big story, which is, of course, payments and all that's happening globally. But maybe that's for another conversation, right? Thank you very much for joining us and appreciate your time here on CNBC TV 18. We'll take a break. We're back. And we'll focus on, of course, the big worry globally, which is AI. Sandeep Agarwal of Sovilo Investment Managers will also be with us. So quick one coming up.
Welcome back. Citrini Research, the 2028 global intelligence crisis has gone viral. Prashant has walked over to the big wall to tell us more. Prashant.
Well, thanks very much for that. Rarely does a piece, an article, blamed for moving markets, right? I mean, you go to the Wall Street Journal front page today, the landing page today, and it points out this particular article as the reason why stocks sold off last night. As one of the reasons, right? But even that is rare. Usually it is, something else. I mean, it's not a. And by the way, I read this. I didn't read the whole thing. It's a really long piece, but and I'll tell you the crux of what it is saying. The title is the 2008 Global Intelligence Crisis, and it's like a gloom and doom piece, almost a doomerist kind of view about what AI will do, right? And what it does is it takes you through what will happen in 2026, what will happen in 27, what will happen in 28, what will happen in 29. It's like a forward-looking piece in that sense. So, I was surprised when I saw this getting blamed and getting mentioned quite a bit. It's absolutely gone viral, but that was yesterday. But then it continues to get talked about. Now, Citrini Research is not a big, large fund or anything. They're a sell-side firm. They do largely top-down, macro-ish, thematic type of research. It's a small firm, but well-respected in that sense, right? Now, what is this particular piece saying? Not that it's anything new, but it's kind of sort of very well detailed out. It basically says, it explores what happens if AI productivity gains prove too successful, right? And the consequences, and I'm just summarizing, it's a very long piece, which I'm summarizing in maybe a minute and a half. It says AI drives unprecedented GDP growth, productivity growth, but no growth in consumer demand. The velocity of money circulation in the economy collapses. The reason they say is because machines don't consume anything. I mean, if you're basically going to get to automate everything, your productivity goes through the roof, GDP increases, but it's all on paper. On the other side, right? What can you and I offer as labor to earn a wage? So if on the other side there isn't any demand getting generated, so where will consumer and discretionary spending, etc., happen from? So that's a fundamental kind of point that they're making. They say it'll accelerate into job losses, etc. And they say that displaced workers shift into lower paid roles or reduce consumption, right? That's the other hit to consumption. One is straight away income goes away. The other is low paid work, where it's a hit to consumption. It says disruption spreads beyond employment into credit markets, and it basically hits intermediation, economies which are heavily reliant on intermediation and discretionary spending. So this is the crux of what this very long form article that I put out by Citrini Research really says. It identifies a few sectors, right? Intermediation related sectors which are going to be hit the most, and these are the ones: food delivery, payments, software and IT services, private credit. Specifically identifies, but it's not limited to this. I urge you go and check out this article. It talks about other stuff as well, but these are four that are picked up straight away, where it points out there is perhaps going to be a problem. It's gone, as I said, it's absolutely gone viral, but it's not just a one-way view. People are coming up with a research opposing it, saying, well, this is too gloom and doom, and it's not going to play out like this. What I decided to do is present two opposing views to this, right? And both are, by the way, well-known philosophers, economists. So the first one is from a man called Joseph Schumpeter. He's a political economist, basically Austrian-British origin, late 1800s, early 1900s, but very popular man. And he pushed the idea of creative destruction, right? He says creative destruction does not just destroy, it creates industries we can't conceive of yet. Now, these ideas were put out early 1900s, but it's the basis for a lot of arguments that we are making now. That and we hear this often, right? There are going to be jobs which don't exist right now. So that is one. That's from Schumpeter. The other is Friedrich Hayek. He's again Austrian economist who essentially focused on prices, and his viewpoint was that prices will respond. And in the context of the Citrini speech, the article, what does the Citrini article says? That companies will continue to spend hundreds of billions of dollars, irrespective of everything else. Mr. Hayek argued that it does not work like that. What happens if the stock market is down 50%, credit markets are down 50 cents to the dollar, and things are in a spiral? Will companies be able to raise money, do IPOs, etc., to fund all this capex which is required for these productivity gains? So his basic point, which he made again a long back, was that prices adjust and markets are not a static kind of a mechanism, and we should not discount that too much. So I thought I should put two fundamental opposing ideologies to, of course, what is being put out as this, what is being touted as this, and it's a well-written piece. There is no doubt about it. If you can go back to the first page, it's a well-written piece, but I think one has to take into account some of the opposing viewpoints as well, and I just put out two. So this getting blamed for a market correction, I thought it was surprising, and that's why I thought I should highlight this. Sandeep Agarwal is with us, fund manager, Sovelo Investments. Sandeep, good morning. Good to have you with us here. This is not so much about IT services and software. I'm sure you've read this piece. You're on top of all of it. So just wanted your thoughts quickly.
No, hi, good morning. So, I have gone through the development, what has happened, and I believe that, it is very, very short duration of time in which, people are taking a very long based call. And I think, stocks are right now reacting because there is a lot of fear. So, Prashant, while I have been very negative on the sector for last 14-15 months, and I expected this index level, the IT sector to correct by 35-40%, I think a large part of that correction has happened. But the development which has happened why IBM, Accenture, Cognizant, everyone was falling sharply yesterday on this Anthropic's COBOL thing. I think, these are little bit of too much stretched because, one thing is that, understanding and streamlining. Another thing is who will streamline. So I actually see this, honestly, despite my view on the sector, which is slightly negative still, but I believe this is a great opportunity because this COBOL and all those things, we have forgotten that this architecture can ever be touched and upgraded. Now, if AI tools come which allows them to be streamlined, I think it is a huge opportunity. I clearly remember speaking to one of the CTOs of one of the top global banks a long time back when I was covering IT sector. He was saying that we are still using a lot of architecture and things which are 1980, 82. They have not been upgraded because we don't know what will be the impact on the business if something goes wrong. So I see this as a positive development and not negative development. Also, Indian IT services are not so much we don't have exact similarity with Accenture. So I don't think, the kind of reaction should be similar. So while I believe that, valuation are still little high, given the PEG ratios are high, but I don't think that, this news has any impact on the business directly. I am not of this view. I think our business model was always superb. It continues to be very robust. Only valuation was a concern, which I think has corrected 70-80% what I was expecting already.
You're saying 70-80% of the pain is done in that sense, right?
Yeah, so I would say elephant is gone, only the tail is left.
Well, there's one way to put it. Sandeep, so this is, and you run a portfolio of names. It's not just IT services, although that was your sort of first love and what you focused on for a couple of decades. But what is, this is a larger piece. The argument is it starts in software and it spreads out. And it starts in software because that's where they decided to focus on first. And then it kind of moves out. Just a quick view. I mean, so for example, I put out industries mentioned, payments, private credit, food delivery. I mean, just any thoughts here? And any implications for viewers who are watching in India? Yeah.
So I think first there are two things to it. One, software and then its application. It is a time period of 5 to 7, 10 years which it takes. It cannot happen overnight, right? As I said earlier, also when we interacted, that software has to correct immediately because that is a one-time superb cut, means 60-70% slide, which should happen in 1 or 2 years. But services cannot be in the same way. Secondly, all these things which they are talking of disruption, they will need application layer on top of that. So it is a 7 to 10 year phenomena. In that period, a lot of work will also come. So I don't think, there'll be a big disruption and all. But yes, some of these businesses will change completely. Like payments, I don't know whether payments will continue to be in this form where it is today. So definitely there will be some disruption, but there will be an alternate which will come. There will be application layer which will simplify the things, reduce the cost, and a lot of things. Same, I think private credit, lot of development can happen on that side. Software and IT services, yes. Food delivery, I am not very sure what kind of changes can happen. Yes, if there is an economic impact and all those things, productivity and all that, then obviously there will be demand impact. But otherwise, I think disruption on the payments and private credit too much is very much possible. Software and IT services, software is the first one to go, and IT services will have to rescale itself, which is happening. So that is the way I would put payments at the top of the disruption, followed by private credit, and then followed by IT services, and software will be immediate. Like software is already happening.
So when you say software is immediate, what you mean is software products, right?
Yes.
Software products, okay. And IT services is the application layer, which is what Indian IT services companies do. We don't have very many products, software products in that sense. Yeah, got that.
Absolutely.
Yeah.
So we will have disruption, but much slower pace, and our growth will decline. But I don't see that we will see a negative growth for our industry. I am not of that view at all.
Yeah. Just a quick word on the. Have you thought about the macro-ish impact of all of this? I mean, baseline is you're saying you're not saying that the impact is so large. So maybe that question is moot in the first place. But I've well-meaning, serious people have written about this, saying, well, you start to think about what is the, what's the broader impact, right, with regards to consumption and demand and all of that stuff. I don't know. Any thoughts, Sandeep, quickly?
So broader impact, obviously, things will change from the way they are executed today. There will be a lot of productivity, efficiency gains. The experiences will improve substantially, and the cost will come down, but volume of work will go up substantially. Because see, remember, whenever the experience goes up and the efficiency goes up, the volume goes up, because you are able to do more work with the same amount of budget. So if you see last 10, 15, 20 years, hardly IT budgets have moved more than 2-3%. So I think that budgets will remain constant, and the use of that budget will go into the newer technology, which is happening already. So I believe that, we will see a lot of new applications coming, a lot of new sectors coming, and a lot of sectors which are currently today, either they will change to new ways of execution and experience, or there will be some disruption. But at the top, software, I think, is immediate disruption, and followed by, I think payments is something which will happen very quickly, and then followed by, private credit and IT services. IT services has advantage that, it doesn't go up suddenly, it doesn't go down suddenly. So 5 to 6 years, 7 years. Honestly, Prashant, if you think now, I believe whatever I have thought 14, 15 months back, 80% of that correction has happened. Last 10, 20%, I cannot time the bottom. But when this kind of things happen and the reactions which are happening, this is the last leg. I believe that, from here, things should slowly improve. We did not have a large base also earlier. Last 2 years, we have not done much. Yeah. So we will not have that kind of, negative impact, in my view, for the services side.
Well, certainly hope so, Sandeep, and not just for the sake of software services, but for everything else which is dependent on the consumption which feeds off it, right? So it's not just about that one sector, but so much depends on it. It's a big $250 billion industry, export industry in that sense. Thank you very much, Sandeep. And I think we need to do this, maybe do a segment every morning with you, Sandeep, because we wake up to newer and newer things, and hopefully more positive stuff, right? Well, that's Sandeep from Sovilo with a quick perspective on things. I think the rupee is open, the pre-open is kicked off. Rima, back to you.
Well, let's get in some technical trading ideas to help you navigate trade today. The implied open is down close to about 100 odd points on the gift side, but pre-open rates are a little more mellow, just down 50 points on the Nifty. Sudarshan Sakhani, Mitesh Thakkar now join in at 9 o'clock to help us with some trading ideas. Good morning, gentlemen. Thank you for joining in. Mitesh, begin with you. If we do get a slight gap down, what is the call?
Good morning, Rima. So on the index, I've been saying that the directional bias is moving out. The indicators are turning flat. Volatility indicators are turning down, which means that we might be in a choppy range. And I've maintained that we'll do possibly 25,400, 380, about 25,800, 810.
Sudarshan, we've been in this range now for the last so many days. There was momentum building up on the way up. If there is a gap down, would you recommend buying it? And do you see a decisive breakout of this consolidation range anytime soon? Sudarshan?
Oh, I'm sorry.
Yes.
But I can't answer that question in the sense that I don't know when that breakout or breakdown will come. But the range persists. And my view is that, yes, today's gap down comes on the back of a very narrow range till yesterday. So that tells us that the narrow range has actually We've all broken on the downside. That's not good news. And we have weekly expiry and monthly expiry today. And of course, the US markets decline. So this is a very heady cocktail. This is not a day to trade anything. I mean, this is not a day to trade the Nifty. We have no idea what it will do. The larger question, whether it will break on the upside or downside, is anybody's guess. We are in this range and we are chopping around. Let's see what happens.
Let's get to stocks then. Sudarshan, what do you have?
I'm RBNL, Rail Vikas Nigam Limited, which is a buy to stop under 305, 315. Nestle is a buy to stop under 1290. IndusInd Bank is a short to stop above 940. And Phoenix Limited is a short above 1760. It's a very mixed bag as the markets are also pretty confusing today.
2 buys, 2 sells. Mitesh, what do you have?
I have 2 buys and 2 sells as well. Mazda on top is a sell with a stop at 2304 for targets of 2230. AU Bank had a breakdown, so a sell there with a stop at 986.5 for targets of 950. And 2 buying names. The first is HDFC Life. It's been a buy yesterday and day before yesterday as well. Even now, if you get a mild gap down opening over here, it's around 738. Buy with a stop at 729 for targets of 756. And Biocon is a buy with a stop at 379 for targets of 405.
Thank you, gentlemen. We'll come back to you. For now, let's talk about HAL. That was in focus as sources suggest that the Indian Air Force has grounded the entire fleet of around 30 single-seat Tejas LCA jets after the crash earlier. HAL denies reports of the Tejas crash, saying it was a technical issue, not a crash. Jyoti Gupta, Senior Research Analyst at Nirmal Bang Institutional Equities, is now joining in. Jyoti, thank you for joining in. Have you spoken to the HAL management? What are they telling you? And if indeed there is a grounding of 30 aircraft, what impact will it have? What is the worst case?
Good morning and thank you for having me on the show. First of all, precaution groundings are a standard global aviation practice. So when an incident like this occurs, whether related to braking systems, maintenance protocols, or operational practice, Air Force worldwide pause operations to conduct fleet-wide technical checks. Now, this is not unique to India and therefore does not automatically imply a systematic design flaw in the platform. At the same time, HAL does say that it was not a crash or hull loss in the reported episode. I think the aircraft was damaged during landing and investigations are being, carried out jointly with Indian Air Force. Until a court of inquiry or technical review establishes root cause, whether mechanical, environmental, or procedural, it would be premature to attribute the issue to structural weaknesses in the aircraft itself. I think third is we must understand that the broader operational trajectory of Tejas, that is the platform has accumulated thousands of flight hours, achieved final operation clearance, and continues induction in the multiple squadrons. So, like all relatively young, fighter programs globally, it has, it has attained, final flight, approvals. So, I think the concerns are more valid in the industrial ecosystem, where I think that delivery timelines, supply chain, depth, and private sector participation remain structural challenges in India's aerospace manufacturing base, and these deserve scrutiny, not alarmism, but constructive oversight. So for me, this episode should not be framed as a crisis, but as a test of institutional robustness. The key questions are how quickly is root cause identified, how transparently are findings communicated, and how efficiently are corrective actions implemented. If handled professionally, as indications suggest, it could reinforce confidence rather than diminish it. At the same time, I think that there's a silver lining that I see. It's with the elevation of Mr. Kota Ravi. He's widely regarded as the LCA man for this role in operationalizing HAL Tejas. And as a strategically reassuring, I think it's a strategically reassuring move. And his appointment comes at this critical juncture for HAL, while it's scaling NK production and managing engine integration, advancing next generation platforms. I think the key variable now is not order inflow, but basically execution velocity. And I think over the next 12 to 18 months, I would actually look at delivery cadence, margin stability, and production throughput will determine whether, that this transition sustains continuity or meaningfully, strengthens has execution credibility.
Okay, all right. Hi, Jyoti. Good morning. Good to see you in. Nigel on this side. Jyoti, I've taken on board what you said with regard to the current issue and also the man for the moment coming in at the right time. That said, since execution is going to be important, what kind of revenue growth are you building in for HAL? And what's your view on the stock? It was a 5,500 rupee stock at its peak, recent peak. And now it's at around 4,000 rupees. How much of this perceived bad news is in the price, and post this 30% correction, will you be constructive?
See, first of all, I'll talk about the revenue build-up. So, I think 5 pages is what I've taken as a baseline figure for me since I actually, for this entire year, on the 1st of April, FY26. And it is 5 aircrafts, and the revenue should be built up in this quarter, fourth quarter. So I think despite that, considering the engines, ALFP engines and all, I think the company should log in something like a double-digit growth, something like a 12 to 30% revenue growth for FY26. And the margins, I don't think that they'll disappoint you. You should be somewhere at least around 30%, close to FY25 numbers. FY27, you should look at least a 20% growth with margins broadly stable at 30%. Now, I think every news for HAL is actually is a negative news for the company, and I think rightly said it deserves it because the stock has really not performed. In fact, the company's performance has been a bit of a sad. So, but I'm still constructive on HAL, and this was a discussion which I did have a month back with one of the officials, and we together, we were on the same page where we believe that somebody from the IF, because IF crew has always been instrumental in any of the Air Force fleet, so therefore somebody should actually be inducted should be elevated at a high position for this kind of platforms, and that is what is happening. So I'm quite positive that things will change in HAL, but I would actually look at HAL for the next 3 quarters, how they perform. I am quite positive that second half of FY27 will be extremely positive for HAL.
Jyoti, we leave it there. Thank you very much for coming on. Quick conversation, but useful and contextual. Thank you. Well, I think, 9:11, 4 minutes to go for the market open. We can get the calls out of the way. Sudarshan and Mitesh are back with us. Sudarshan, morning. What do you have?
IndusInd Bank, sell IndusInd Bank with a stop above 940.
IndusInd Bank is a sell.
Sells.
Okay, got that. Anything coming to your notice in the pre-open, Sudarshan, as you see it?
Well, it is, we are breaking down from the range. And as I said, this is not good news. We should just avoid the markets.
Okay. All right. Sudarshan, thank you for that. Of course, Sudarshan put out more trades earlier on. So do look at those as well. I think Lupin is what we want to focus on, or rather refocus on. Vinny is here with details. Vinny, morning.
Hi, good morning. So for Lupin, they've received a EU approval for biosimilar ranibizumab, and this is for vials as well as syringes. Now, ranibizumab, where is it used? It's used for some eye conditions. Lupin has commercially partnered with Sandoz for this, and with this launch, they'll be the 7th competitor in the EU market and this category specifically. Now, what is the EU market side? It is estimated at around $800 million. What analysts are expecting that for Lupin, $100 million will be the peak sales, and they believe that this could contribute around $25 million to Lupin's EBITDA by FY29. So positive sign here, given the approval that's coming on the EU front for ranibizumab.
Thank you very much for that. 2 minutes to go for opening rates to kick in. Let's just quickly recap the stocks you should have on your radar. Bharti Airtel on the back of its NBFC expansion plans and push. Pace Digitech, Sigma Advanced Systems, Patel Engineering, Vari Energies, Lupin, we just spoke about, JSW Infra, Chalet Hotels, Fractal Analytics, and One MobiKwik Systems. And I think in that One MobiKwik Systems is the one which is showing a big move. And not to forget the entire IT complex, because of the sell-off that we had on Wall Street overnight. ADRs were under pressure. IBM saw its single biggest fall in the last 25 years with a fall of about 13%. And there will be that ripple effect across the Nifty IT index. And there you have it, Is that the pre-open? Yeah, that's the pre-open. 1.5% lower on the Nifty IT. And I think I can see all the large cap names down 1.5%.
That would be the lowest level on the Nifty IT index since April 2025. So it's nearly a 10-month low, 11-month low is what we're seeing on the tech index. From there, it rallied more than 20%, and it's back to square one now. So let's see whether or not there is some kind of bottom fishing. And after a while, I'm hearing Sandeep saying that
I think he just sounded a little more.
80% of the bad news in the. I mean, he sounded relatively more optimistic, because otherwise, in the last 12 months or so, whenever we have spoken,
I remember like a couple of months, 1 month back, he said this is the most bearish I've been on the IT sector, and now he's saying that maybe most of the pain is behind.
And I think 80% of the pain is what he said in the press. Let's see.
Elephant is out, tail is left.
Yes. I don't know how long the tail is. So.
Okay, what do we have, right? 500 points lower, 1.6 down, and we got market open coming up in just a bit from now. So a few seconds, right? And 1/3% lower on the Sensex and the Nifty respectively, around that, right? 25,600 on the Nifty. So we were at 25,700 something. We were at 25,600. So it's about a 100-point cut. Nifty Bank is down about 0.17. You've got the mid-cap index down about 1/3%, and I think the small-cap index will come up on your screen, and it'll show up in a bit, about 1/4% down, 17,000 or so on the small-cap index, 40-odd points in the red. So 800 lower and about 500 higher. That's the advanced decline ratio as things stand right now. And of course, I mean, straight off the bat, we are putting up some of the large-cap IT names at the bottom of the screen, and it shows you what's happening. The Nifty heat map is coming up as well. So Infi, HCL, TechM, TCS, Wipro, top 5 losers are all IT. Eternal, Bharti, Bajaj Auto, Mahindra, Aisha. But basically, it's about 12 up and 38 down, roughly, right? I mean, L&T and ONGC are in the green, and the rest of the stuff is on the other side of the equation. So 117 lower, as the GIFT Nifty indicated. Rima.
Well, below 25,600 or around that level with a cut of 100 points in the Nifty, 0.4% lower. IT is singularly dragging the index lower, with the Nifty IT index is down 2%. But other than that, even the auto index has a cut of more than 0.5%. Talking about individual stocks, the top 3 Nifty losers are IT names. Infosys 3% down for the day. From the start of the year, it's a 20% fall. TCS also 2% lower, sliding 14% from the beginning of the year. And all this fall has started in the month of February, because 3rd or 5th of February is when Anthropic had released that Claude update, which sent ripple effects across the sector. TCS also 2% lower, Tech Mahindra 2% down, Wipro 1.5%. The entire IT basket, large cap, mid caps, are selling off rapidly. Look at an LTTS, a Persistent, a Hexaware, Emphasis, all down between 2 to 3%. So IT taking it on the chin. Other than that, Eternal is seeing selling pressure. That's lower by 1.5%. Bharti Airtel is reacting negatively to their NBFC plans. Bharti Airtel is down 1%. Maybe the street doesn't like the capital commitment of 14,000 crore, which will come in from the listed entity. The balance will come. 6,000 will come from the promoter entity, but Bharti Airtel is reacting negatively. And you've got Eternal, Trent, Bajaj Auto, Bajaj Finance, all down more than 1%. On the way up, you've got a few gainers, but they're not sizable or meaningful. The top gainer, ONGC, is up less than 0.5%. Tata Steel, Dr. Reddy, Coal India. A couple of banks are trying to fight, but the best you can say for them is that they're holding up and they're resilient, because Kotak, SBI, Axis Bank have a gain of about 0.1%, 0.2%. So not meaningful enough to offset the selling pressure coming through in IT names.
Absolutely, Rima. And the number of stocks declining are twice the number of stocks that are advancing. 2:1 is what that decline advance ratio is what we're looking at. You don't want that to worsen, because that's what makes portfolios actually get absolutely clobbered. One, MobiWik, that's the stock of the morning. BSE approval to commence stockbroking business. So that one is up and about, though it's come off a little bit in the last minute or so. Stocks that are seeing follow-through buying, D Development as well as Morpin. Both of them were up in yesterday's trading session. But both those two are seeing some kind of follow-through activity in today's trade as well. A few more notable movers on rather large volumes. Physics Wala actually is down 3.5%, so sharp downtick is what we're seeing out there. Eternal as well has seen a bit of a pullback, and Grow is down closer to 2%. Though the stocks are only moving around 2 to 3%, the reason I'm highlighting is because of the high volumes that you're seeing on these counters. Blue Jet, one of those rank underperformers, it was down closer to around 35% getting into this week year to date. And that one, in fact, yesterday was up, today as well as doing some kind of pullback. Even after the pullback we've seen yesterday as well as today, well, that one, in fact, is still down 22% for this year itself. So, some bit of pullback. Pace Digitech, they won an order. So that's why, in fact, that is holding in the green. The Nifty at the day's low, 130 points, courtesy the IT index that's now down more than 1% in today's trading session. At 11-month low is what we're seeing. I'll tell you what Hormuz is pointing out. Year to date, every IT stock has actually lost more than 10% of its market cap. Painful times.
Yeah, and this month, the Nifty IT index is down 19% now almost. And Feb so far is turning out to be the worst month for Nifty IT since September of 2008. We're going back to the global financial crisis to see this kind of a painful sell-off. The Nifty IT index in the month of February is down 19%. Sell first and then ask questions and see where business settles. But yeah, it's extending the sell-off now, Prashant, 2.5%.
Sell, shoot, whatever, right? And it is down about 2.6% down. So yeah, that's market behavior, classic market behavior. So uncertainty and markets like quantifiable things, and very little is quantifiable right now, especially because of what is happening on the AI side right now. So that's the picture. 140 odd points down is where we are at. It's clean 2:1, declines to advances. 1,500, 1,600 stocks are lower, and about 700 stocks are higher at this point in time. To take a look at this. I'll come to, there are some winners as well, and maybe we can highlight those as we go along. But let's get in Mihir Vora, Chief Investment Officer, Trust Mutual Fund. Mihir, good to have you with us here. Thank you very much for joining us. So, there is all this tariff business, etc. But I think the bigger thing is this deep anxiety about what an AI-first future will look like, right? And which industries it will disrupt, etc., etc. Is that coming up as a topic of conversation here as well? I mean, I highlighted that piece which was viral, and so what's your sense? I mean, just starting thoughts.
So absolutely, it is a disruptive factor, not only for IT services, but it's going to be disruptive for a lot of industries. I think a lot of efficiencies will come into the system in the long term. But in the short term, there are so many moving parts, as you just mentioned. We don't know what will be impacted. But all I can say is that one segment that can really benefit is companies which are spending a lot on IT and R&D. Productivity of the IT services, the cost of IT services implementation will fall dramatically. I think innovation and creativity and companies which focus on research and development will be greatly benefited because the scenario generation, the model testing, etc., becomes so much more efficient and cheaper with AI that innovative companies will really rake it in a big time. So companies which have significant amount of IT costs, I think that's a lot of companies should benefit on the cost side, and innovative companies should benefit on the R&D side. So there will be big winners coming out from this. In the short term, obviously, there is some uncertainty on the IT services side. They have to rethink their business models. But even there, I've been quite negative on the sector, not because of AI, but because of the fact that even before this AI, they were single-digit growth companies. But having said that, this disruption will make them, wake up and change their business plans, very likely. Similar situation, if I remember correctly, if you were there, probably not there in the market, in 99, 2000, IT companies got a lot of business because of Y2K, the same COBOL code that today you are talking about had to be regenerated and tweaked around to just for the date change from 99 to 00. And a lot of IT services companies came into the fore because there was such desperate need for reworking the entire COBOL database. After that, the situation was that people were always wondering what will IT companies do after that, because year 99 is done. All the big work on the basic, reworking of Y2K has been done. But companies reinvented themselves. They became implementers. They became offshoring agents. They became ERP, consultants, and we could see that the growth rate continued even beyond Y2K. So Indian companies have the talent. We have the wherewithal, and we have the flexibility to reinvent ourselves, which is, I think, what they will do in the medium term.
So underweight IT, what's the extent of underweight? I think at an index level, say IT is about 10% in the at the
Yeah,
index, the
significantly
weighted?
underweight. We got about 3% exposure.
3% exposure. And would you be looking to change your view on IT? Because sometimes prices correct, even, prices correct and valuations price in the scenario far out in the future. And already prices at current market prices suggesting a very low growth kind of scenario persisting for a long period of time. If IT companies indeed do reinvent, then growth perhaps would be better. And this, in hindsight, you would have come back and said, well, it was a good buy. It would have been a good buying opportunity. Are we there somewhere yet?
I think we'll probably get closer very fast, if not today, frankly speaking. But the way there is panic in the market, not only in India, but in the US especially, we should be getting there very soon. They are cash generating companies. These long-term contracts and the long-term requirements are not going to go away in 1 year. So this cash pool that these large IT companies have has to be put to good use. And of course, as I said, they will have no choice now but to reinvent themselves. And they're smart enough to do that. So I think we'll get there quite soon. So the underweights, if the stocks for another 10, 20%, which won't be good for the market, but then it really gets into that attractive zone.
Yeah, because, they will get some business, data sanitization, cloud migration as well. Some of these Indian tech companies, well, they stand to gain on that front. So as you said, 10, 15% lower, maybe they get a little bit interesting.
See, the point is you also need corporates to implement AI in their systems.
Yes.
So that like I said, after Y2K, there was a huge debate about what will happen after Y2K. But then we realized that companies then needed to upgrade to the internet-enabled thing. That internet was coming, networking, infrastructure management, remote infrastructure management, all those SAP implementation, ERP implementation, all those things came up in a big way after that. So we have the talent pool which can be retrained, and I think they will do that.
Interesting. Mir, yesterday we had an analyst from Nomura, Abhishek, who said that the SaaS companies, they're clearly under pressure, but their gross margins are 70 to 80%. So they can get squeezed far more. While as the Indian IT companies, as is, their margins are quite lean, in comparison to that. So the crunch could be relatively less out here, and they will also find their ways of implementation as new software has come out. So that's about tech. Let's keep that aside. Let's talk about the data center opportunity. But that's another big buzzword, right? Today, there'll be various gainers. We had a cables and wires player, KEI Industries, who joined last week. They were talking about, how big an opportunity is for them. And like that, there are various other industries as well. What's your take on that space? And do you have any couple of companies that have exposure?
We don't have too much exposure directly, but indirectly we have through some of the transformer and the T&D players, because data centers will require a lot of backup power generators. So we have the generator companies, some of the transformer companies, which will benefit because the data centers not only need reliable power, but they need two backups. And these are high capacity backups that will be required. So those kind of names we have on the indirect plane for the data centers. The way I'm looking at it is that, data centers, actually the owners of data centers need to put in a lot of capital. It's a capital intensive business, right? And my guess is that you are seeing a lot of action in India, of course, because of the tax benefits that the government has offered, but also because of the fact that it's very energy intensive. And a lot of our large groups are putting up a lot of renewable capacities. And probably with this data center demand coming through, that renewable capacity, the growth of that can actually accelerate going forward. In the West, it's very difficult to ramp up power generation capacity. So my guess is that they are coming here not only for the human talent pool, but also because of the fact that we have the capacity to ramp up power generation and distribution. So I think this trend will continue.
Mihir, any view on food delivery companies? That Citrini report says that other than payments, other than software, even food delivery companies stand to get disrupted in a big way. And their key argument is that food delivery companies spend a lot of money, billions of dollars, on customer acquisition to build the habit of opening their app first. So when you want to think of ordering in or dining out, you will automatically open a Zepto. And that habit is the moat, which Citrini talks about. And they're saying an AI agent has no habit. And therefore, this industry stands to get disrupted. Have you put any thought behind that Citrini report on the whole, and particularly food delivery and the way the business can change?
See, I think the Citrini report stretches things to the extreme. So you can argue, in the longer term. But having said that, it's kind of saying when you had the supermarket chains coming up with their in-house brands, we said that the existing brands will vanish or have a great problem. But the point is, there is a moat to the brand. There is some value to the brand even now. So habit may take longer to to kind of form, and more importantly, you also have the brand which gives you some assurance of quality. So wherever, whether it's an app or a physical product, where there is a brand, it stands for some trust and some basic quality requirements. So to that extent, you can stretch that logic, but it probably may take longer than we think.
No, that's true. They just laid out a hypothetical scenario, and it wasn't a prediction. And as you said, it got stretched quite hard. It got stretched to one extreme. You said the companies which spend a lot on R&D will benefit. Can you name a few?
So we have, for example, in pharma, we used to do mostly chemical engineering, but then we started doing, going back in the curve and going forward in the curve to generate molecules. So a lot of the companies that are coming out, not a lot, but a few companies that are out there are doing basic molecule research, basic treatment research. And there, I think there's a lot of money that is spent on IT and data processing, etc. Trials require a lot of data. Sometimes, because of AI, you may not even need to physically create molecules, because now you can model molecules and the impact of those molecules without actually manufacturing those molecules. So the scenario testing for some of the models, etc., can get accelerated by 50 times, 100 times. So those are the kind of chemicals, biotech, even your telecom companies, your the new age internet companies that you talked about. A lot of their input cost is IT. All those can be benefited.
Yeah, just take a quick look at what's happening in broader markets, right? So you got about 600 stocks higher, 650 stocks higher, and about 1,900 stocks which are lower at this point. But I'm just looking at this list of what is down, and maybe a few names, right? Maybe the tech, of course, all of it, right? IT, the ITB is down 3%, 3.5%. And of course, Infi and TCS and Persistent and Coforge and HCL and Tech Mahindra, Emphasis, everything is down. The textile names, Gokuldas is another one which is down 5%. And I think there is specific news flow there with regards to Gokuldas. We'll try and have Vinny join us, because this has got to do, there is the Trump tariff, etc. But there is some export-related benefits which perhaps have been cut. So we'll try and have Vinny join us on this. Maybe look at Pearl Global, etc. as well, the garment and apparel guys, and see if there is any impact there. Although, I think for Pearl, there is exports out of, like for Gokuldas, exports out of elsewhere as well. But we'll give it a quick look and come back if there's anything new to report. Car trade is down 4.5%. That's another one outside of this tech sell-off that we're seeing. Hexaware is down 3.5%. Okay, Vardhaman is down 6%. That is Vardhaman Textiles. So 504 on Vardhaman Textiles. There is Mahindra & Mahindra Finance, which is down about 3.5%. Should come up on your screen. And Zaggle is down about 3.5%. But it's not as if it's a huge right out of the gates, and this is still first 15 minutes of trade, as if the volumes on the downside are humongous or anything. It's it thins out pretty fast beyond the top few names. MobiKwik has got a big pop, 8% higher on MobiKwik, 218. AG's Vopak was a big mover yesterday. AG's Logistics is up 6% today and has got very large volumes. There is Bluejet, which high was 1,000, low was 300, now at 400. And yesterday was locked up at upper circuit. Some more buying here, 2 million shares, so 4% higher in Bluejet. ABB is up about 1.25%. HEG is up about 2%. Bandhan Bank is up about 2% or so, all with large volumes. Natco Pharma is up about 3.25% or so. Vishal Mega Mart is another one. JK Tyre, ICICI Pru AMC, Chennai Petro. So just kind of trying to give you a sense of what's happening on the upside as well. And there is, price gains are not large, but volumes definitely, I would still say, at least on my screen, it's a longer list of stronger volumes on what is up rather than what is down. And something similar to what we had yesterday. 200 lower on the Nifty right now, 25,500. Mihir, any specific area you're working on, focused on for opportunities from here?
So I'm actually quite positive on the market, frankly. Most of the negatives are done in the sense, except for some more uncertainty on the trade deal side. But now it looks like we'll be at least at par with other countries, if not better. So I think even the trade situation seems to be panning out. So it should be back to back to business, normal business. So we have been positive on the lending space, and incrementally we think that the way economy has shown some green shoots, the lenders, both banks and NBFCs, should now start coming back in the picture. The domestic investments cycle also seems to be picking up. So capital goods, power T&D, defense, all the physical asset infrastructure linked plays should do well. And selectively on the new age companies, there is still some excitement there. So there are growth companies out there. So we're picking from those things. So broadly speaking, consumer discretionary, some of the financials, and the physical asset creation names like cap goods, construction, power T&D, etc. Those are the themes that we would still continue to play.
Okay, all right, Mir, always good to hear your thoughts. Thanks a lot for joining in. Wishing you a good remainder of the day, and good to hear that you're continuing to maintain your bullish stance on the markets. Thanks a lot for joining in. Well, by the way, the markets actually have moved to the day's low, 200 points lower. Now we're approaching that 25,500 mark, which is the important first level of support. 200 points lower, you have the 200 DMA, which off late we have protected. So just keep an eye out on that. The tech index, that's getting pummeled right now. It's more than a year low. In the last 1 year, the previous low was around 30,900. It's gone below that. It's at around 30,600. So that's a bit of a problem pocket. The Nifty Bank is trying to hold one end up because that's down only around 50 points. That said, let's move to our next management. We have KC International. That's the next management on the show. Remember, the stock has actually come under pressure in 2026 so far. I think it's down more than 15% or thereabouts. But the management, during its quarter 3 conference call, executed 5 data center projects across India, and they're actively bidding for more projects. Mr. Vimal Kejriwal, the MD and CEO of KC International, joins us on the show. Hi, Mr. Kejriwal. Always good to have you on the show, sir. First, let's understand a couple of basic details. I'm looking through a Prabhudas Liradhar or PL Capital note. They are saying that in a data center, the EPC opportunity could be in the vicinity of close to around 20 to around 25 crores or thereabouts per megawatt. According to you, what is that opportunity? Could it be in that vicinity of around 20-25 crores? And out of that, how much are you eligible for?
So if you look at the numbers which you're talking about, we have done around 800 to 1,000 crores of revenue till now on data center civil. And it's around 100 megawatts. So around 7 to 8 crores is what comes to us purely on the civil side. Then there's an MEP project, MEP part, which we were not doing very actively. Now we've started doing it. So it could be anywhere between, 15, 17 or 18 probably crores, depending upon the configuration per megawatt. If we do both civil and MEP, with pure civil, maybe 7, 8 crores.
Got it. So the total opportunity could range from around 7, 8 crores to around 16 crores approximately. Would that be fair?
Yeah.
And you said that, you have done close to around 800 to around 1,000 crores of revenue from data center projects. Could you tell us, how do you see this number scaling up? And in the near future, how do you see this number look like? On an annual basis, how much can it contribute?
So this 800 and odd crores is over the last couple of years. Okay. The way we are looking at it is in the next couple of years, we should be reaching around 1,000 crores per annum of data center revenue. And that's purely on the civil side. We can discuss T&D separately. But on the civil, we expect it to be around 1,000 crores going forward annually.
Interesting. All right. And, y'all must be in talks with a lot of players, right? What is the pipeline looking like? What is the bid pipeline looking like? We've got that in terms of an opportunity per annum. It could go as high as around 1,000 crores of revenues. But as of now, what is the bid pipeline looking like just for data centers? Mr. Kejriwal?
So see a lot more inquiries.
We missed that, sir.
If you look at the opportunity, I said that at the moment, we are not seeing too many actually under bidding. We have got, I think, 4 or 5 large ones under bidding. But I think with all the announcement that has happened and a little bit more fast tracking and push and prod from the government, we'll see a lot more inquiries coming on the ground, on the civil side. Whereas on the T&D side, we are seeing a lot more inquiries because data centers which are now, let's say, off the drawing board, under execution sort of, there we have started seeing inquiries.
Got it. Sir, in terms of a capex, how capex heavy will this be for you? We've got the opportunity in terms of revenues, but how capex heavy it is for a company like you?
I don't think that will require more capex for us. Because for us, on the civil side, it's like a typical civil project where, honestly, on one project we put 5 to 10 crores of capex, which can be reused. So I don't think we will even say it's capex heavy for us. No.
Good to hear that. Let's focus on business then, sir. We just discussed that I think year to date the stock has been under pressure. And in the quarter 3 numbers, you had a couple of issues. There was labor shortage issues. There were project-specific delays as well. How much of that has eased out a little bit with regard to the labor shortage as well as those projects? I think water projects had come under some pressure. So have they eased out a little bit, those concerns?
Not yet, honestly, because water still continues to be under pressure. Although, if you look at the budget, government has allocated 67,000 crores for water projects. I do hope it gets translated. Last year also it was 63,000. I think the amount they have in the RE was 17,000. Actual spend is actually very much less than that. So I hope in March they actually spend that 17,000 and we get some payment and we can fast track our projects. Labor shortage continues and March is going to be a bad month because of Holi and then Ramzan. So I have not seen it easing out significantly, no.
Okay, and in terms of the outstanding with regard to your water projects, what was it at?
I don't know the exact number. It was around 800, 900 crores, and it sort of remains there because what happens is whatever cash we get around 70, 80 crores or thereabout every month, and we spend that back on completing the project. So the numbers have been, more or less constant at that.
Oh, difficult times then. So quarter 4 as well could see some kind of pressure on these two aspects, labor shortage, as well as in terms of this project execution. Got that. So if I got that number correct, the order inflows as of the last reported number was close to around 19 to 20,000 crores. I think you were guiding for around 30,000 crores of order inflows. What do you end up this year with?
So our exact number, I think, is roughly around 20,400 and or something like that. We have L1s of more than 4,000 crores. So I think 25 is any case done. We are in negotiation on a few large projects. Depending upon the outcome, we may be 28, 29. If nothing materializes, then we'll be at 25 in any case. But I think we'll be closer to the topper number, a higher number than the lower number based on the current negotiations. We do hope. Typically, March has got more closures happening. So we do expect that more closures should happen.
Yes. So this year you should be in that vicinity of 25,000 to around 28,000 crores, depending on how things flow, right? For FY 2026.
Yeah.
And for 27, you're guiding for around 35,000 crores of order inflows?
Yeah, we are still finalizing, but yes, it has to be 30 plus in any case.
All right. Final question before we let you go. What about the margin outlook? For this year, you had scaled back margins to 7.5%. Earlier, I think you were hoping for an 8% plus number. So you end this year in that vicinity. Could that be a further decline from there? And also going ahead, though, you're still optimistic. I think you're guiding for 9 to 10% margins.
So
I
you
think
hold on to that? 9 to 10 for the year after. We didn't
for the year after,
10.
28, I think so you're talking about. So you're saying that this will be the basing out year in margins, and from year on, you will gradually build on. Is that correct?
We hope it actually depends upon the same issue that what we talked about, because there are large revenues in water where we have got higher margins, and some of the newer projects are now taking off. When the newer project takes off, and I think the other issue which we had talked about, that we had a lot of money stuck in arbitration, especially on railway projects. So it depends, how those arbitrations go also. But I think we are reasonably okay with what margins we are talking about today.
And the net working capital days, sir, what should it look like? I think it was stretched. It went to around 135. You could correct me on that number. What's the range we should work with?
I think the number is somewhere around that range. We are talking around 120 or so for this year. This year is March. I think our borrowings have already come down by 500 or 600 crores odd. We are talking about a further reduction because some large receivables which we were expecting are coming. So hopefully the numbers will correct significantly.
Got it.
All right, Mr. Kejriwal, thank you very much. Always good hearing you, hearing from you, and about a variety of businesses, data centers, but everything else as well. Thank you very much, sir.
Thank you so much.
All right. Well, we're going to take a quick commercial break here. We'll come back in just a bit. Kawaljeet Saluja of Kotak Institutional Equities will be with us to talk about the trends in the IT services space. And that is the conversation you don't want to miss, coming up in just a bit.
Welcome back. Now, the ROTTEP incentive has been cut by 50%. How does this impact textile companies? Vinny is now joining in. Vinny, what's the news and analysis?
Hi, so absolutely, like you mentioned, there's going to be a 50% reduction in ROTTEP. That is, what is it? Remission of duties and taxes on exported products. That is reduced to 50% for all the textile products. Now, the main purpose of this was to boost the competitive intensity for Indian exporters in the global market, reduce their tax burden on the exported products. Now, analysts believe that, after ROTTEP, there would be also a reduction that would follow, maybe could come in for ROSCTL. That's the rebate for central and state tax levies as well. Do not forget that in the union budget, we had seen that there was a 50% reduction in the absolute budget amount for these incentives as well. Elara believes that, mainly for yarn and fabric players, this will be a big blow that comes in here, given that they are highly competitive and very price sensitive in the global markets. Exporters obviously now will be compelled to maybe reprice their new orders, maybe move it upwards as well. So that could maybe impact the profitability in the near term till this repricing is done for most of them. Yes, what one could see that orders which are already placed or shipments which have already gone, that price is already locked in, so no concern on that front. But new orders, that could see some repricing coming in. Vardhaman Textiles, Arvind Limited, all of them have seen pressure in today's trading session. Why? Because they have meaningful exposure to yarn as well as fabric exports and are vulnerable to these policy changes that come in here. Potentially earnings impact that could come in for them would be in the form of around 4 to 6% ranging between FY27 to FY28. Nitin Spinners also could see some bit of an impact given that they have cotton yarn and fabric export as well. So yes, reduction in this is a bit of an impact that one could see coming in for these companies.
Thank you very much for that. And by the way, the Nifty IT continues to grind lower. It's 3.5% gone at an index level. It's down 20% in the month of February, making it the worst single month fall for the Nifty IT index since September 2008. Kavaljit Saluja, head of research, Kotak Institutional Equities, is now joining in from their conference Chasing Growth. Kavaljit, the IT companies really need to chase growth to reset what is happening with the kind of sell-off, but you believe the sell-off in IT is overdone. I remember your 4th of February report, you said plenty of panic over a little flutter. Then later, 15th February, you said risks are understandable but overstated. Take it away. Why you think it's getting a bit overdone here and exaggerated?
Actually, can you just repeat the question? There was a problem with the mic.
Sorry. No, we just wanted to get your view in. You believe the sell-off has been overdone. Can you tell us why?
Yeah, of course, I believe that the sell-off is overdone. There is value in the sector. We do believe that Gen AI would be deflationary for the sector. We had published multiple reports highlighting the magnitude of deflation, which is 3% over a period of 3 years, post which new use cases will lead to normalization of demand. FY26 was the first year of deflation. FY22 will be the second year of deflation. And despite that deflation, you would have growth rates for the sector, which would in FY27 would be better, albeit marginally, than FY26. If you look at where the stocks are today, they are just building in a 3% revenue growth to perpetuity for some of the large caps, which in my view is inexpensive. Yeah.
So investors, when you speak to them at the conference, they're aligning with your view that there is value in the IT sector, because at a price level, when we look at the screen, you can't see any buying emerging.
It's a mixed bag. Concerns right now outweigh opportunities. There is definitely a concern on structural growth for the industry. Investors are apprehensive about the magnitude of deflation in the IT services sector because of AI. And I think investor belief may be that the deflation may be far higher than what is commonly believed here. So yes, amongst the investors, there is anxiety.
Right. Got that. Kavaljit, hi, morning, Prashant here. Now, I just had a question. How much of this, right, is... so the fundamental point that everyone is making is that the technology is evolving too fast. The models coming out now are a generation ahead of a model which came out 3 weeks ago, right? That's just crazy. But actual enterprises can't keep up with like this. I mean, no one can keep up like this because it's like this is AI improving AI, right? Is that your argument as well, that it's going to take a few years for it to work its way through, or are you in fundamental disagreement with what it will do, which is which is the fact that it's going to be deflationary, etc., etc.
No, I think, at the end of the day, AI is real. I think there are going to be, as I said, a deflationary impact across the sector. We expect a wide-ranging adoption of AI across enterprises in the next 3 years. Essentially, what is happening today is that the pace at which new models and tools and agents that are being launched are far ahead of the enterprise readiness, and which basically creates a bridge, and which is where services companies would act as a bridge in which what is available in the market is something which they would fundamentally execute, orient, and transform in an organization. But the net result is deflationary for sure, and that's part of the estimates here.
Yeah. Right. No. Is there a difficulty estimating here as well, Kawalji? That seems to be the problem, right? You say, okay, 2 years out, based on estimates, it is cheap. But the point is, we are talking about 3 weeks, models being generations ahead. So who knows, 2 years out, what's going to happen? Isn't that the issue?
Absolutely. No, absolutely. I think the rate at which new agents are being launched is accelerating. It's not the model, it's basically agentic AI that's a broader concern. I think the rate of change is accelerating. So to that extent, it's always difficult for anyone to estimate, what the exact pace and deflation would be, which is where basically, in a sector of rapid changes, what you end up doing is basically, increasing the cost of equity to bake in the broader concerns and the rate of change. Which is how basically you're getting a situation wherein, if you look at it globally, stocks are down. If you look at Cognizant, for example, it trades at 10.5 times calendar year 2026 estimates. You have Indian IT services stocks that have corrected by around 30 to 40% in the last few weeks as such. Yeah. So whenever there is such a level of uncertainty and apprehensions, inevitably multiples take a hit, which is nothing but cost of equity increasing to capture the uncertainty as such.
Okay. All right. Hi, Kawaljeet. Good to see you, Ben. Put it lightly, it seems like it's sell, shoot, and puke the IT stocks. That seems to be taking place right now. That said, as I said, Cognizant at around 10 times odd. Our stocks have corrected, 25, 30, 35% as well from the recent peak. So as if I were to give it a PE multiple, Indian IT companies are trading at what multiple, and where do you see that basing out? Compare it with averages. Currently, what is it, and where do you see it basing out?
Right now the stocks are trading at 16 to 18 times fiscal 2027 estimates.
Yes.
Where do the stocks, kind of bottom out? What you can always highlight is where the value is. Trying to take a stab at where it should bottom out is always a difficult call, as such. Yeah. Because, I think there's always relative and absolute arguments that come in. But our view is that at today's price, among some of the large caps, there's definitely value.
This IBM news, IBM declining 13% overnight, the fact that Claude can now modernize COBOL. Many Indian IT companies work with IBM. So IBM is a client for Indian IT services companies. So if IBM gets disrupted, how should we understand the impact on Indian IT services companies?
Okay, so look, essentially what has happened overnight is that, COBOL code modernization is a tool which was released by Claude. Now, I think IBM has a product called Watson X, which was doing something similar. Now, what ends up happening is that typically, if you're looking at legacy modernization, then, within legacy modernization, your code discovery and documentation process is something which gets accelerated. So there's a deflationary impact. Now, at the same time, there is difference between automation of task and ownership of outcomes. Because if you look at large enterprises like, let's say, banks or airlines or government, they are running critical systems, and they'll not allow the entire system to be run by or completely automated by basic tools. What you require is services vendors as a bridge to take ownership of outcomes on architectural decisions, risk management, testing, a whole host of other functions as well. So what ends up happening is at one end of the spectrum, there is deflationary impact. And at the other end of the spectrum, you'll also have cases wherein people who are deferred, core modernization, because of various reasons, with the new tools in the market, those programs become what I would say feasible. So at one end of the spectrum, for a given particular task, let's say if you had an army of engineers, there's a deflationary impact. And then at the other end of the spectrum, you'll have a lot more such programs that is coming out. And where the market is worried about is the timing risk, right? Because you can see the deflationary risk, which is pretty imminent, but you don't know the timing gap of it as to when do the new programs come in and the time frame for that, and which is where we are dealing with this transitionary risk right now, again captured in multiples.
But do you think net, say over a 3 or 5 year period, modernization of COBOL via these AI agents like Claude could be positive for Indian IT companies because of the opportunity it throws up? Because up until now, it was considered very costly and risky to do for, say, banks. But now there is that opportunity. So today we're selling off because of revenue deflationary fears. But do you think 1 year, 2 years down the line, it's net going to be a positive?
Think about it conceptually. What you're saying, again, the challenge with what you're saying is at a task level. At a task level, let's say if you're modernizing the core, then obviously, if I'm an enterprise, I save a lot of money, right? So if you're looking at that particular enterprise, the amount spent on modernization goes down, as such, or the effort estimate on that particular project goes down. Now it's up to that enterprise on how do they use the money saved in the process. Do they redeploy it into newer programs, and do companies capture the same? Now, if you're looking at it from a vendor standpoint, let's say from a client X, there's a revenue deflation. But the way that vendor will compensate for volumes is by having more such clients which hitherto were not modernizing systems because it was risky or it was too expensive. They start getting into the funnel. So there are nuances around it. At a conceptual level, the way to think about it is that if you're an enterprise, the amount you spend on, let's say, COBOL modernization, etc., would go down. There'll be savings. And then it's a function of how does a client want to use those savings, right? Now, if that spend gets captured by frontier model companies or basically the infrastructure layer, then it's net negative for IT services companies. But if that money is being used to funnel into newer programs, of course, it's neutral to positive, yeah. And as a result, in this disruption, what is clear for everyone is that they are clear that at least IT services gets impacted easily. That's fairly clear. The upsides are not, which is very fairly clear, which is where basically you're seeing the current disconnect and panic in stock prices.
Kawaljeet, it's a conversation which we will continue to have over the next many weeks and months, and I hope you will join us for it. Because it's a fast evolving space, I think that much we can all agree on. Thank you very much for joining us here on CNBC TV 18. And thank you for your time. Have a good conference. Well, let's just focus to Centre's asset monetization pipeline. Public sector enterprises will start offloading stakes in subsidiaries as part of the new monetization plan. Sapna is here on the phone line with details. Sapna, over to you. Morning.
Morning, Prashant. So this is on expected lines. Some other examples have also happened in the last 12 odd months. But having said that, the government has now outlined a clear 16.72 lakh crore asset monetization pipeline, starting FY26, the current financial year, of course, but that's ending very soon. So I suppose from FY27 onwards, the action is likely to unfold. And, CPSE selling stake in their subsidiaries has been formed as an important part of this new asset monetization plan. So, stake sale in CPSE subsidiaries should take place between FY27 and FY30. The disinvestment proceeds are to be retained by the PSUs as monetized value. For example, if you look at sectors like oil and gas, power, coal, aviation, even probably tourism, you have some big examples there. So, for instance, government has said very clearly in its report that it proposes to sell stake, or rather proposes, that GAIL should actually dilute its holdings in CGD companies and put all of that together in the GAIL gas, and then that GAIL gas should be listed thereafter. So that's one. They are also anticipating GAIL gas FPO, probably in IPO in FY28. Around 31,100 crores is what they plan to raise. Apart from this, Coal India to dilute its holdings in subsidiaries, and there are big targets over here. This is around 48.3 thousand crores, which is basically 48,350 crores is what they're planning between FY27 and FY30 via stake dilution in subsidiaries. Apart from that, similar format for the power CPSEs. 31,000 crores via IPO or FPOs in these companies. Similarly, for Airports Authority of India, the plan is that they should divest their stake in one of the subsidiaries and also do some stake sale in 4 of the joint ventures. Here, the aim is to raise somewhere around 12,500 odd crores via, again, IPO, FPOs, and even private placement. That is also an option as far as the monetization of aviation sector holdings are concerned. Last but not the least, also the redevelopment plan of Hotel Ashok Prashant is back on the table. So they are saying that they should start somewhere around, or rather restart somewhere around FY27. This is going to be a PPP model with a lot of interest from the private sector most likely. And Hotel Samrat earlier, if you remember, was not part of the asset monetization pipeline because it was very close to the Prime Minister's earlier residence. So now that also has been brought under this new framework, and likely timeline for the monetization plan or rather redevelopment of Hotel Samrat is at FY30. Now this is a big, grand, ambitious, almost a 17 lakh crore pipeline that government has in mind. So we'll have to wait and watch and see how this unfolds. Just a quick reference, and the earlier asset monetization pipeline, government says that it has met almost 90% of the 6 lakh crore target. That's it for now.
Thank you very much for that. Back to tracking the markets. The low today was sub 25,500. The Nifty went down to levels of 25,482. From there, it's climbed back above 25,500, but the situation still very tentative. Chandan Taparia, Motilal Oswal Financial Services, is now joining in on the show. Chandan, hi, morning. What do you do? 200 points lower now on the Nifty.
Good morning, Rima. Thanks for having me. So the setup is slightly range bound where declines are being bought, but at the same time, follow buying is missing in the market. We have noticed in last almost 8 days that index took multiple support near 25,380, 25,400, but failed to move beyond 25,900 mark. So I believe this range bound bias could continue. The only concern is that calls and put both are decaying at wicks of 14 as market is finding unable to cross the broader trading range. So we have to be very selective in the sector and stocks rather than talking about index. But yes, major support for Nifty is now at 25,380. On upside, hurdles are visible at 25,850. If you talk about day point of view, we have seen significant put writing at 25,500. And if market holds below the same, then it might see the cut of further 50 to 80 points. So being the monthly expiry, 25,500 could play an important role for day point of view.
Stocks, Chandan?
Yeah, so on a stock point of view, positive view on the wire and cable names. So recommending to buy on Polycab, one of the strongest counter which has been making high top, high bottom on the daily and the weekly chart. In fact, we have seen a positive rollover in the counter and holding well on higher basis with support beyond 8,000 plus. So one can buy Polycab with immediate support of 79.50 for an upside target towards 8,400 level. Second trading idea, that is buy on Power Grid. We have positive on the Nifty energy basket, and Power Grid and NTPC are a couple of strongest names. I believe this can do well. So with support of 298, it can head towards 320 kind of level. And one sell idea, that is on HCL Tech. Nifty IT is continuously making lower top, lower bottom, and most of the IT counters are under pressure. We have seen significant short and call writing is visible, which can drag the further on the downside. So one can sell with hurdle of 1405 for the downside target towards 1320.
Thank you very much for that. Two more stocks. Bharti Airtel is grinding lower, 3.5% down. It had a gap down opening, but the sell-off has picked up. And the other one is UPL. Yesterday, down 16-17%. UPL opened up in the green, but now it's inching lower, 1% down on UPL. Get into a break. On the other side, Manisha Gupta will talk commodities. Stay tuned.
Fly Emirates, fly better.
Welcome back. Now our eye is on commodities. Manisha joins in as always at 10 o'clock to tell us what's happening here. Manisha.
Thank you so much for that. When I'm looking at energy as a sector, if you look at the overall crude oil prices, we are trading at multi-month highs onto this one. So Brent, for example, is trading at a 6-month highs. We're looking at nearly a percentage point of gain coming in for this one. And the WTI crude oil prices are trading at a 7-month highs as well. It's not just that. It's about the energy products, distillates. All of that also is trading at a multi-week and a multi-month highs. Heating oil, for example, is trading at a 13-week highs. The prices have gained up nearly 4% in matter of last 1 month itself. The investors across are monitoring right now the round of talks between US and Iran. That is anticipated to take place on Thursday, which is 26th of Feb. But ahead of that, it is both the countries which are stuck on one point or the other, whether it's about nuclear or uranium enrichment. Trump, in the meanwhile, has warned of very bad day for Iran if the nuclear deal fails to materialize. Also, there are fears of potential military conflict in the Middle East and could lead to supply disruption. That is keeping some geopolitical premium in case of prices. A lot of experts do tell us that it is nearly $8 to $10 of a premium that the crude oil prices are carrying right now. And then it also is about reports of Ukrainian drones hitting Russian pump station serving Dizba oil pipeline. Well, this pipeline actually supplies crude to Eastern Europe, so some disruption there is also working its way in case of prices. Interestingly, a report from FGE says that the oil price spike to $90 to $100 a barrel is within reach if something goes wrong, pardon me, in the Middle East there. And then take a look at the supertanker market. That incense also has been buzzing, trading at the highest level since 2019. The daily rate for hiring a supertanker is highest since 2020. From Middle East to China, those prices have surged nearly 3 times in the matter of last 1 month to $150,000 at this point in time. If you also look at the Baltic Dry Index, well, that is trading at a 3-week highs as well. So overall, the tanker demand and the tanker prices has been on the higher side. The bigger tankers actually, which carry iron ore, coal and grain shipments, have been actually surging more than what the small tankers have been doing. The U.S. crude oil production is near peak is another thing that has been supporting the markets. We have seen constant decline in U.S. crude inventories. That has been supportive. And then it is harsh weather in U.S., which also means more demand for energy. It also has to do with the U.S. implementing 15% global surcharge under Section 122. And the street is watching out on the statements that we are hearing on Section 232 as well. So everything, it's a perfect recipe really for the crude oil prices to trade where they are, where markets anticipating it's not a sell short at all as a trade. It is a buy calls coming across energy.
Thank you very much for that. We will slip into a break on that note. On the other side, Lata speaks to Neeraj Seth of 3R Investment and Arup Rakshit of HDFC Bank to understand the impact of tariff wars on currency and other markets.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back. The cancellation of Trump's tariffs and Trump's comeback with a 15% tariff has had a confusing impact on emerging markets. In February itself, Taiwan and Korea, the old favorites, are continuing to rise, while Indian indexes have largely been ranged to lower, pulled down by IT stocks rather sharply. On the other hand, most Asian and EM currencies have actually become stronger versus the dollar, with the rupee shifting from a range of 92 to 92 per dollar in late January to 90.40 to 90.80 per dollar in February. So where are Indian equities and the rupee headed here on as the world waits with either a 10% or a 15% tariff for the next 5 months? With warnings of worse coming from Trump, we have two experts to discuss that. Arup Rakshit, the Group Head Treasury at HDFC Bank, and Neeraj Seth, Founder and CIO at 3R Investment Management. Gentlemen, good morning and thank you very much indeed for your time. Arup, to start with you on the rupee, can we say that first the trade deal on February 2nd and thereafter the removal or blocking of all tariffs by the Supreme Court appears to be rupee positive, at least so far?
Good morning, Lata, and thanks for this opportunity. Yes, I think it is a rupee positive from that sense. And obviously, when the 2nd February announcement came, we saw the rupee appreciating. But earlier also, when I was on your channel, I had said rupee will be in that range of 90, 91, half 92 levels. And I stick to that. See, we have inched up back to almost a 91. So the uncertainty continues, but now the uncertainty is largely global. So earlier it was an India issue which was forcing rupee to weaken. I think with that out of the window at the moment, it's a global uncertainty on the trade deals henceforth. This will be a little rupee positive. So we have seen that 1 rupee appreciation, which you did mention, from a 91.5 levels to 190.5 levels, and likely to continue in these levels only.
Okay. Neeraj, what have you made of this complex of announcements and events? The IT stocks have lost 15 to 20%. I'm only looking at the Nifty IT stocks. 15% in Wipro and almost 22% in Infosys. That's the range of the fall. If you're a Nifty buyer, if you're an index buyer, how is India placed at this juncture?
So I think overall, this is a challenging time to be an index buyer. That's a very simple point. Given when you look under the hood, whether it's in India or rest of the markets, the level of dispersion you're seeing, the great rotation that you're seeing is actually phenomenal. Well, index is still not telling you the whole story. And when you step back, think about what the markets are grappling with in general. You have the geopolitics in terms of the US-Iran dialogue, which is unclear where it goes. The scare of AI, you have obviously the taking a toll on software and services and actually broadening out. And the credit issues that you saw in the last few days and a week again getting to the forefront in private credit. So I think you do see a lot of issues at this point the markets are grappling with. And hence, index is not a great reflection. I think it is the time where you want to go more granular and think about the sectors and single names that you want to pick.
So maybe my question was wrong. I shouldn't have asked you index. I only asked in the sense whether India has become a buy zone or at least definitely not a sell zone. We did have one odd day of a 7,000 crore sell-off, but otherwise we have had more plus days of FII rather than minus days. So I'm just asking you from an overall, before I get granular, whether India is somewhere near a buy zone or a not sell zone?
It's near a buy zone. I do think some of the recent developments are positive for India, including the currency stabilization, the tariff, if anything, going to 18 and now 15. I think it's a positive, and the turn in sentiment brings it to the buy zone.
Okay. What's the, what are you hearing, Arup? Are you getting a sense, I don't know whether you meet your investors at all, being a treasury guy, but is the FPI sentiment turning? And therefore, is the rupee becoming, there was this huge long commodity currencies short rupee trade that everybody was speaking about in Jan. Is it now reversing, and is the rupee itself becoming a reason why the FPIs could dip in? At least their assets don't become negative 2 days after they buy.
No, Lata, I think the sentiment is a little positive because there is an expectation that rupee will be likely to be stable within a range. So it will not just go off flying like we had seen in the last few months of last year also. So from that perspective, it is looking rightly positive. Going forward, how the FPI plays out, yes, the rupee will not be a determinant factor for their decision, and it will possibly be more towards as Neeraj also mentioned, some of the geopolitics as well as how the economy per se starts performing. So it will be more on the real economy, which will start showing company specifics.
Okay.
Which
No,
will
fair
start
point. Actually,
showing
that I have to pose that question to Neeraj. The Q3 numbers had some seeds of positivity. We saw some of the food FMCG companies, not all FMCGs, not the levers perhaps, but those, like Tata Consumer or Nestle, the food FMCGs actually showed double-digit volume growth. Yeah, Britannia as well did that. And then auto sales were excellent. Steel, of course, the metal companies have been having a regional fuel. Is there a buy story now because of earnings?
So I do think there is at least early signs of the positivity around the earnings growth. I do expect that to pick up as we progress further in this calendar year. And I think that's going to be an important backdrop for Indian equities. So certain sectors where I would be cautious will still remain IT services or certain pockets which are very expensive. So if you look at healthcare or consumer staples, but from an earning growth perspective, financials, manufacturing, industrials, I do think there's a positive turn and the markets will follow that.
Arup, a word on the way bond yields have behaved. They have not been all that impressed by the switch, which brings down the government borrowing effectively by about 75,000 crores. But the market continues the 10-year above the 6.7 mark. What is that doing to to bank credit growth? Are you seeing an improvement? I mean, the numbers were excellent, I think 15% when we got the last RBI number. Is there a fuel to credit growth because bond yields are now kind of an expensive zone?
So bond yields will continue to get impacted with the expectations of the issuances coming next year, and also more on the SDL than just the GSEC issuances. The switch, they never announced the switches during budget. So somewhere the switch would have been expected at some time in the future, any which way. So the 16.5 lakh crore, which was originally thought about, would be around those numbers only for the GSEC issuances. But the SDL issuances will play an overhang on the bond yields. Okay. Credit growth, I think that is anyway showing positiveness. And I think the policy has also indicated that liquidity will be provided as and when needed. So from that perspective, the credit growth, I don't see the bond yields playing an overhang on the credit growth. Credit growth should be in the normal zone itself.
Okay. Neeraj, one of the better performing sectors has been banking, and especially in that public sector banks, and better than public sector banks as well, better than everybody else, seems to be State Bank. Since you spoke granular, where do banks figure and any other areas?
So I think first of all, the financials remain in the positive zone because what you heard in terms of the credit growth, there's still an impulse as the capex picks up. The credit growth should continue. The banks have a pretty clean balance sheet. The capital levels are adequate. So I do think the financial sector continues on that path. And there you're just seeing the public sector banks playing more of a catch-up given where the valuations were in the last 12, 24 months. So I think that path I would expect to see continuing in the rest of the year.
Any other stocks other than financials that attract you?
The extension of financials, you have the non-banking financing corps, which should continue to do well. You have then automotive sector, the commercial vehicle sector. I think that still has impulse as the capex picks up. Consumer discretionary is another sector, I think, which is well positioned. And rest, I think, again, you have the great place, but the valuations, I think, are a little bit stretched at this point.
Fair point. Actually, capital goods and construction companies have done very well. Even the likes of Siemens have done very well. Arup, finally, I want a view from you on how you see the dollar index itself going and your rupee range, say, up for the end of this quarter.
Rupee range, I still think that 89.80, sorry, my mistake, 89.80 to about a 91.50 kind of a range should be holding up.
Okay.
The broader 1992, which I've been holding for some time.
Yeah.
Dollar index, I think, it has been quite a volatile with every statement coming out every day, something new comes out. I think dollar index you'll see coming off only. I see a bearish trend on the dollar index.
Okay. Same question to you, Neeraj. What are you expecting in terms of dollar index and the rupee as well?
A little less of bearishness in near term, but I think medium term, I do agree. I do see a bearish backdrop for the dollar by virtue of the overall the flows that one would expect and the exposure that the world has to the US dollar assets. From a near term, I think the positioning is a bit heavy on the short dollar, so I'll be cautious going against it. On the rupee, I think we will see more stability. So I'll stick with my 90 to 92 as a range, and we're probably sitting in the middle of that right now.
Okay, I'm completely out of time, Neeraj, but the big conversation after that Citrini report is whether the IT sell-off spills over into poor macros, into poor growth. Is that a scare for the year?
Not for this year, but I do think it's the changes happening with AI are real. It's transformational. It's going to play through the economy, both micro and macro over time. I don't think it's a huge scare for this year other than equity market corrections that you're seeing.
Okay, that's a consolation because it's a rather dire scenario that Citrini is presenting. But yes, it is a scenario and it is probably some years in the making. Thank you very much, Neeraj and Arup, for joining us and giving us a view of all the markets that we have to be worried about. That's it on this edition of It's the Economy and of Bazaar. After break, Chartbusters.
Global software stocks continue to sell off and Indian IT majors join in as the fears of disruption by AI grow. The Nifty IT index has slumped 20% in February so far, marking its worst month since September 2008.
Bharti Airtel slips after it announces 20,000 crore rupee investment into building Airtel Money as a high-scale NBFC. Brokerages Morgan Stanley and ITI remain bullish on the stock following the announcement.
One MobiKwik's wholly owned subsidiary receives an approval from the Bombay Stock Exchange to commence its stock broking business. The stocks rallied up around 5%.
BSE announces that the inclusion of Hutco, Piramal Pharma, Tata Technologies and Torrent Pharma will be discontinued from the F&O segment effective the 4th of May. Stocks trade under pressure.
Textile stocks under pressure as the Director General of Foreign Trade, DGFT as we know it, cuts incentives under the remission of duties and taxes on exported products, RODTEP, by 50%. Brokerage firm Elara says that this will force exporters to reprice contracts in a highly price-sensitive market.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And as you can see, the color is red today. Global markets in a bit of a tizzy because of the tech stocks tripping. You had Trump's tariffs as well at play. And there are looming fears with regard to geopolitical tensions. Put that together, the market's in a bit of a tizzy. And today, to add to the excitement, Mangalam, we do have the weekly expiry as well as the monthly expiry. So plenty of action due. But the man on top of your screen is the Nifty Bank. That'll have to play an absolute blinder to pull us out of here.
We will have to see the Nifty Bank play an absolute blinder. But Nigel, the color of the market is red, but color is definitely grey when it comes to Qs, etc. And there are a lot of uncertainties around the world, and that's exactly where the markets perhaps bottom out. Would this be one of them? Would this, in hindsight, be an opportunity where one would have thought that this would have been a great buying one or not? Let's pose that question actually to Dharmesh Shah of ICICI Securities, who joins in for a quick technical check. Dharmesh, all said and done, yes, the Nifty has been under pressure. IT stocks are under pressure. But at the frontline index level, we haven't seen important levels being breached. Do you see this as a sign of consolidation and perhaps a breakout at some point later?
Yeah, so good morning, Mangalam. Absolutely, I think so. The way the market is behaving in last 2 weeks, it looks like we are into more of a consolidation in this range of 25,200 to 26,000. But it looks like, I think so, if you look from the market sentiment perspective, I think so, the market breadth, it's been a good indicator to understand the sentiment of the market. The percentage of the stocks which are trading above the 50-day moving average of total CNX 500, I see the improvement from 20% to 45%. It's clearly showing, yes, absolutely, I think so, the IT index as a whole has seen a good sell-off of almost 10%, and that seems to be reflecting in the index level also. The reason why we are not crossing 26,000. But it looks like, I think so, we will be seeing some bit of a bottoming of formation in this range of 25,200 to 25,400. And absolutely, we believe, I think so, market should make a new high of 26,350 in the days to come. So we remain to be positive for the market. Buy the dip should be strategy where the stocks, again, where the structurally looks positive, backed by strong Q3 earnings. I think that should be the one focus at the current market price.
Got it, Dharmesh. Thanks a lot for giving us that insight. By the way, in times of trouble, you look at some of these high pedigree names. Some of them have not made much wealth. But in the last few minutes, I'm observing HUL. That stock has moved to the high point of the day. I'm looking at another name like Nestle. Both those two, in fact, have perked up. Once we get the intraday chart, we'll give you a better picture on both those two. Dharmesh, as you said, it continues to remain a stock-specific market. Individual stocks that we should be looking at?
Nigel, if you look at, I think so, the bank index, I think so, clearly outperforming, and inside the bank Nifty, I think so, PSU index seems to be scaling a new high. Where already, if you look, the large cap stocks have been clearly outperforming, like State Bank and Canara Bank. We believe, I think that catch-up activity should be pick up in the second-line banks like Tier 2, like Bank of Maharashtra, Union Bank, and even IOB type. So we remain to be constructive positive for Bank of Maharashtra at the current market price. Again, one of the clearly outperformer inside the PSU banks. And again, if you look from the technical perspective, I think so, the way the technical chart pattern seems to be suggesting finding the support at 20-month moving average in each corrective phase and forming higher top, higher bottom formation in this current corrective phase. Looks like Bank of Maharashtra can be looked for a target of around 79, keeping a stop loss of around 65. So Bank of Maharashtra remains to be our top pick inside the banking space. Apart from banking, I think so, metal is a space clearly outperforming even in this current corrective phase. Maybe some bit of a pressure from the global perspective. I think so we are seeing in some bit of a percentage, 2% in the stock prices, but clearly outperforming Tata Steel. I think so the one where we believe the technical setup seems to be forming a cup and handle type pattern and indicating a breakout about 212, looks for a target of around 228, keeping a stop loss of around 198. So Tata Steel and Bank of Maharashtra remains to be our topic at the current market price.
All right, take that point. Dharmesh, thank you so much for that. We'll take your leave on that note and also get some colleagues from Money Control Pro to give you ideas for profit. Khushbu Roy Gupta joins in with a stock that she's tracking. Khushbu.
In today's idea for profit, we are recommending ITC Limited. Cigarette stocks are sensitive to any change in the tax structure. Hence, the implementation of the comprehensive tobacco tax overhaul effective February 1, 2026 led to sharp correction across major cigarette stocks. Also, ITC with over 70% market share fell by more than 15% after the government raised the GST rate to 40% for tobacco products while replacing the compensation cess. After this sharp correction, the stock is trading below its 10-year average PE ratio. The lower relative valuation compared to most FMCG players mirrors the regulatory overhang in the industry. However, we feel that ITC is well positioned to pass on most of the increase in the tax rate to consumers, supported by dominant market position, strong cash flow and a robust financial profile. Hence, the current level appears to be a good start to accumulate the stock. That said, we don't expect a sharp rebound here in the near term, but rather a range-bound movement.
All right, thanks a lot for that, Khushbu. Just before we slip into a short break, pull up a couple of these mid-cap names which are doing well. Polycab, for one, has seen a sharp recovery from lows. Polycab has actually moved to the high point of trade with a gain of almost 1.5%. And the other one that should come up for you is Mahanagar Gas. That one too has seen a big surge, up around 3% in a market like this. So we'll monitor how the moves on these counters play out as we move forward. But take a short break. On the other side, Girish Tanti and JP Chalasani of the Suzlon Group join in as the company undergoes a management rejig. More on that after this break.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. While we were talking about recovery in a couple of these stocks, look at a few of those stocks which are seeing a bit of a decline. Jubilant Foodworks, that's the one which has fallen to the low point of today's trading session. Remember, post its numbers, the entire QSR space was abuzz, thinking that maybe momentum from December has continued into January. The question is whether that's continued into February or not as well, or was it a false start, as it has been for the QSR space in the recent past. Multiple times we see continued sell-off for Crompton as well. That is another stock which saw a big surge post its numbers, and now coming in for a bit of profit taking if you must. And Delivery is the other one which has moved lower to the lowest point of today's trading session as well. But moments ago, we did get this announcement coming in from Suzlon, where they've undertaken a management rejig with Ajay Kapoor, formerly of Ambuja Cements, has now been appointed as the new CEO effective today. Girish Tanti, who's the co-founder and vice chairman, along with JP Chalsani, the member of the Group Executive Council, are now joining in. Obviously, Mr. Chalsani has been elevated into this Group Executive Council. Mr. Tanti as well, the co-founder. This is an important part of a company's leadership transition, a company's growth transition, where new people come in and, the management sets direction. If you could, from an investor standpoint, tell us what the thought process behind this change was, and what could be the quantifiable benefits of someone like an Ajay and coming in, and the kind of structure that you have now designed?
Yeah, so I think thank you for having us today. So as you said, I think we have two very important positive developments at the group today. We just concluded our board meeting and have these announcements. So the first and foremost is that we formed the Group Executive Council. This is the body that will primarily focus on the mid to long-term planning and important strategic pivot projects that we look for moving ahead. Mr. JPC is elevated to join the GEC, where our chairman and myself will work together in driving the GEC going ahead. At the same time, today, if you look at the current sector situation, renewables is now growing to become mainstream energy source for our country. And the growth opportunities are tremendous. Also, the market has shifted from a single source, whether it's wind or solar, to a firm dispatchable renewable energy hybrid projects. And earlier this year, we announced Suzlon 2.0, our vision to become a full stack renewable energy solutions company. So the idea is that with Ajay, and Ajay comes again with a fantastic track record as a professional, coming from large corporate, having managed multiple industrial domains, as well as scale up of businesses, and also integration through M&A and other activities and transformation drive. So the approach that we've taken is that the business performance, the driving of the transformation and the business growth of our current businesses is something that Ajay will lead. And then we have GEC along with JPC sir and our chairman and myself, where we'll be focusing on the pivot projects going ahead.
Got it. Hi, good morning, Mr. Tanti, as well as Mr. Chalsani. Good to have you all on the show, gentlemen. I've been lucky to meet Ajay ji in his previous avatar when he was at Ambuja Cements, then back at Adani Cement as well. So I've seen him on ground and I've seen him driving teams ahead. That said, what are the challenges? You have clearly laid out what you want to see of him, but can you put it into numbers? Suzlon 2.0, so to call it. What kind of capacities are you looking at? What kind of a mix you're looking at? As you said, renewable energy is going to be very, very important. So what kind of a mix are you looking at in terms of renewable energy? And say in the next 3 years, where are you headed?
So if you look at, the overall growth, like the first review period for our country is about 2030, for 4 more years. Effectively, the country has to build about 500 gigawatts of non-fossil fuel energy, of which about 300 gigawatts is going to come from solar and 100 gigawatts is going to come from wind. So the idea is that today we are purely a wind player, and with our expanding into being a full FDRE player, we would be able to kind of play the entire market of 500 gigawatts going ahead. And we already have a significant leadership position that we enjoy in wind. What we have seen with our large order book, which we have a significant portion coming from C&I segment, customers are looking to have more hybrid projects where if they can have one-stop shop for someone to supply all their renewable energy demand, then it becomes a win-win for both sides. So I think we are naturally transitioning to this new area of operations, and we hope to kind of be a leading player in the FDRE solutions moving ahead also.
All right, Mr. Tanti, once before we go to Mr. Chalasani, I have just one last question, and this is purely out of curiosity. Ajay joins from Ambuja's, which was after Adani's. Is management exchange the only thing that you have from the Adani's right now, or could there be any more in terms of dealing with them?
I think we've had a wonderful relationship with the Adani Group. I think as part of working together with the Adani Group on developing the renewable energy portfolio, we've done quite some good work together on that. So I think like any other large corporate, today Suzlon, almost all the top 10 large corporates across the country, we are working closely with most of them to see how we can help in the RE transition portfolio build-up for all the organizations.
All right, Mr. Tanti and Mr. Chalasani, let me make it a little simpler. Since you'll have such a good relationship, can Adani Group have a equity holding in Suzlon? Could that be a possibility? After all, as you mentioned, great relationship, right?
There's nothing of that consideration.
As of now?
I think Mr. Chalasani as well wants to come, and he's batted this query a few times, but I think he wants to come in. Please go ahead, sir. I think you're on mute, sir. If you could unmute yourself, we'll be able to hear you.
Yeah, sorry about that. I'm saying that this is for them to answer your question, not for us. So therefore, I think.
Have they shown any interest, sir?
No. I think we mustn't speculate. There's nothing like that. So it's purely speculative. So we shouldn't get into that zone.
Yeah, I mean, I just wanted to clear that it is not necessarily speculative. It was just out of curiosity because you have a leader from the Adanis coming in.
Clear answer is no.
And typically,
Nothing.
okay, clear answer is no. Thank you for clarifying that. And the other part that you said that, the GEC will also be looking at some sort of M&A going forward. If you could lay out an investment plan that you have over the next 3 to 4 years, and also what proportion of your growth will come from organic manner, how much of that will be perhaps inorganic, any sort of acquisitions that you're eyeing?
Let me first understand the reason why, like Girish Bhai explained about the GEC. See, if you look at last 3 years for us has been the resilience and rebuilding. The next few years is going to be disciplined expansion and the institutional scale building. Today, the market is throwing up various opportunities for us. And one is that in the current core business, there is a significant growth opportunities, which you're seeing and then which multiply. And the second, at the same time, is that we need to move away from add on to this core business in other areas which we've been talking about, so Suzlon Vote 2. As I said to you about a month back when we met for the results, obviously we have decided where all we want to go. But right now we're in the process of preparing our blueprint. And obviously we would come back to you and tell you what all we want to do. Definitely we want to become an RE player. That's number one, which we made very clear. And we also made our intentions clear that we want to go global from here. So I think the whole purpose of creating the GEC, where 3 of us are full-time members there, is to move away from the running the current business and concentrating on the growth. Because if you do only that, you can't actually diversify. Is that we can spend full attention in the growth areas for the future other business, as well as for the core business for the future. What we want to do in the core business, let's say in year 3, 4, 5, is what we can concentrate on. While Ajay, with his complete experience of track record, he can concentrate on delivering a disciplined execution and deliver what we want to do in this year and next year. I think that's a whole concept. But to your answer, what are the investment plans, organic, inorganic, everything is open there. We are right now building the blueprint. Next few months we'll come back to you. And also you will hear from us the next few months, the further strengthening of our management bandwidth. This is basically, we're expanding our management bandwidth so that we're getting prepared for what we want to do in Suzlon Vote 2.
Okay, the street is a little bit concerned about beyond FY28. BESS as well as, solar could be a bit of a challenge. What do you have to say about that? Till 2028, I think numbers are being plugged in. But the challenge, not just for you, sir, but for the industry is beyond 2028. What do you have to say about that?
Yeah, Nigel, that's exactly the reason why we have been guiding and saying that what we're going to have is slowdown over 2. We got to look beyond FY28. We are pretty confident that even the core business will continue to grow beyond FY28, but we need to capture other opportunities like what you said, the solar BESS. There are a few other things what we can do which are aligned to our strengths is what we will do, and that is what will come into picture by FY28, definitely, and that will continue to add. The whole purpose of creating this GEC is to answer that question of saying that what happens beyond FY28. So we've been talking about this for quite some time internally. We have we know clearly where we want to go. So preparing blueprint and operationalizing those new businesses. If you're actually got bogged down with the current business, core business, what we're doing, obviously we will not be able to incubate and operationalize the new business, what we're talking about, which will start giving us significant results from beyond FY28. So GEC is actually the answer to that. The reason for me moving out of day-to-day affairs, working with chairman and vice chairman closely, is to reach a stage where the growth doesn't have any comma.
All right.
This doesn't have a comma.
Just a final question, and this one to Mr. Tanti. Recently, Renew Power in its conference call also highlighted some challenges for the sector, lower plant load factors, etc. I just wanted to understand again, from a long-term standpoint, medium to long-term standpoint, the purpose of the GEC that there is beyond FY28, if you could give us an aspirational target, how much of your business should be coming in from wind, how much of it would come from beyond wind, how much of that would come from India, how much of that would come from outside of India? If you could just give us aspirational targets, and we won't cast your numbers in stone. Basis this, obviously, the ones that you formally lay out would be something that we'll be looking at, but just aspirationally.
Yeah, sure. I think, more concrete numbers we will come out, I think, in another 2 months' time to give more details once we finish our budgeting cycle and announce the formal program. But I think aspirationally, if I were to say one is, of course, to make sure that the wind momentum, currently, if you see the growth momentum of wind, we need to kind of step it up, that on an annual basis, it goes to 8 gigawatts, 10 gigawatts, 12 gigawatts and beyond. So it has to kind of continue that growth path year on year. And we also have a program of Wind 2.0 where we are reimagining the wind business to scale up the wind business. So one is just the scaling up of that business in a much larger way. So that's one element. Second, within the wind business is to take it to the global markets. So as you know, we've just kind of appointed some of our management for the international operations. So we'll be looking to expand globally on that. As far as our other FDRE businesses are concerned, we are in that early stage where we are getting the blueprints ready in terms of how do we play in the market, looking to also work with open mind to see if there are partnership ideas, opportunities, strategic tie-ups that can be done, other things. And effectively, our focus would be how we can add value beyond what's currently available to our customers in different elements. So it's a little early, but aspirationally, we would like to be a significant player for providing FDRE solutions in India.
Take that point. Thanks a lot, Mr. Tanti and Mr. Chalsani, for joining in and laying out the plan, at least as of now. And obviously, we will connect 2 months later as well, when you have firmer plans and some more numbers as well. And for now, wish you and your team members good luck, along with Ajay as well. Take a short break, come back, get you more on the markets and a lot of stock-specific action. Stay with us.
Well, the board of Tata Sons will meet later today to consider extending the chairman of N. Chandrasekaran the tenure for the third 5-year term. The board of directors, which include Noel Tata, Venu Srinivasan and Anita George, among others, will also review key business updates related to the Tata Group companies at the meeting. So stay tuned for that. But we've completely run out of time with this edition of Chartbusters. You stay with us. The team of Trading Hour is waiting for you on the other side of the short break.
You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu, with me Hormas Vatakia, and it's a down day for the markets. No other way to put it. 230 points lower on the Nifty. There are fears from all around the spectrum. You know, on the one hand, there is this AI-related sell-off which is underway. On the second, there is the Trump trade tariff-related uncertainty. On the third, we do have, you know, geopolitical uncertainty as well. All of that on the day where there is a weekly and monthly expiry for the frontline index. That means that the Nifty has to be lower, and that exactly is what's taking place. The only thing that we'll watch out for is whether there is recovery from current levels, from around 25,450 to 25,500, which has been a support in the past for the frontline index. And for that recovery, it's the Nifty Bank which will have to play a very strong part, because the Nifty Bank is relatively outperforming in today's trading session by not falling as much And we do have nearly 2,000 stocks in the broader markets otherwise declining for just about 800 stocks which are in the green. So it is a down day, a red day, all eyes on whether there is any sort of recovery that comes by or not. Let's go across to Hormaz now, who puts the spotlight on a lot of the movers in the market. Hormaz, I reckon more red, way more red than green.
Way more red indeed, and it was very difficult to take your eyes beyond IT because every time you open an index you would find an IT stock being among the top losers, and the screen is evident of that. Persistent down 5.5%, Coforge down 5.5%, L&T Tech down almost 5%. The picture is no different for the large cap IT as well. The entire IT index being down, out, battered, bruised, call it what you like. But take a look at the volumes here as well, with Persistent also 3x its 20-day average, Coforge almost 4x its 20-day average, L&T Tech 3x its 20-day average. So a fall on significantly high volumes as well is what you are seeing on these IT stocks. The IT index set for its worst monthly performance after September of 2008. That is the kind of fall that you have seen in these IT stocks in the month of February. On the flip side though, the one pocket that is standing tall all through has been the PSU banks, and today is no different, with Bank of Maharashtra leading those gains today. The third straight day of gains for the stock. The last 7 sessions the stock has gained in 6 of them, and almost 2 crore shares have been traded so far on Bank of Maharashtra, the 20-day average being around 55 lakh shares, so around 3.5 to 4x its 20-day average. And here too, almost more than half of the shares that have been traded so far have been marked for delivery, the delivery volumes being on the higher side as well. And so far the stock has gained around 10% this month, which is turning out to be the best month for the stock since April of last year. So on the flip side, Bank of Maharashtra doing well, but another one on the broader markets that's not doing well today is Yatra Online. It's a double-digit loser today. 12% lower now on the stock, the top loser on the small cap index. The 4th straight day of losses. The stock is down in 6 out of the last 7 trading sessions, and for the last 9 trading sessions we have had more than 10 lakh shares being traded on the stock every single day. And even in today's session, close to 30 lakh shares have been traded, almost 4x its 20-day average, which is close to 8.5 lakh shares. Close to 60% of the shares that have been traded so far have been marked for delivery, and as a result of this fall that you have seen over the last 7 days, the stock has now slipped again below its IPO price of 142 rupees and significantly below the recent high which it had made, which was well above 200 rupees, Mangalam.
I take that point. Thanks a lot for that, Hormaz. Those are a bunch of stocks which are moving around, and now as we speak, incrementally the market's seeing some bit of a sell-off. Let's go across to Reema, who will speak a little on Bharti Airtel and why the street is not particularly happy with their 20,000 crore foray into the NBFC space. Reema.
Thanks so much for that. Let's just begin with the news. So Bharti Airtel has said that they plan to, push forward with their NBFC plans. They got the RBI license for an NBFC on 13th of February, and now they are, pushing forth with, a lot of commitment. 20,000 crore is what the company is saying they will be committing. Of that, 70%, that's 14,000 crore, will come from Bharti Airtel, and the balance 30%, that's 6,000 crore rupees, will come in from the promoter entity. Now, earlier Airtel Money was acting as a LSP, a lending service provider, which means it facilitated loans. It did not directly lend on its balance sheet, but now with an NBFC, it can directly lend via its balance sheet. Now, I spoke to a few analysts because the stock is correcting today. It's largely on account of the fact that there will be some capital commitment, which maybe today is 14,000 crore rupees from a company point of view over the next few years, but that number could go up. And also the credit business in a way is a bit risky also because of the kind of delinquencies you could see. So it's the capital utilization which perhaps in a weak market has spooked, the shareholders of Bharti Airtel. Back to you.
Indeed. Well, 3% lower is Bharti Airtel, and among the top losers, if you take your eyes beyond the large cap IT names that are among the top losers on the Nifty today. So a 3% cut on Bharti Airtel, still trading close to that mark of 2,000 rupees. Now, the other pocket that has been a big talking point has been the textile names. Of course, the Trump tariff related uncertainties aside, there is another potential headwind that is lined up for them. Vinny is here to tell us what exactly is that potential headwind. Hi, Vinny.
Hi. So yes, what we're seeing is that the DGFT has actually notified a 50% reduction in road TEP, that is actually remission of duties, taxes on exported products. What does it simply do? It was giving benefits to exporters, so they have a competitive landscape with global players. Now, if this cuts down, that could lead some pressure for these textile players. Analysts believe that, with ROD TP, there could also be a reduction that will come in rates for the rebate of state and central taxes and levies as well. So that is something that we're still waiting on. But as of now, the 50% reduction in ROTEP is something that is a bit of a concern. Now, Elara analysts are highlighting that yarn and fabric players, actually for them, it's a big concern. Why? Because they are highly competitive in terms of pricing over there with global exporters. So players like Vardhaman Textile, Arvind Limited, they do have exposure in yarn and fabric exports and considerable exposure there. So that could be a bit of a concern in terms of policy change coming in here, and that is why both these stocks also are under pressure. Potential earnings impact that they have highlighted could be in the range of 4 to 6% for FY27, FY28 estimates in terms of earnings if the reduction is not passed to customers. If it's passed, then obviously the impact would be lower, but as of now 4 to 6% is what one could envisage. Nitin Spinners is another one with cotton yarn and fabric export that they also have. They could also face some bit of a risk in terms of earnings for them as well. So that is the main concern coming in here today in terms of reduction in these export benefits that they had previously.
Take that point, Vinny. Thanks a lot for that. So those are a couple of these textile names which are on our radar. Just watch out for a few other losers as well. Eternal, for one, is among the top Nifty losers. It's down about 4% right now as we speak, and this is one of the top 5 losers on the Nifty, which is not in the IT pack. The other one, which is also selling off, is Trent, which is down about 1.5%. Eternal obviously has been fairly volatile, ever since the announcement of DP Goyal's exit from the position of the chairperson of the company or as the CEO of the company, and thereafter we saw a bit of volatile moves on both these counters. Trend has been on a one-way down after its numbers, thereafter as well continues to see a bit of a sell-off below that 4,000 rupee mark on that counter. But some purchase on Axis Bank and HUL in form of maybe some sort of flight to safety. Take a short break, come back. We focus away from the equity markets and into the bond markets with Manisha Gupta on Bond Street.
Fly Emirates, fly better.
CNBC TV 18 and India Bonds presents Bond Street.
Back with us here on Trading Hour, as promised, shifting focus to the bond markets with Manisha Gupta. Manisha.
Thank you so much for that. Well, on Bond Street, we're talking about the government bonds, where we have seen a bit of a decline in the day today, but this is on expected lines. We've already been talking about that since yesterday, and this is happening as traders are placing short positions or short bets on gilts there. Well, what the traders really seem to be doing is that they are making room for 16 states which are looking to raise almost rupees 445.5 billion therein. This is on, again, on expected lines. Remember, for the quarter, the states already had given an agenda on the kind of issuances that they were looking at. So 2 gilt auctions is what the street is looking at for the rest of FY26. That is for the next 1 month itself, which totals to nearly 610 billion therein. So this is exactly what the street is working with right now. Having said that, it also is because of the decline in Indian rupee on the opening trades today itself, and that is on the back of crude oil prices, which have risen to a 6-month highs for Brent and a 7-month highs for the WTI crude there. There also are fears of US potential strikes on Iran, and in the global markets, we've seen treasuries and yields react to that. That's exactly what's happening for the Indian markets as well. Taking you through also on the bond yields that the street is looking at right now for the top-rated companies, and of course, this is in comparison to the government numbers as well. So when you look at the 3-year tenure, the top-rated corporate bond yield stands at a strong 7.07% there. 5-year, 7.24 for the corporates there, and 6.35 for the government yield. It usually is the practice that you always see the corporate bond yields higher than what the government does give. But the number clearly, as you can see, is nearly a percentage point higher for the corporate markets there. For the 10-year yield as well, when you look at the top-rated corporate bond yield, stands at a 7.4% vis-a-vis 6.8% in sense of government yields there.
All right, Manisha, thanks a lot for that. So that's about the bond street. The Nifty is now moved beyond that 25,500 mark. So there is some recovery from the low, and that recovery has been led by the Nifty Bank, which has moved into the green as well. We take a short break. On the other side, we have the real estate market up for discussion with Murtaza Arsiwala, who joins us from the Kotak Institutional Equities Conference sidelines.
CNBC TV 18 and India Bonds presents Bond Street.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back. You're watching us here on Trading Hour. Let's welcome Murtaza Arsiwala, who's a real estate analyst from Kotak Institutional Equities, joining us from the sidelines of the Kotak Institutional Equities Chasing Growth Conference 2026. Murtaza, always a pleasure speaking with you. What's your call on the real estate space? Just got to ask you this, largely because on the one hand, stocks haven't done much all of last year after having seen a big surge in the previous year. There have been price increases. There has been demand, in a lot of pockets which are improving, but then there are a lot of players in a lot of pockets which are facing demand slowdown as well. So amidst this uncertainty and multitude of cues coming in, what is your call, and what are some of the stocks that you like? What are some of the stocks that you don't like?
Sure, thank you so much. Hard. No one has a crystal ball to tell how the demand goes, but it's a pretty sort of one-sided street where the view is that the industry volumes are moderating, and therefore even if companies are reporting good numbers, it's only a matter of time before their sales falter. Now that view, essentially, if I look at some of the larger companies within the residential space, they are still able to meet their full year guidance. And mind you, if I look at the aggregate of my coverage universe, you're looking at double-digit growth in sales. Even going into FY26, we will start seeing the guidances for the next year when the fourth quarter results come in. But at a company level, performance still good. Industry may be a bit stagnating. Almost all players have talked about approvals being an impediment to new launches, and launches are important in terms of getting sales. Investors arguing whether the lack of approvals or launches is sort of a cover-up for not having adequate demand on the ground. I think in due course time will tell. What is true is that companies continue to deliver good numbers over the last almost 6 to 7 quarters versus industry volumes which have been more stagnant. Now you could, in that scenario, given where stocks are, you make for a very attractive proposition. DLF, Brigade amongst the larger pack clearly stand out. And the irony of this is that in such an environment, the street is not even differentiating between the subcomponent of earnings. The names that I pulled out, DLF, Brigade, have a reasonable amount of annuity earnings, which the street likes when you look at the trading multiples of the various REITs, which have done extremely well. But on this hand, where when you look at a DLF or a Brigade, they're really painting the entire earnings profile or cash flow profile with the same brush. We remain constructive. DLF and Brigade stand out as amongst our topics.
Murtaza, thank you for joining in. But the concern right now for real estate may not necessarily be industry dynamics per se. It also maybe has a lot to do with what has been transpiring across the globe, with a lot of this AI related concerns that have led to a very, very sharp sell-off across the entire IT basket. And would that somehow turn out to be a bit of a proxy concern, because the stocks in the real estate space as well are down anywhere between 5, 10, 15% already this year?
Absolutely. So again, discussions which keep coming up, you're not going to run too far before you run into a discussion on AI. There are concerns. A lot of the developers do have a large presence in Bangalore. But let me give you another flip side to it. When I look at commercial real estate, you're clocking 14 million square feet of quarterly leasing this quarter, which is fantastic. On a 9-month basis, you've done 40 million. If companies are taking up so much space, there are obviously more jobs being created. It may be on the IT side where the hiring trends are not as encouraging. But on the flip side, there are GCCs which continue to come in, take up new space. So when I look at the office market, from a real estate angle, I'm seeing record leasing levels, which means jobs are still being created. Hard to call what the future holds in store with, the technology disruptions, etc. But for now, the numbers continue to sustain. Yes, the street's concerned of real estate being, a second-order impact of what could happen in the technology sector.
Fair to assume then, Murtuza, based on what you also mentioned, jobs may be created, yes, but this residential upcycle, we'll get to commercial real estate in just a bit, but just to round off the loop on residential real estate, is the upcycle now entering its final legs, and before we hit a period of saturation and then again you move towards a bit of a down cycle before the revival starts again?
So let's look at it this way. The upcycle really started post-COVID. The first 3 years, you had strong double-digit volume growth. And it's almost been 2 years. I'd say, the best was probably 2 years ago. And you've had 2 years of near stagnant volumes at an industry level. So you're well in that consolidation phase or stagnation phase, 2 years already. We don't have a very long history of data. We really got it from 2007, so we don't have an extremely long history. But if we were to go by that, the previous ups and downs and stagnant cycles, you had an upcycle which lasted the previous time about 3 to 4 years, which is not very different from this time. And then you had maybe a 5-6 year period where sales were sort of stagnant. You've been more than 2 years into that phase already, as you look back. So yeah, hard call, but maybe the best is behind us as far as the sector goes. Companies could continue to do well.
So in that case, if one had to look at any attractive opportunities right now, should they even look at the real estate space?
Well, that's a question that often gets asked. But if you look at the valuations of companies, they're pretty much, given where stock performance has been, they're factoring in near no growth, where the sales have been fairly resilient. Healthy sales numbers, valuations extremely attractive. I mean, the stocks are pricing in near no growth in sales, which is what the base case assumption is. Should the company surprise you, that's when you make money.
So very quickly, Murtuza, if you could tell us, between residential and commercial, where would your preference lie? You would choose the REITs and the InvITs and so on as a better investment opportunity, or would you still go with the larger residential players like the Godrej's and the DLFs?
Well, look at it this way. That's the point that I was making. There is a DLF which has a larger annuity portfolio than any of the REITs, and it's trading very low on valuation multiples. So you've got this mix between residential and commercial when you look at some of the players which have sort of a mixed sort of business dynamics. As far as REITs go, I think the industry performance is great and the market's sort of pricing that in. And ironically, while the risk of AI, etc., seems to be substantially being priced in residential real estate, but no one seems to be talking about it or not seem to be priced in as far as commercial real estate goes. Our view on REITs, you could still make reasonable money, not the kind of returns that you made maybe in the last 2 years or so, but still can make a reasonable return. You're looking at dividend distribution yields which are more around the 6%, earnings growth which is still in double digit, so you could make reasonable return. Deep value really lies in the residential piece, because if you're sort of looking at that investment, you're really taking a contrarian view versus the street, where the street almost stands unanimous that the best of the cycle is behind us.
Murtuza, pleasure having you today. Thank you so much for sparing time and joining us. Look forward to having you more often on this very insightful conversation on the real estate space. By the way, 60 points now off the lows of the day is where the index is. So back above 25,500. Still trying to hold on to that level, and no better a day than the monthly expiry to tell you what are the trends from the F&O space indicating, and Mangalam has hopped over to the F&O desk for just that.
Well, Hormaz, the IT index continues to pressurize the Nifty. Though the Nifty's decline is currently stemmed because of the outperformance of the Nifty Bank that we're seeing. The Nifty Bank, while it is not up and about, it is definitely not following. And that's, supporting the frontline index, which is why the Nifty's cut is just about 200 points as against the Nifty IT, which is down 3.5 points. So that heavyweight is being counterbalanced by the other heavyweight. So we'll monitor this situation as it moves on, largely because it is, the monthly expiry. The market breadth, however, tells you a different story. The market breadth tells you that all the portfolio, mostly all of the portfolios are feeling fairly strained with over 2,000 stocks in the red. So as soon as we see some improvement there is something that the bulls would perhaps track as an important measure to see where it goes from here on as well. And finally, we look at the advanced decline ratio along with the India VIX, which is contained too. On a day like this, the VIX could have always been about 5 or 6% higher, but right now the fact that it is lower tells you that there is some sort of support which the street is eyeing at lower levels. The one technical level that we have to cross and close above is the 20-day moving average, which after breaking below today, can we see some sort of second half recovery and go above that 20-day moving average? Were that to happen, bulls would feel very good. Until that happens, the option writers are fulcrumed around the 25,500 mark. So the 25,500 call and the 25,500 put, both of them come up for you. Both of them together have a premium of roughly 100 rupees, telling you that the broad range that the street is working with for expiry today is 25,400 to 25,600. The Nifty Bank, that's the stronger of the indices, and that is a fair distance away from its 20-day moving average. So obviously, so long as the Nifty Bank holds on to that 60,000 mark, 60,300 mark, which is again a 600-700 point distance from where it is right now, it is doing fairly well. And were the Nifty Bank to pick up from here on as well, who's to say whether we go ahead and cross past that 20-day moving average and close above that or not?
120 points higher now on the Nifty Bank, and doing all the heavy lifting to ensure that the Nifty does not fall further. Mangalam, thank you for summarizing that for us. At the highest point of the day now is the Nifty Bank doing fairly okay for itself in what has otherwise been an IT sell-off led decline on the Nifty. Take a short break. Market fundamentals on the other side with Ashi Anand of IME Capital.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
A lot of these movers in the broader markets are, well, significantly in the red. Even if you take your eyes beyond IT, we spoke of Yatra Online earlier in the show. It's still down 12%. But take a look at Revenues Tech, that's Ixigo, that's down 7. Cartrade Tech is down 7. Novartis is down 6.5. Zaggle's down 5. So a lot of these high-flying broader market names from the recent past are seeing some significant cuts. Well, what's bucking the trend though is highlighted enough and more losers in today's session. But there are some PSU banks that are doing well. J&K Bank is up 4.5%. Central Bank of India is up 4%. Natco Pharma is up 4%. So doing fairly okay. What's also doing well though is Vishal Megamart. That is also trading with gains of close to 3% in what is otherwise a fairly weak broader market. Continuing our conversation on the markets with Ashi Anand of IME Capital, who is now joining in. Ashi, good morning. Thank you for joining in. Can't not start a conversation with possibly the hot trend over the entire month, which has been IT. Now with what is happening, with what has transpired and what is yet to transpire, where do you find some opportunities within this space, or do you even want to find any opportunities in this space even though valuations are back at historical lows?
Hi, sure. Firstly, good morning and good morning to all the viewers. It is extremely interesting. I think this whole question that is effectively being asked about the impact that artificial intelligence is going to have across businesses. I think this is a very large kind of a question. It is probably the most important question to kind of ask in terms of investment returns over the next 3 to 5 years. And what you are starting to see in the IT services sector is people starting to question what happens as AI becomes more and more intelligent and capable of displacing a larger number of jobs. Now, as that effectively, and I don't think there's yet a lot of clarity around here. What there is basically an uncertainty about how much of revenues of IT services companies are at risk. It is important to understand that this is all not negative. Arguably, artificial intelligence is reducing the biggest cost of IT services companies, which is the IT employees. So there is a big margin boost, but I think the concern of the street is the kind of disinflation impact this could have, as the same projects could get kind of done with much lower kind of revenues. I think when you're looking at IT services in particular, the core call is, do you have incremental demand that can kind of come in to kind of take into account this kind of disinflation pressure and kind of lead to revenues continuing to grow, despite the fact that productivity gains are very significant. So I think IT services continues to be a difficult call. Yes, valuations are quite interesting, but as AI kind of becomes the theme of the future, I kind of think that IT services going back to past valuations may not kind of happen in the near future. They are likely to remain volatile and under pressure as long as there's uncertainty about this core call. But just to kind of also highlight, I think this entire what you're seeing in IT services and also in a number of other sectors, where you are starting to price in the impact of AI in the future. It's extremely important for investors to start positioning their portfolios to actually benefit from the AI trade. And therefore, at IME Capital, and we've recently released a white paper, also done a webinar on this, where we kind of helping investors build international exposures. Unfortunately, in India, you don't have a lot of companies that are direct beneficiaries of this AI trade, but there is over $1 trillion of capex being spent over just the next couple of years by cloud hyperscalers on setting up AI data centers, throwing up some phenomenal kind of demand across semiconductors, advanced memory, electricity, cooling solutions, etc. We believe Indian investors need to start looking at kind of global allocations quite closely and actually starting to incorporate some of these positions as part of their overall portfolio. Because as AI becomes more and more mainstream, it is going to have implications on different segments of the economy. And you kind of want to be in the one core space where it is a very strong tailwind.
Right. What do you think would be the second order impact of the decline in IT stocks? It could be lack of jobs, maybe lack of the wealth effect, which could impact consumer discretionary products. The real estate, we had Murtaza Arsiwala join in earlier as well, saying that some of the concerns around real estate in Bangalore are now coming to the surface. So what according to you could be the second order impact, and would that have an impact on your overall investment thesis?
Sure. So, Mangalam, let me just kind of answer this in a particular, if you just go back a bit, right, to understand what AI is actually doing, it is going to lead to a substantial boost in productivity, right? And therefore, the same thing which would earlier require 100 employees could now possibly be done with 30 employees. So therefore, what happens to that balance 70? Now, before we get too concerned about negative second order implications, if you go back to any technological revolution you've seen in the past, the information age recently, or go back to the industrial age, what happens is a lot of incremental demand, a lot of new products and services that could not exist earlier start to kind of exist in this new kind of technological era. So before we kind of get very negative on overall IT services, IT employment, etc., our own view is that overall IT spends of enterprises may actually remain broadly the same. You're likely to see significantly larger projects, a lot of things that were not possible earlier. So say, for example, just kind of, you've seen IBM collapse in global trade yesterday, and the concern is that you can now do COBOL coding on Anthropic, and that basically IBM's core mainstay of ownership on these old mainframe computers that run on COBOL, that could technically be under threat. But this was never leading to IT demand earlier. You suddenly have the potential to modernize huge legacy systems that wasn't available earlier. So it's important to understand that there could be a lot of incremental demand coming in, which could actually compensate for this. And therefore, a lot of the kind of doomsday second order implications may not end up being as strong as being suggested. But I think given the risk that you could have second order implications, right? As in, if India is a services based economy, AI has a natural impact on services. As it kind of, if you do end up having a negative impact on employment, on income, it has very clear second order impacts in terms of consumption spends. It'll have second order impacts on auto, on consumer, on real estate, pretty much very large swaths of the overall economy. Now, keeping this in mind is really where this overall call towards Indian investors starting to look at certain level of global diversification, global allocations, especially towards the AI trade, is becoming kind of quite clear. We believe most investors need to have that. But that said, we also don't think that the second order impacts are going to be that significant. It's important to understand that AI is still fairly nascent. A lot of enterprise use cases have not yet been touched. And we strongly believe that productivity benefits would actually be utilized in incremental demand, incremental things that organizations do. So that's a core call.
A short but insightful conversation. Ashi, thank you so much for sparing time and joining us today. Look forward to having you more often on the show. We'll take a short break. More on the markets on the other side. Stay tuned.
Welcome back. You're watching us here on Trading Hour. The Citrini Research's article, The 2028 Global Intelligence Crisis, has gone viral. What does that imply? And is that causing the decline that we're seeing in the IT stocks today? Prashant tells us more. Prashant.
Thanks very much for that. Rarely does a piece, an article, blamed for moving markets, right? I mean, you go to the Wall Street Journal front page today, the landing page today, and it points out this particular article as the reason why stocks sold off last night, as one of the reasons, right? But even that is rare. Usually it is, something else. I mean, it's not a. And by the way, I read this. I didn't read the whole thing. It's a really long piece, but and I'll tell you the crux of what it is saying. The title is the 2008 Global Intelligence Crisis, and it's like a gloom and doom piece, almost a doomerist kind of view about what AI will do, right? And what it does is it takes you through what will happen in 2026, what will happen in 27, what will happen in 28, what will happen in 29. It's like a forward-looking piece in that sense. So, I was surprised when I saw this getting blamed and getting mentioned quite a bit. It's absolutely gone viral, but that was yesterday. But then it continues to get talked about. Now, Citrini Research is not a big, large fund or anything. They're a sell-side firm. They do largely top-down, macro-ish, thematic type of research. It's a small firm, but well-respected in that sense, right? Now, what is this particular piece saying? Not that it's anything new, but it's kind of sort of very well detailed out. It basically says, it explores what happens if AI productivity gains prove too successful, right? And the consequences, and I'm just summarizing, it's a very long piece, which I'm summarizing in maybe a minute and a half. It says AI drives unprecedented GDP growth, productivity growth, but no growth in consumer demand. The velocity of money circulation in the economy collapses. The reason they say is because machines don't consume anything. I mean, if you're basically going to get to automate everything, your productivity goes through the roof, GDP increases, but it's all on paper. On the other side, right? What can you and I offer as labor to earn a wage? So if on the other side there isn't any demand getting generated, so where will consumer and discretionary spending, etc., happen from? So that's a fundamental kind of point that they're making. They say it'll accelerate into job losses, etc. And they say that displaced workers shift into lower paid roles or reduce consumption, right? That's the other hit to consumption. One is straight away income goes away. The other is lower paid work, where it's a hit to consumption. It says disruption spreads beyond employment into credit markets. And it basically hits intermediation, economies which are heavily reliant on intermediation and discretionary spending. So this is the crux of what this very long-form article that I put out by Citrini Research really says. It identifies a few sectors, right? Intermediation related sectors which are going to be hit the most. And these are the ones: food delivery, payments, software and IT services, private credit. Specifically identifies, but it's not limited to this. I urge you go and check out this article. It talks about other stuff as well, but these are four that are picked up straight away, where it points out there is perhaps going to be a problem. It's gone, as I said, it's absolutely gone viral, but it's not just a one-way view. People are coming up with a research opposing it, saying, well, this is too gloom and doom, and it's not going to play out like this. What I decided to do is present two opposing views to this, right? And both are, by the way, well-known philosophers, economists. So the first one is from a man called Joseph Schumpeter. He's a political economist, basically Austrian-British origin, late 1800s, early 1900s, but a very popular man. And he pushed the idea of creative destruction, right? He says creative destruction does not just destroy, it creates industries we can't conceive of yet. Now, these ideas were put out early 1900s, but it's the basis for a lot of arguments that we are making now. That and we hear this often, right? There are going to be jobs which don't exist right now. So that is one. That's from Schumpeter. The other is Friedrich Hayek. He's again Austrian economist who essentially focused on prices. And his viewpoint was that prices will respond. And in the context of the Citrini speech, the article, what does the Citrini article says? That companies will continue to spend hundreds of billions of dollars, irrespective of everything else. Mr. Haik argued that it does not work like that. What happens if the stock market is down 50%, credit markets are down 50 cents to the dollar, and things are in a spiral? Will companies be able to raise money, do IPOs, etc., to fund all this capex which is required for these productivity gains? So his basic point, which he made, again, a long back, was that prices adjust and markets are not a static kind of, a mechanism, and we should not discount that too much. So I thought I should put two fundamental opposing ideologies to, of course, what is being put out as this, what is being touted as this, and it's a well-written piece. There is no doubt about it. If you can go back to the first page, it's a well-written piece, but I think one has to take into account some of the opposing viewpoints as well.
Multiple viewpoints there. Prashant, thank you for summarizing that for us. Take a short break. The Nifty is back below the 25,500 mark. We'll continue our conversation on the markets on the other side.
Welcome back. You're watching us here on Trading Hour. The Nifty Bank, which was mildly in the green, has been going back into the mild red as well, and that explains why the Nifty is below that 25,500 mark. So the distance between 25,500 and all things else would depend on what the Nifty Bank does from here on and whether there is any last hour recovery on the IT pack or not. But for now, we're out of time on this edition of Trading Hour. Stay tuned to CNBC TV 18. The team of Halftime Report comes up after this short break.
Stocks see a sharp drawdown after tariff jitters and AI disruption fears drag US stocks lower. IT and realty are the big drags, while PSU banks and metals eke out gains.
Global tech stocks like IBM and Indian IT shares take a beating after Anthropic unveils a tool to auto-upgrade legacy COBOL systems, while analysts rule out an existential threat for Indian IT. They clearly see deflation ahead.
Bharti Airtel is set to scale Airtel Money as a digital lender after RBI's note to operate an NBFC. It will invest 70% and the promoters 30% of the 20,000 crore capital allocated. The stock slips as investors turn wary of the non-core bet.
The National Monetization Pipeline 2.0 aims to raise 16.7 lakh crore over 5 years. The plan includes stake sale by GAIL and CGD's entities and listing of GAIL Gas Coal India, diluting holding in arms, Airport Authority of India divesting stake, and public offers by power PSEs. Hello, good afternoon. You've tuned into Halftime Report coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. With me is my colleague Ekta Batra as well. Markets as of now, a bit of a dull day coming in here, down almost 0.9% in the trading session. But we have a lot on the show as well, Ekta, and we'll get you an exclusive conversation that we are having with Rajiv Bajaj, MD of Bajaj Auto, on demand outlook, export opportunities, and more. We'll focus on buzzing stocks and big movers in trade today as well. So stay tuned in for that. And in our What's Trending segment, we'll be putting the spotlight on the sell-off in the IT sector after IBM sees the biggest single-day fall in the last 25 years. But time now to get you the exclusive conversation. Parikshit Luthra, my colleague, is in conversation with Rajiv Bajaj of Bajaj Auto. Parikshit, take it over.
Bajaj Auto has seen a strong rebound in exports in Q3 of FY26 with 200,000 export sales per month since October, and the numbers crossed the 600,000 mark after 15 quarters. The company expects this export momentum to continue. In fact, the Bajaj Auto leadership has said that the company is on the path to deliver its highest ever top-line performance in dollar terms this financial year. Continued leadership in the three-wheeler segments is also supporting the growth of the company. Bajaj Auto emerged as the #1 player in the electric auto segment in Q3. In electric two-wheelers, TVS, Bajaj Auto have consolidated their position as the top 2 players, followed by Ather Energy, Hero MotoCorp and Ola in the 5th place. Bajaj Auto has said that for electric two-wheelers, the company has emerged out of supply chain disruptions and is working on a rapid scale-up of sales and production. While Bajaj Auto's two-wheeler sales in the domestic market were up 25% at 214,000 units in January this year, overall, between April to January, the domestic two-wheeler sales for the company were down by about 2%. To drive domestic growth, Bajaj Auto has taken 7 initiatives in the form of upgrades recently, and 8 more interventions or products are expected to come out in the next 4 months. Increasing growth in the 125cc plus segment and the 150cc plus segment will be a priority for the company. Joining us now to talk about all of this is Bajaj Auto's Rajiv Bajaj, the managing director of the company. Mr. Bajaj, thank you very much. The export performance has stood out in the last quarter. How do you see the export momentum continuing?
Hi, Parikshit. Yes, exports has been our most standout vertical over the last quarter. As you mentioned, after a long time, we crossed an average of 200,000 vehicles per month. In the last quarter, we are set to repeat that in this quarter and hopefully do even better in the next year. Let me, just share some data points with you, starting with our oldest markets. Sri Lanka, for example, from complete collapse, say 2 years ago, is back to over 10,000 a month. Nepal, also very troubled in recent times, now over 5,000 a month. Our biggest market, Nigeria, that used to average at its best 60,000 a month, had gone to 0, and now back to 30,000 a month consistently. And I believe looking at 35,000, 40,000 a month in the near future. Doing very well in Kenya, Uganda, DRC, but the star really is LATAM, as Rakesh has been telling you, not just again the older markets like Colombia and Central America, but the relatively newer ones, Mexico, Brazil, where we are up to now over 3,000 a month, and I believe in the top 5 in the market in terms of number of players. Parikshit, I never thought a day would come when I would be saying to you that in just 1 month of January, we recorded a sale in LATAM alone of over 50,000 motorcycles, most of which are Pulsar and Dominar, and over 5,000 three-wheelers. I never thought this would happen, but it has.
All right, so that's a strong performance in Latin America, as you pointed out. 50,000 two-wheelers in January, 5,000 three-wheelers. So if the numbers, export numbers crossed 600,000 in Q3, would you expect similar numbers, or could you give us a growth projection for this quarter, for Q4 and going forward?
This quarter should be very similar. Also because the month of March, as you know, in terms of accounting term, for us ends by 20th of March in terms of exports, making sure that all the bill of lading, etc., is available to close the books. So this month, despite a shorter month in that sense, this quarter we will still finish at 600,000, having done 215,000 in Jan. We are set to repeat that number this month. And then the balance will come in March. But from first quarter of next year, we should certainly be doing better. I am hopeful that with the spillover from March into April, we should be edging towards 250,000 in April.
All right. Also to ask you about the recent trade deals, how are you encouraged by the FTA conclusion with the European Union? It's going to come into effect next year, and we will be getting zero duty access for our two-wheelers. How does this help you, and how does it open up new markets?
Well, I'm very positive, Parikshit, obviously, because, fundamentally, let me tell you this from our recent experience with so many European suppliers that are supplying to KTM that I have been speaking with. And it's very clear. They say to us that in the pursuit of China plus one, they evaluated India, they evaluated Thailand, and they evaluated Vietnam. These are the three sources that most people are looking at. And almost without exception, everyone says that so long as there is scale, you cannot beat India. India is more competitive than all these alternatives, including, at least in our industry, what I have heard from them, even China on both quality and cost. So, ours is a business where we have tremendous scale, unlike, for example, the car industry in India. So, this deal is going to be great for the two-wheeler industry.
All right. And what about the United States? We're seeing a lot of uncertainty with the trade deal there. Yes, it has been agreed upon at 18%. Then, of course, the Supreme Court struck down the IPA tariffs. Then Donald Trump increased tariffs to 10% and now to 15%. How do you see the uncertainty there? How does the company and your export push get impacted?
That story is we've done very well, Parikshit. As someone said, you can't control the wind, but you can adjust your sails. And it's a real testament, as I told you the last time we spoke as well, to Indian engineering and Indian engineers, that when the 50% tariff was imposed, Bajaj Auto absorbed most of that for the export of both KTM and Triumph out of India to the US, a volume for us about 15,000 per year. And let me tell you, despite absorbing most of that 50% increase, our EBITDA on those products was over 20%, over our corporate average. That just tells you how competitive India is. Now, of course, we are shipping not at 50% tariff, but at 15% tariff. We've just changed FOB in that context. So obviously, the volume has been protected, and the EBITDA is going to be very, very strong. So again, US is looking great for us.
Right. Now, just to ask you about certain measures that the Indian government is taking to support exports. But at the same time, the ROTTEP scheme, the government there has slashed duty benefits by 50%. Now, exporter bodies have expressed concern. They've urged the government to rethink. How does this impact the two-wheeler segment especially?
Well, it can only have a negative impact. I've always said that more than anything, the government just in this regard has to ensure greater and greater ease of doing business. In terms of what I like to call the 5 L's, labor, legislation, land, logistics, and electricity. And it's true. Again, if I compare with markets like Thailand and Vietnam and some others that we have some experience of, it is still harder to do business in India than it is to do out of those places. And ROTTEP, as everyone knows, is not a subsidy or an incentive. It is basically trying to negate exporting your inefficiencies or the inefficiencies of the ecosystem in which you have to perform. So frankly, for an exporter like Bajaj Auto, whose export EBITDA is way above its corporate EBITDA of 20%, and the way the rupee is depreciating, it is not the most significant thing. But for a lot of the other people who are especially in a B2B kind of business, who do not have price elasticity, I can imagine that this is not a trivial issue. And I just don't understand, it could not have been more ill-timed. So really, I have to say this, that there's some mantris and some babus that are really brain dead out there.
All right, just to ask you about EV sales, the company has been looking to tackle supply chain issues. EV sales, as per Vahan numbers for January, they were in the range of 26,000 units. Bajaj Auto was in second place after TVS Motor Company, and somehow both companies have consolidated their position over the last 1 year. How do you look to drive sales going forward, and how do you expect the sales and production to increase?
Well, let me tell you, Parikshit, as much as we remain India's #1 automotive exporter by volume, we are actually, we have been for some time, India's #1 EV company. This year, our PLI claim in that regard will be of the highest slab, and I think will be to the tune of almost 1,000 crores of rupees, of which recently I told you a couple of months back that the first tranche of 642 crores or so that we applied for was granted to us by the government without any modification. Coming more specifically to your question, I'll start with the three-wheeler, where, as you said in your introduction, we are now the market leader in E3-wheelers. We've been in the top 2 with Mahindra for a long time, but in recent months, we are clearly pulling away to the #1 position. We are close to the 40% market share at which we hope to close this month, representing 10,000 vehicles a month, which is not a small volume. But our ambition is very clear. In the ICE three-wheeler market in India, we have 70% share, and we are not going to stop till we get this 40% to 70%. In the E2-wheeler market, where our brand is the Chetak, again, we are in the top 2, as you mentioned, but there I must admit that TVS has been ahead more months than we have. We have now stabilized at about 30,000 vehicles a month, having overcome the supply chain issues and other operating issues. And our capacity will be up to 40,000 across the supply chain from April. So that's what we've set our eyes on as the next target. The answer to your question, what's the way forward? The way forward in this business is always, product as strategy in the wider sense of the term. And I feel very confident that we will continue to be a very significant EV company, if not the largest EV company in India for some time.
Fly Emirates, fly better.
Welcome back. You're still tuned into Halftime Report on CNBC TV 18. It's turning out to be a very down day for the market. So the Nifty is just about holding at around 25,445. So below that 25,500 mark as we speak. The mid caps also under pressure. So down around 0.8% at this point in time. The Bank Nifty, which was fairly resilient, is now showing a little bit of incremental pressure. So the Bank Nifty also just about lower by around 0.2% at this point. Fairly resilient, but you'd have to say there's some pressure seeping in. But joining us now from the Kotak Institutional Equities Chasing Growth 2026 Summit is Alankar Garude. He's the analyst at Kotak Institutional Equities to discuss the latest trends in the pharmaceuticals and healthcare space. Alankar, good to see you in, and wanted to start by asking you how the conference is going. What are the big themes that you're discussing in the pharmaceutical and healthcare space? What are the big questions? What are people liking? What are people interested in?
Hi, good afternoon, Ekta. So we have 29 healthcare companies attending our conference this year. Broadly, about 20 companies in pharma, about 6-7 companies in hospitals, and a few diagnostic companies as well, along with one pharmacy company. Broadly, the mood is pretty positive if I look at all these different subsegments. If we start off with pharma, I think the key talking point is a very strong performance on the domestic front over the last few months. And how long will it continue, especially in context of the upcoming GLP-1 launch next month. Apart from that, there is a lot of discussion as far as US is concerned, not just around specific molecules, but how the market will behave, given that the number of shortages in the market have come down. So far, companies seem to be suggesting that the pricing regime continues to be stable. There is fair amount of discipline in the market, which augurs well. And if you look at some of the other markets, Europe or some of the emerging markets, there as well, the trends continue to remain pretty healthy. So apart from the fundamental underlying local currency growth remaining strong, there are some forex tailwinds as well. And all in all, we are looking at a pretty healthy outlook as far as margins are concerned. If we strip off some of these chunky one-time opportunities like, say, Revlimid.
Okay.
So that's on pharma.
Okay, that's on pharmaceuticals. But what is the preference right now for you in terms of, say, a portfolio? How much weightage would you give pharmaceuticals? How much would you give healthcare? And what would your preference be within that, within the spaces on a micro basis as well, within the pharmaceutical as well as the healthcare basis?
So if you purely look at it from a top-down standpoint, we are more positive on the CRDMO space within pharma, followed by domestic formulations. And then on the healthcare services side, which includes hospitals as well as diagnostics, we are more positive on hospitals with a 3 to 5 year view. US generics, generally one needs to look at it from a more bottom-up standpoint. We like some companies which have a more US generics exposures, for example, Lupin. But then from a top-down standpoint, our pecking order would be CRDMOs, followed by hospitals, followed by export generics, which includes US as well.
Mm-hmm. So you said DMOs are the players that you're liking as well. Alankar, good afternoon. This is Vinny joining in the conversation. What I also wanted to understand, the CDMO, CRDMO space. These companies and these stocks in the recent time have seen a significant correction. Only in the last couple of days, they're seeing a bit of a comeback. In the CRDMO space, any specific names that you're looking at?
Sure. See, what happens here is, if you look at the long-term structural opportunity that has stayed intact, are we seeing any change in the way the discussions are happening between these companies and their clients? The answer is no. There's also the Biosecure Act to talk about. So purely again, if you think about it from a 3 to 5 year view, maybe more, there's nothing which worries us or there's anything incremental which has happened over the last few months, which comes as a headwind for the sector. But what happens is many of these Indian companies have some concentration risk, product concentration risk, as well as client concentration risk in their portfolio, which is creating some havoc. We've seen that happening with Syngene and Piramal over the last 3-4 quarters now. If you look at other smaller companies like Blue Jet as well, we've seen something similar. So if destocking hits your largest molecule, that does tend to create a big impact. But if you look at some other companies like Sai Life Sciences, for example, they've had a fabulous run over the last few quarters. They have a pretty strong pipeline in place. And from a one-year view, that is one stock which we definitely like. Even DVs, for that matter, has been doing quite well as far as the CSM portfolio is concerned, or the CDMO portfolio is concerned. DVs has been facing pricing pressure on the generic API front, and that's been the case for the last 3 to 4 years now. But thankfully for them as well, the pipeline, again from a 2 to 3 year standpoint, maybe more, is looking quite healthy on the CDMO front. It's just that as far as valuations are concerned, they are a bit stretched in our view for DVs. So that's why within the entire pack, we like Sai with a 1 year view, and Syngene and Piramal with a more 3 to 4 year view. So that's broadly the pecking order as far as CRDMO space is concerned.
Okay, all right, fair enough. So that's the pecking order in the CRDMO space. Just wanted to narrow down and talk a little more about what you probably like, in terms of the US generic space, because the top companies such as Cipla as well as Dr. Reddy's are facing a little bit of headwinds at this point in time. Dr. Reddy's is still awaiting that approval from Canada. But they sounded quite positive, but Cipla is facing some amount of supply issues for lanreotide. Can you just narrow down and tell us what you like within the US generic space, considering that, Revlimid generic is also an opportunity which is now done with?
So yeah, we had Sun Pharma, Dr. Reddy's, Lupin, Cipla at our conference over the last 2 days. Our pecking order within this entire pack, even though Sun is not exactly a US generics play, we like Sun Pharma, followed by Lupin, followed by Cipla within this space. Lupin in particular is one stock which has a very heavy leverage as far as US generics is concerned. Of course, they are trying to move up the specialty curve as well. There's biosimilars which will contribute meaningfully for them as well. So even though earnings for Lupin might fall off after tolvaptan and mirabegron opportunities come off, they still have a pretty good pipeline over the next 2 to 3 years, both on the biosimilar side as well as certain 505(b)(2)s, which make us optimistic about continued strong trajectory as far as US growth is concerned for them. Apart from that, Cipla has had a relatively lean run over the last few quarters as far as US ex-Revlimid is concerned. They have a bunch of products lined up, about 8 products, 4 in the respiratory space, 4 in the peptide space. So over the next 2 to 3 years, as some of these opportunities fructify, ex of Revlimid, we are looking at a pretty healthy US sales trajectory for Cipla as well. What is important to highlight here is if you look at the specialty foray, both in case of Cipla as well as Lupin, and maybe if we can add Reddy's here as well, all 3 companies have been trying to kind of up the ante as far as specialty is concerned, innovation is concerned. Lupin and Cipla have been actively talking about it from a US standpoint. Dr. Reddy's is more focused on some of the other markets when it comes to specialty. So that's the other aspect to keep an eye on as far as US is concerned, apart from the normal generics business for these 3 companies in particular.
Okay. Alankar, just a quick one. Your top picks, and overall, are you seeing the China plus one story also play out for CDMOs?
So I wouldn't call it China plus one. I'll come to your question on the top picks in a bit. I wouldn't just call it China plus one. What we are seeing is a clear trend towards supply chain diversification, whether it's happening from US or Europe or China or any other country. I think the point here to highlight is there are clients, there are big pharma companies who are looking at more than one source, in many cases more than 2 sources, and then we are seeing a lot of these Indian companies acting as a second or a third source. And there have been instances, ample instances in the last few years wherein Indian companies have become the primary source as well. And hopefully we see that trend increasing over the next few years. So that trend is something which will continue. Is China hurting because of a big amount of business coming to India or Indian CDMO companies? The answer in our view is no, because Chinese companies are also doing quite well. But at the same time, given the small size of the Indian CRDMO market, we are more optimistic about the supply chain diversification theme and the kind of capabilities, relationships which Indian companies have built, helping them in the years to come. As far as our top picks are concerned in the pharmaceutical space, Sun Pharma, Lupin, Cipla, and Torrent, these are the ones in the large cap space which we like. On the mid cap side, we like Sai Life Sciences, Emcure, and Corona Remedies. So that's on the pharmaceutical side.
Okay. Alankar, thanks.
Okay, all right, Alankar. We're going to leave it on that note. Interesting picks coming in there. And I'm sure the top opportunity to talk about soon would be obviously the weight loss drugs as they pick up pace. We'll be touching upon that soon enough. Thanks very much for joining in and speaking with us. We'll take a short break, but here is some good news for our viewers. India Business News Leader is now just a click away, introducing CNBC TV 18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC TV 18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty is below 25 or around the 25,400 level, down 280 points almost in the trading session. But in our What's Trending segment today, we're going to be putting the spotlight and tracking the IT space as the sell-off deepens there, with Nifty IT down significantly in the month of February, and mainly the AI-led disruption fear that's leading to the sell-off. How big is this as a threat for IT, or is it a fresh legacy modernization opportunity for Indian IT companies? Let's go across to Rima to understand more on this. Rima, over to you.
Thanks so much for that. First, let's step back and just take a look at the price action and the price damage. The Nifty IT index is down 20% in the month of February, and February so far is turning out to be the worst month on record since the global financial crisis. We need to go back in September of 2008 to see this kind of a fall in a span of 1 month. You take a step back and the pain is even deeper. This is the fall since the start of the year. The most of the pain is actually in the month of February, because 3rd of Feb or 5th of Feb is when Anthropic Claude had released that first update via which agents can do so much work, whether it's legal, wealth management, etc. And the entire narrative shifted from AI is assisting software companies to the fear that AI perhaps will replace software companies. Now, yesterday, the casualty of AI-led disruption was on IBM. IBM slipped close to about 13% yesterday, seeing its single biggest fall in the last 25 years. The reason is that Anthropic's Claude latest model shows that it can read, analyze, translate, and modernize COBOL code. Now, COBOL is a computer language program which was way back in the 1960s, 70s, and 80s. But even today, it still dominates most of the banking stocks, insurance. In fact, some reports say that 95% of the ATM transactions in the US still happen on code which is written in COBOL. Now, Claude can completely modernize this. Indian IT companies have IBM as a customer. So IBM is a client for many Indian IT companies, and Indian IT companies themselves help in project maintenance, application work for COBOL, and help with the migration. Though some believe that yes, there will be some revenue deflation if indeed Claude can in a way replace COBOL, but there will be an opportunity which opens up on account of legacy modernization. But the other argument is that despite the correction, Indian IT companies are still trading at 16 to 18 times, and it's still more expensive than global peers. And Accenture is at 14 times, Cognizant is at 10, 11 times. So even after the correction, Indian IT companies are still trading at a premium to global peers. And there is that question mark on what kind of growth Indian IT companies will see. And there is still lack of clarity, a lot of anxiety surrounding that. Back to you.
Okay, absolutely, Rima. Thanks very much for that. That anxiety is definitely played out on the IT stocks. Like Rima mentioned, it's down 20% in the month of Feb. Remember that it is set for the biggest monthly fall that we've seen since the global financial crisis, which was in September of 2008. And if you're just talking about the recent fall, the IT index is just down 8%. It's already down 8% in just the past 5 days. We'll take a short break on that note, but on the other side, Manisha Gupta will join in. She has with her Narendra Taneja, an energy expert. Stay tuned.
Welcome back. Joining us on the show now is Narendra Taneja. He's an energy expert. Mr. Taneja, thank you so much for joining in. And there's plenty happening in the global markets when it comes to geopolitics impacting the crude oil prices. With the both sides talking, which is US and Iran, on the nuclear deal or the uranium enrichment for that matter, how are you looking at that, proceeding or progressing from here? And what kind of geopolitical premium do you see on the crude oil prices at these levels?
Well, first of all, honestly, Manisha, I don't really think this has anything to do with the talk on the nuclear deal. Because as it is, President Trump himself announced after the attack on the nuclear installations of Iran that there's nothing left. It's all destroyed. Then what are they talking? Now, the question is, I don't think really it's about that. It's more probably aimed at kind of engineering or triggering a kind of situation on the ground in Iran, which sooner or later, could lead to regime change. And that means, the companies open up for Western, particularly American investment in hydrocarbon sector, in oil and gas sector, and also infrastructure. Because Iran, at the end of the day, is a huge country with a very large population. To me, it appears that all that we see, for instance, if you really want only to talk, why do you need to bring in 2 aircraft carrier and these dozens and dozens of aeroplanes, and then at the same time, all kind of, military preparations? My sense is that, probably what President Trump wants to do is to kind of go for a strategic, limited shock and awe military strike against Iran, maybe 2 days, 3 days and all that, which probably they think that would trigger a kind of chain of events, which basically would bring people on, on the street, asking for a change, a regime change. Either there would be a regime change and a democratic government comes into power, or probably it could even be a kind of military taking over. So that's my sense. I don't understand that these negotiations brokered by Oman is going to lead to anything, because there is nothing left, according to American president himself, in terms of the nuclear assets that they want to negotiate on.
And how much of a geopolitical premium do you see on prices on crude right now?
Well, if you, Manisha, if you really go strictly by demand and supply fundamentals and the basic economics, I see no reason for oil to be anything more than $58 per barrel. Brent, of course, I'm talking about. Anything that's more than 58, or let's say 59 or 60, is actually geopolitical premium. And right now, since Ukraine negotiations are going on for peace, Gaza is more or less behind the picture. So it's all about Iran. So whatever you see, above, let's say $59, $60 per barrel or $58 per barrel is all Iranian premium, because markets are very edgy, markets are very anxious. Though majority people in the market feel that even if they go for a military operation, it would be limited. It would not lead to the closure of the Strait of Hormuz, because that's the main point. And but that's the calculation of majority people in the global market, because if that happens, the Strait of Hormuz is either mined or closed by Iran, or even if they make an attempt, then Saudi Arabia, and Iraq and Qatar and Kuwait, they all will have to get into action against Iran. And I don't think Iran would like that kind of situation, that they all gang up against Iran. So my own sense is that probably we are going to see some kind of military action against Iran. It will not produce any results immediately, but they think that it would probably trigger or engineer a kind of chain of events which could lead to, either a change of regime, or the regime is more willing to go for some kind of compromise with the West in terms of opening up, in terms of oil and gas assets, bringing investment from the Western countries, so forth. So basically, either the present regime would be forced to change the color and stripes, or there would be a regime change. That's probably what they want.
All right. So that is something that we will have to watch out for the next few days, on what the US president says and the kind of reiteration that we see from Iran as well. Mr. Taneja, as always, thank you so much for joining in. With that, let's go for a short break. When we come back, we'll talk more about markets and short space.
Welcome back. You're still tuned into a halftime report on CNBC TV 18. Let's go across to Gaurav now. He's going to take us through all of the buzzing stocks he's tracking at this hour. Gaurav, over to you.
Well, yes, it's not a good day for Nifty to say, but if you look at some of the gainers, first let's talk about one MobiKwik. If you look at the stock, now MobiKwik Security Broking, they have got BSE's nod. Remember, they had got this SEBI's nod in July 2025, and this is actually sentimentally positive for the stock, and that is what we are seeing in the stock price as well. D-Development. Now, this stock is gaining in trade for the second straight day. We remember yesterday we saw the stock actually, the company actually got 170 crores of order, and today also the stock is up more than 6%. Northern Arc, if you look at this company, Motilal Oswal, they have initiated with buy rating and a target price of 360 rupees, and that is something which is buzzing the stock. Pace Digitech, this is the next company that we are tracking, and the reason being that they have received another order worth 159 crores, and it is also helping the stock gaining in trade today. And let's also not forget about Nifty PSU. If you look at the index, we are highlighting that every day we are seeing some positive uptick, although the index is down. But if you look at the stocks like UCO Bank, Central Bank of India, Maharashtra Bank, all of these stocks are up in trade, and we are seeing some volumes as well. And lastly, some of the volume-led gainers, we have got companies like Morpin Labs. Yesterday also the stock was up. J&K Bank and Apollo Microsystem. Now these stocks are not only up, but we are seeing strong volumes. On the losing side, let's not forget about Nifty IT. Now we are seeing a sharp fall, almost 5% decline in Nifty IT, and we have seen stocks like Coforge, Persistent System, HCL Tech, all of these stocks are down in trade more than 5%. Other than that, let's also not forget about the stock like travel aggregators. We are seeing some sell-off in these stocks as well, in the likes of Yatra Online, Ease My Trip. We are seeing some fall, and at the same time, volumes are also high in these companies. And let's also not forget about Paytm. Now, today we saw one MobiKwik gaining in trade, but given that there can be competition for the stock, we are seeing some sentimental negative impact in the Paytm. As we speak, the stock is down more than 4%.
Okay, Gaurav, thank you so much for that. But on that note, we're going to step into a very short break. We'll come back with more of the markets on the other side. Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty is at 25,400, just managing to hold on to that level. Day's lowest point is what the Nifty is trading at, down 300 points now in the trading session, 1% decline for the Nifty 50. Obviously, most of the sectors today are trading in the red, except for Nifty Pharma, which is managing to hold on to a slight bit of a gain. But IT, clearly the top sector loser, down 5%. Realty following suit as well, down almost 2-3% in the trading session, and broader end of the market also continues to be under pressure. Advance decline ratio clearly in the favor of declines versus advances. But with that, we're absolutely out of time on this edition of Halftime Report. Thank you so much for tuning in. Up next, your Business Search.
Stocks see a sharp drawdown after tariff jitters and AI disruption. Fears drag U.S. stocks lower. IT and realty are the big drags, while PSU banks and metals eke out gains. Global tech stocks like IBM and Indian IT shares take a beating after Anthropic unveils a tool to auto-upgrade legacy COBOL systems. While analysts rule out an existential threat for Indian IT, they clearly see deflation ahead. Bharti Airtel is set to scale Airtel Money as a digital lender after RBI's nod to operate an NBFC. It will invest 70% and the promoters 30% of the 20,000 crore rupee capital allocated. The stock slips as investors turn wary of the non-core bet. The National Monetization Pipeline 2.0 aims to raise 16.7 lakh crore rupees over 5 years. The plan includes stake sale by GAIL in CGD entities and listing of GAIL Gas, Coal India diluting holding in arms, Airports Authority of India divesting stakes, and public offers by power PSEs. Bajaj Auto MD Rajiv Bajaj sees exports at 2.5 lakh units in April versus 2 lakh last month, even as he slams the ill-timed revision in RoDTEP rates. He also aims for a 70% share in EV three-wheelers, 40% now, and market share gains in EV two-wheelers. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramanan. Hi guys, good afternoon. It is red across the screen, expiry day, weak global cues and the sell-off in IT stocks, all of them hurting the market sentiment today. If you look at the Nifty, it's at the low point of the day, 25,400, about 1% lower, 300 points down. The mid-cap index falling in line with the blue chips, but the Nifty Bank faring slightly better than both the Sensex and the Nifty. If you take a look at the sectors, the pharma and the healthcare sectors are the only ones managing to hold on to slight gains. Natco Pharma, Torrent Pharma, and Aurobindo Pharma, all of them gaining between 1% and 3%, as you can see on your screens. But it is that IT pack that's weighing on the market after Anthropic's latest announcement spooked IT stocks across the world. Persistent, Coforge, L&T Tech down between 5 and 6 and 7%, as you can see. It's not just the mid-cap IT, right? Large-cap IT is also facing the pressure. All of them down. Infosys, Wipro, TCS, 3%, 2%, 4%, all of them falling in trade. But it's also those realty stocks that are feeling the pressure as well. That index is also down in trade. We've got Prestige Estates, Godrej Properties, Lodha Developers, all of them down between 2 and 5% in trade. But as I pointed out, the top story today, global software stocks continue to sell off and Indian IT majors join in as fears of disruption by AI grow. Rima Tendulkar is here with some numbers. Rima.
Thanks so much for that. Well, it all started in early February when Anthropic released the Claude update via which AI agents can do legal work, wealth management, and so much others. And the entire narrative towards Indian IT, change. And February's been such a brutal month. The Nifty IT index is down more than 20% in 1 month alone. And this makes it the single biggest monthly fall since the global financial crisis. We need to go back till September of 2008. And if you look at the individual stocks, these are large companies. TCS, for instance, it's a $30 billion revenue company, and that's seen a fall of 20%. Similarly for Infosys, HCL Tech, Wipro not getting spared. Some of these large mid-cap companies no longer a part of the Nifty, but at one point, an LTI, Mindtree, Tech Mahindra were a part. Persistent is bleeding 23% lower. Now, yesterday, the culprit was that one Anthropic Claude's update can modernize, analyze, and translate a very old programming language called COBOL. Now, this was a language which was written in the 1960s, 70s, and it became the language of banks, financial institutions. According to some estimates, even today, 95% of the ATM transactions in the US happen on code which is written in COBOL. And because it was so risky to modernize this, no one touched it for so many years. And then yesterday, Anthropic's Claude update showed that they can now modernize it, which suddenly once again questions the business model of IBM in hardware and software, and then even Indian IT companies, because they have IBM as a client or a customer for themselves. They provide maintenance work, application work. They will have an opportunity if indeed this whole COBOL modernization takes place, but that opportunity could be back-ended. For now, the fear is of revenue deflation. And the second thing is that analysts point out that even after a 20% price correction, massive PED rating, Indian IT companies are still trading at a premium to global peers. For instance, a Cognizant is at 10, 11 times. Accenture is at 14 times, while an Indian IT company is, Indian IT companies are trading at 16 to 18 times. We've seen massive price damage. Everyone's selling first and then asking questions to see how the operating and business model is going to evolve. But there's a lot of anxiety which is now being built into the narrative surrounding Indian IT.
So big AI disruption there that's causing fear for IT stocks, which are tanking in trade. But Rima, stay with us. Bharti Airtel slips as it announces a 20,000 crore rupee investment into building Airtel Money as a high-scale NBFC, right? Tell us more about this.
So Airtel Money received its NBFC license from the Reserve Bank of India on 13th of February. Now, Airtel Money was operating in India, but it was operating as a lending service provider, which means it couldn't directly lend, but it could facilitate loans. And via this lending service provider, they had disbursed about 9,000 crore. Now, after they get that NBFC license, they can directly lend, which means they're competing with a Bajaj Finance, a Jio Finance, etc. Now, what is spooking the street today is the fact that Airtel is saying that we're committing 20,000 crore in terms of capital for building Airtel NBFC, Airtel Money over the next few years. 70% of that will come in from the listed entity and 30% from the promoters themselves. Now, this is what is known. Now, analysts point out that overall 14,000 crore for a Bharti Airtel is not very large given its size, given how prudent it's been in terms of the capital allocation. But this capital commitment will keep going up as the company scales in size. So that is one. And secondly, the benefits. It's not that Airtel NBFC will make money, but that is going to be a bit back-ended. So I think that is just the fear which is built in the market. 20,000 crore is what they've committed, and the market capitalization of Bharti today has fallen double of that at close to 40,000 crore rupees.
All right, Rima, many thanks for taking us through all of those details. Now, in an exclusive conversation, Rajiv Bajaj, Managing Director of Bajaj Auto, tells CNBC TV 18 that he expects the export to be around 2.5 lakh units from April. He also says that they will increase electric two-wheeler production to 40,000 units per month by April. Take a look.
Exports has been our most standout vertical over the last quarter. As you mentioned, after a long time, we crossed an average of 200,000 vehicles per month. Biggest market, Nigeria, that used to average at its best 60,000 a month, had gone to zero. And now back to 30,000 a month consistently. And I believe looking at 35, 40,000 a month in the near future. In just 1 month of January, we recorded a sale in LATAM alone of over 50,000 motorcycles, most of which are Pulsar and Dominar, and over 5,000 three-wheelers. This month, despite a shorter month in that sense, this quarter we will still finish at 600,000, having done 215,000 in Jan. We are set to repeat that number this month, and then the balance will come in March. But from first quarter of next year, we should certainly be doing better. I am hopeful that with the spillover from March into April, we should be edging towards 250,000 in April. We have now stabilized at about 30,000 vehicles a month, having overcome the supply chain issues and other operating issues. And our capacity will be up to 40,000 across the supply chain from April. So that's what we've set our eyes on as the next target.
And as we slip into a break, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC TV 18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC TV 18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Fly Emirates, fly better.
Welcome back. You're still with us on Business Lunch. US President Donald Trump has warned countries against backing away from recently negotiated trade deals with the US after the Supreme Court struck down his emergency tariffs, saying that he would hit them with much higher duties under different trade laws. Take a look at this report.
U.S. President Donald Trump on Monday warned countries against backing away from recently negotiated trade deals with the U.S. This follows the Supreme Court decision Friday to strike down his emergency tariffs. Trump said he would hit them with much higher duties under different trade laws. On social media, he said, quote, "Any country that wants to play games with the ridiculous Supreme Court decision, especially those that have ripped off the USA for years and even decades, will be met with a much higher tariff and worse than that which they just recently agreed to. Buyer beware." Trump said he also may impose license fees on trading partners as uncertainty over his next tariff moves gripped the global economy and sent stocks lower. A spokesperson for the U.S. Trade Representative's office did not immediately respond to a request for further comment on Trump's plans. In Brussels, the European Parliament decided on Monday to postpone a vote on the European Union's trade deal with the U.S. after Trump imposed a new temporary import duty of 15% on imports from all countries.
They don't know what would be the terms of the deal now.
Nicolas Frederic Poitiers, a research fellow at the Bruegel think tank, says there is a high level of uncertainty in Europe over how this will play out.
It is unclear what will be the rules under this new tariff, so this has to be calculated good by good. It is not unlikely that there will be goods where the tariff rate will be somewhat higher than under the agreement of last year. At the same time, it is not clear if these tariffs will stand for very long anyway. So right now, there's a lot of uncertainty over this.
Trump's new duty is set to take effect early Tuesday morning. At that same moment, the U.S. Customs and Border Protection Agency said it would stop collecting the duties ruled illegal by the Supreme Court's decision.
Global markets are still trying to assess the potential economic impact of U.S. tariffs that are going away, tariffs that are here to stay, and those that are potentially on the way after U.S. President Trump threatened nations that would play games following the Supreme Court's ruling last Friday. CNBC's Steve Leisman has more on this.
With the Supreme Court striking down President Trump's emergency tariffs, but the president promising a whole new series of import taxes, economists are expecting somewhat less inflation and a reduced hit to growth this year. But the impact will still be there, and there will be greater uncertainty until the administration details the new sets of measures. Erica York from the Tax Foundation writing, "The Supreme Court ruling was welcome news, but the economic pain is far from over. The Trump tariffs amounted to an average tax increase per U.S. household of $1,000 in 2025. Now, with the IEEPA tariffs being ruled illegal, the president's remaining new tariffs will result in a household burden of $700 in 2026. Treasury Secretary Scott Bessent saying Friday that the administration planned to raise as much revenue through the new tariffs as with the old ones. But most think the effort won't fully succeed. Goldman Sachs, for example, believes the effective tariff rate will fall to 9% from 10%. It said 60 to 70% of the tariff price hikes have already been passed through to the consumer, raising core inflation prices by 0.7%. But Goldman doesn't believe there's much more left to pass through. Economists also don't think businesses will roll back prices. Barclays writing, "We doubt that businesses which recently raised their price due to tariffs will lower them back. They would likely wait for more clarity on the future tariff rates." It's the lack of clarity that may take the biggest toll. Businesses now brace for a renewed period of uncertainty over what tariffs will be in place and over what time, along with potential legal challenges. As for the Fed, they're likely to take the administration at their word, which is that they want to raise as much revenue from the new tariffs as they did from the old ones. So that means little change in the outlook for Fed policy. Steve Leisman, CNBC Business News.
So Steve Leisman there with the latest on what's happening with the tariffs. But amid the ongoing speculations regarding the possible attack on Iran by the United States, President Donald Trump pushed back on reports claiming that the Pentagon has cautioned Washington against prospects of war with Iran. He even insisted his preference was still to strike a diplomatic deal. Trump said in a social media post, and I quote, "I am the one that makes the decision. I would rather have a deal than not. But if we don't make a deal, it will be a very bad day for that country and very sadly, its people," end of quote. On that note, it's time for us to head into a short break, but more news and updates coming up on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. Let's get some updates from the Labour Ministry. Sources tell CNBC TV 18 that the EPFO will be settling in inoperative accounts. Timsy Japuria gets us all of those details. Timsy?
Well, what we are given to understand from Labour Ministry sources is that over 7 lakh EPFO accounts which are inoperative currently will now be settled, and what sources say that the money that is lying in these over 7 lakh accounts, which is a maximum amount of 1,000 rupees in each account, will now be settled by sending this money back to the Aadhaar seeded bank account of the account holders or their nominees where account holders do not exist anymore. In that case, the government will now aim to settle these accounts without any paperwork, and this involves amount of over 30 crore rupees, and overall the government aims that in long term there are about over 31 lakh inoperative accounts having more than 10,000 crore rupees stuck in them, and this government wants to settle very soon. Government sources indicated that this amount, after verification, in cases where there is more than 1,000 rupees lying in each account, will be sent back to the account holders, because in an inoperative account situation, that is where there is no movement, no activity in the account for last 3 years, no interest is also given. Thus, EPFO feels that this money should be sent back to the account holders. So let's see how soon this money comes back to the people, and yes, whether this move actually gives a further boost to the consumption or not, something that we'll have to wait and watch.
All right, Timsy, many thanks for those details. But shifting focus to the centre's asset monetization pipeline, public sector enterprises will start offloading stake in subsidiaries as part of the new monetization plan. Sapna Das is here with all of those details on the phone line. Sapna?
Well, definitely this is an ambitious plan that has been chalked out by the central government. The finance minister made this announcement as of yesterday when she put out the details of the new asset monetization roadmap. Having said that, clearly disinvestment is going to play a role in the scheme of affairs. For example, it mentions very clearly that the PSUs themselves, the Navaratna, the CPSEs themselves will be empowered to go ahead and sell their stake in their subsidiaries, and that money is going to be funneled back in the shape of monetized assets or monetization value, and that is something that they can use for their capex and other resources. So, for instance, the roadmap mentions very clearly that to start off with, the Ministry of Petroleum has written, or rather has proposed that, for example, GAIL should be, consolidating its shareholdings in all these CGDs in the gas distribution network, and that should be basically brought into GAIL Gas, and later on GAIL Gas can actually go for a listing. So all of this will have to be done by the CPSEs themselves. The money is not going to come to the government at all, but it's going to be used by the PSUs. That's one example. Similarly, for the power sector, in the coal sector, everywhere, the roadmap mentions very clearly that the big CPSEs have to come forward and dilute their stake in their own subsidiaries and use that money for capex. Number three, also in terms of, if you look at the tourism sector, the redevelopment plans for Hotel Ashok and Hotel Samrat are actually back on the agenda. In fact, Hotel Samrat was not part of the earlier asset monetization roadmap which government had put out a few years back, and all of that again is going to is expected to start around FY27, though the timeline for the redevelopment of Hotel Samrat has been given as FY30. Overall, around close to 75 to 80 odd thousand crores is likely to be raised by the CPSEs by all of these methods over the next 3 to 4 years, starting FY27, and which it's going to be funneled back to them. It's not going to come to the central government. That's an important point that we should highlight.
All right, Sapna, many thanks for taking us through the government's big monetization plan there. The board of Tata Sons will meet later today to consider extending Chairman N. Chandrasekaran's tenure for the third 5-year term. The board of directors, which include Noel Tata, Venu Srinivasan and Anita George, among others, will also review key business updates related to Tata Group companies at the meeting. And with that, it is a wrap on this edition of Business Lunch. Midcap Radar will take all of the market action forward. Stay tuned.
Good afternoon, you're with us here on Midcap Radar. We are coming to you live from the CNBC TV18 Motilal Oswal studios. I'm Hormas Patakia. Rima Tendulkar is with me. Rima, good afternoon. It's not a very good afternoon for the market though.
No, not at all. The Nifty has now breached the 25,400 and inching lower. We'll get to that in just a bit. These are the top stories at 1:30 p.m. Stocks see a sharp drawdown after tariff jitters and AI disruption fears drag U.S. stocks lower. The Nifty slips below 25,400. IT, realty are the big drags, while PSU banks and metals manage to eke out gains.
Global tech stocks like IBM and Indian IT shares have taken a beating after Anthropic reveals a tool to auto-upgrade legacy COBOL systems. While analysts rule out an existential threat for Indian IT, they clearly see some deflation ahead.
Textile stocks under pressure as the Director General of Foreign Trade, that's DGFT, cuts incentives under the remission of duty and taxes on export products by 50%. Brokerage firm Elara Capital believes this will force exporters to reprice contracts in a highly price-sensitive market.
Shares of Northern Arc are outperforming in what is an otherwise weak market after Motilal Oswal has initiated coverage on the stock. The brokerage is expecting a 46% base case upside with a price target of 360 rupees, citing attractive valuations. The stock is back at its IPO price. Well, if you're a bull, this is not the screen you would want to look at. 350 points down now on the Nifty. 1,200, almost 1,300 points now on the Sensex. The Nifty has now broken below 25,350 as well. So now it has convincingly broken below last Thursday's low, which was 25,388, from where it saw a bit of a recovery over the next two trading sessions. And now it's at that 25,350 mark. So 360 points down on the index, and no surprises. Leading the losses is the IT index, and almost every constituent now on the Nifty IT. Persistent is down 8, HCL is down 7, Tech Mahindra down 7, LTI Mindtree down 7, Coforge down 7. It's a sea of red for Indian IT. And the one index that was holding the Nifty together, at least for the first half, was the Nifty Bank, and that too has now succumbed to the selling pressure, is what you can see. The Nifty Bank at one point was up around 120 points at around 11:30, and now it's down 450 points as we speak. So it's a almost 600 point knock from the highs of the day for the Nifty Bank, 0.7% lower, heading towards that important level of 6,500 on the downside, Rima.
Metals too are cracking now. The Nifty Metal Index in the morning was managing to stay resilient. Pull up that intraday chart of the Nifty Metal Index. The spillover effect of the weakness today is now visible in all the sectors. Hormas spoke about banks. Look at PSU banks, and now even the metal index is in the red, down close to about a third of a percentage point. There is absolutely no sectoral index which is now in the green, and the advanced decline ratio tells you the picture of pain. We've got 623 stocks advancing for 2,300 stocks declining. What about stocks? Gaurav is now joining in to take us through the mid caps that are moving around very fast. Unfortunately, most of them are on the way down. Gaurav.
Well, yes, most of the stocks are actually down, and if you look at the broader market, it is not actually a bull's day. But let's still talk about some of the stocks which are gaining in trade. First, let's talk about de-development. This is a second consecutive day where we are seeing sharp rise in the stock. Second, let's talk about Northern Arc, because Motilal Oswal initiated with a target price of 360. They say the stock is actually a good opportunity in terms of medium term, in terms of compounding for the story. Lastly, let's also not forget about Pace Digitech. Now, this stock, we are seeing this company actually receiving order for the second consecutive day. Today, it's a 159 crores order from RIL. Lastly, if you look at the volume-led gainers, there are some stocks which are still up in trade, and these are backed by volumes in the likes of Morpin Labs, Utkarsh Small Finance Bank, where we are seeing a sharp uptick in the last 1 hour. And lastly, Vishal Mega Mart. There also we are seeing the stock is holding up more than 3% in trade. On the losing side, let's not forget about Nifty IT. It is the biggest casualty in the market today. And we have got mid-caps like Coforge, Persistent, Tata Elxsi. All of these stocks are not only down, but we are also seeing strong volumes. And if you look at the move, they are down more than 5%. And even if you look at the stocks which are currently at 52-week low, it is actually filled with more of IT stocks in the likes of Tata Elxsi, KPIT Tech. We have also got Oracle Finance, who hit its 52-week low, and Suzlon Energy, second consecutive day for the company to hit its 52-week low. And as a result, we are seeing some pressure not only in IT but across the market in a day-to-day.
Indeed, and that is the screen of red that we were talking about, be it the benchmark index, be it the broader markets. it's red all around. Good time to get in a chart check from Shrikant Chauhan of Kotak Securities. Shrikant, good afternoon. Thank you for joining in. Well, we were trying to hold 25,500 for the better part of the first half. Now that we have moved below that, we have broken below last Thursday's low as well. So now we've made a lower low. What does the chart indicate now on the Nifty with this distortion? Do you believe we go down to 25,200 or maybe even further down, or do you see some support emerging at lower levels?
Good afternoon, Hormas. Good afternoon, everyone. So while looking at the overall trend of the market, it has broken all its important level. And today, the most critical part that we can say is the market has broken the level of 25,370, above which the market has spent nearly 6-7 trading sessions. So breaking this level clearly indicates that we are heading for the next levels of 25,000, 25,100 in the near future. So at this level, we are of the view that we can expect further more weakness in the market. In case if there is any pullback, then again 25,500 is going to act as major resistance. Ideal strategy should be to look for reducing position, trading position, especially because the market has broken an important level. Around 25,000 levels, the market is having support, but for the time being, one thing is very clear that we are heading lower.
Heading lower.
On IT, is it time to bottom fish or not really? Just completely stay away. And the bigger question is, if someone has IT positions, even if it's for a longer term, not from a trading point of view, they had held it from a 1 year, 2 year point of view. Given the pace of the stock price fall, is it better to sell today because you'll save something over the next 1-2 years?
So for Nifty IT index, it has broken important level at 30,000, above which the index has spent a lot of time. And now below that, the next level to watch out for would be 26,000, 26,500. It has no support in between. So I am of the view that based on technicals, it is better to stay away from taking any contra view at this level. If there's a long-term view, then certainly one should hold on to the same, because the overall, I'm going to say the even stocks as well as index, all are completely oversold. So we may see some rebound in the market, bounce back in the market, but at these levels, the way the market, all the stocks have broken important levels, I think we are heading lower and it is better to stay away.
Better to stay away for IT. But what about your recommendations, Shrikant? Mostly, are they on the short side, or do you have any contra trades as well?
See, all these PSU banks or mid-sized banks, they are doing really well, Hormas. And whenever there is a weakness in the market and recovery or maybe some bounce back, we see some activity in mid-sized banks as well as in metals. So from the mid-sized bank, we like Union Bank. There we have specifically bullish view, and we are of the view that the stock is heading for at least 210 or 220 in the near future. So there we should look for adding some more position even at current levels. The stock on which we are bearish is Trent. Currently it is around 3,950, but the pattern is clearly indicating us that it is forming lower top, lower bottom series. So based on this technical formation, the next level to watch out for would be maybe 3,700 or 3,650. So at this level also, it's a short candidate with a stop loss at close to 4,010 on the higher side.
Boy, 8345 was the high for Trent in October of 2024. Now sub 4,000. That's the kind of value erosion that you have seen. Of course, the kind of run-up was also pretty significant there as well. So 2.5% lower for Trent. Shrikant, thank you for sparing time and joining us with your views on the index and on specific stocks as well. By the way, since we were on the subject of IT, the Nifty IT index has now slipped below the mark of 30,000. And the last time the Nifty IT closed below that 30,000 mark was back in August of 2023. So that is the kind of sell-off that you have seen now. 1,600 points shaved off on the IT index, 5% lower. Most of the constituents trading with losses of at least 7 to 10%. Take a short break. More on the markets on the other side. Stay tuned.
Welcome back. You'll be hard-pressed to find stocks which are currently in the green, but our team is just joining in. Actually, it's Gaurav who's joining in. He's got two stocks which are holding up in the green, and Vinny is also here with us to tell us why textiles are under pressure. But Gaurav, let me start with you. Northern Arc. Not a company we often talk about, so tell us a little bit more about it and why it's holding up in the green today.
Well, if you look at Northern Arc, it is actually up in trade, and the reason being that Motilal Oswal, they have initiated a report with buy rating and a target price of 360, which still offers more than 40% upside. What they're saying is that the company is actually working in a business which is addressing the underserved margins and the customers in the likes of retail credit across MSME and rural segment. Now that is something which is niche for the company. Second is what they're saying is that the key inflection point for the company is that they're transitioning from their intermediate retail model to direct to customer model. Now what is happening is that in the last 5 years we are seeing that the direct to customer model have seen a growth of around 57% on a CAGR basis. This is also accounting for more than 59% of the business now, which company is aiming to bring to around 70%. Now what it will do is that it will support growth and net interest margins, while the IR, which is their existing business model, will continue to provide stability through diversification. Now another aspect here is that the technology, which is something helping the company in the risk management. In fact, Motilal Oswal believes that the credit cost is going to be normalized in the range of 2.7 to 2.8% by FY27. And given all these aspects, if you look at the valuation, it still trades at 0.9 price to book value on FY27 earnings, which still gives attractive valuation and attractive price point, and that is the reason why they have initiated with buy rating. If you look at the market performance, even though market is under tremendous pressure today, we are seeing the stock is still holding in green, and one of these stocks today, which is still holding in green. So let's see how it performs for investors. But for now, Motilal Oswal initiated on buy, and that is the reason why we are seeing some gains in this stock.
The one stock, one among the few bucking the trend in today's session. The other one that's bucking the trend is MobiKwik. Of course, it started off on a very positive note. At one point was up almost 11%. It's now significantly off the highs, but still holding on to some gains. Gaurav, tell us more on that.
Well, MobiKwik Security Broking, it is one of the wholly owned subsidiary of the company. They have received approval for stock broking business from BSE. Remember, this approval from SEBI they had got in July 2025 itself, but now they have got it from the BSE, which will add more arm to the business. Now what it will do is that with this they will be enabled to carry activities like buying, selling, dealing and clearing and settlement of equity trades. Now it is going to be another arm and another avenue for revenue for the company. If you look at the management commentary, now earlier they have mentioned that at least in the short term they are not going to contribute so much on the revenue side specifically if you look at the broking business, but in the medium term definitely they are going to scale it up. Now what is also happening is that if you look at other players, we have already seen players like Grow, Zerodha, Angel One showing tremendous growth in terms of number of users as well as the brokerage that they receive. Apart from that, if you look at some of the other casualties, now MobiKwik is up in trade, but at the same time if you look at Paytm, it is down in trade, and the reason being that there is a sentimental impact given that it is a closest peer and the listed player if you look at the one MobiKwik, and now they are also entering into the broking side. Remember, Paytm also has its Paytm money, and there is another trigger for Paytm today is that the Airtel, now they are also coming up with the digital NBFC that they are building on, and which is something causing some sentimental negative impact for Paytm as well. So again, positive for MobiKwik because they have received BSE's nod, but it is also having some sentimental impact on Paytm. Both MobiKwik is up 2%, but now Paytm is down 3% in trade.
Gaurav, thank you for sharing that with us. The couple of names that are bucking the trend today, Northern Arc and MobiKwik. But again, back to stocks that are under pressure. Textile is one segment. If the tariff uncertainties were not enough, there is another potential headwind that has emerged for the sector. Vinny is here to tell us just that. Vinny.
Hi, so yes, the headwind that has come in for the sector, the DGFT has now notified a 50% reduction in RoDTEP, or what is known as remission on duties and taxes for export products. Now, this is mainly like a rebate they used to get so that they can be competitive in the global export markets. And these rates, now they said that what benefit they were getting because of this, the remission or the rebate, that would be cut by 50%. Now, analysts say that DGFT reduction for RoDTEP normally follows a reduction that one sees in rebate of state and central taxes and levies as well. As of now, that is not yet announced. So now, as of now, companies which will see an impact will be the ones which were getting the benefit of this RoDTEP. So yarn and fabric exporters. that market is very competitive globally, and the prices also are highly competitive there. It's very price sensitive market. So any of these players would see an impact. That's why I look at Vardhaman Textile. That's down almost 2%. And during intraday trade, it was down almost 5% as well. We have Arvind Limited, that is also under pressure because they have yarn and fabric exposure in the export market. So they are seeing some bit of an impact. Nitin Spinners, that's another one that is seeing an impact as well. Elara is highlighting that the possible potential impact on earnings for Vardhaman and Arvind Limited would be in the range of 4 to 6% on FY26 as well as FY28 estimates is what they're looking at as of now. Apart from that, Gokuldas Exports, they benefit more from the rebate that comes in from the central and tax levies, that's a ROSCETL, where as of now there's no cut made. So there's not much of an impact that one is seeing on Gokuldas Exports because of ROTAP, but sentimentally it's still weak because there's a possibility that this could come in as well. As of now, clear impact on Vardhaman Textiles, Arvind Limited as well as Nitin Spinners.
Thank you very much for that. Get into a break. On the other side, we'll get you more on the markets, what's happening with the sell-off and global opinion also.
Still below last Thursday's low on the index, still at 25,366 is where we stand. So still hovering around those levels. So maybe, just maybe, the last hour of trade, the bulls would be looking to sustain or survive or defend those levels, at least 25,400, if not 25,500. The biggest culprit of the Nifty fall today, barring IT, has been L&T. And the stock is now at the lowest point of the day, 4% lower on that stock as well. Now, not to forget that L&T is, of course, the promoter of two listed IT firms as well, be it LTIMindtree and L&T Technology Services, both of them facing selling pressure in today's trading session, and as a result of which has had a bit of a cascading impact on L&T as well. So 4% lower on L&T. The others, of course, there has been a minor recovery, if you could call it that, in IT names, so minor. But other than that, it's very difficult to go beyond the IT names, because the top 10 losers, most of them are those. But Eternal, of course, is at the lowest point of the day now, 6% lower on Eternal. Navin Fluorine, of course, there was a negative brokerage note that came in this morning from Morgan Stanley that warned of earnings risks to both Navin Fluorine and SRF, and this is what has resulted in the fall, 5.5% lower on Navin Fluorine today. And Prestige Estates, of course, among the losers as well, 5% lower on that stock. But beyond that, and the list, the one name that has sprung up on the list of losers right now is Hyundai Motor, the biggest IPO of the country, at 5.5% lower there as well. So not good going for a lot of these names. And Yatra Online, we mentioned this in trading hour, that stock is down 15% now as we speak. And Car Trade Tech has also extended its losses, 9.5% lower now on Car Trade Tech, Rima.
Let me find some oasis in this, this bloodbath that's taking place. Utkarsh SFB is up 8%. You've got many banks, Karur Vysya Bank, Bandhan Bank, J&K Bank, Bank of Maharashtra, Central Bank of India, Union Bank. These are all banks which are up, 2.5, going up to a 3% kind of an up move. Karur Vysya, Bandhan Bank, J&K, Bank of Maharashtra, Central Bank, Union Bank. So that's one pocket which is at least broadly resilient. And not to forget, it's also the Nifty monthly expiry, right? That also generally tends to add to the volatility. And just to give, the sentiment in the market, Bharti Airtel, now they've committed 20,000 crore for the NBFC push and foray and expansion, out of which only 14,000 crore will come from Bharti Airtel, and 14,000 crore is not large for a company like Bharti Airtel. But the market capitalization reduction, I think at the low, was close to about 40,000 crore rupees, right? So it double of what the company is planning to commit. That indicates the sentiment in the market.
As the sentiments are as paramount, as they say, and that's showing up on a lot of these stock prices today, and even a lot of these names, be it Ixigo, be it Affle, be it Signity Tech, Mass Tech, all of them seeing losses of anywhere between 6 to 7% in today's trading session. We take your leave on this edition of Midcap Radar. Rima and I say thank you for watching. MF Corner on the other side, we leave you with the index looking to fight from the lows of the day.
Hello, good afternoon. You've tuned into MF Corner on CNBC TV 18. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. Today, what we're going to be focusing on is going to be all your stock-related, I beg your pardon, all your mutual fund-related queries that you all have sent us. So, we're going to be answering them. And to answer all of that, we do have Saloni Sanghvi, who is the founder at My Wealth Guide, joining us right now to answer those mutual fund queries. A lot of things that are happening in the mutual fund industries, whether you all should look at maybe your sectoral fund, what should you all watch out in terms of that? You all have sent us all those queries. And to answer that, Saloni is here. Saloni, good afternoon. Thank you so much for joining us on the show. Let's get started with the first query for today. The first one is coming from Nitin Arora. And he is writing to us from New Delhi. He's a regular mutual fund investor. And he has saying, and he's actually shifted from debt to equity mutual funds in the last year. He's saying that his overall investments are giving him 10% return so far, but he has two of these funds which he's holding. One is SBI MNC and SBI Consumption Fund, which are not performing well. So he wants to know, and he's asking if he should stay invested or maybe switch to some other sectoral fund, something that's focusing more on tourism, or even the next 50 index fund. Would that be the right strategy to go about by? Saloni, afternoon.
Thank you so much, Vinny, for having me on your show today. I'd like to say, first off, kudos to Nitin. He's been a disciplined investor for more than 2 days. I think that's a fantastic thing. The way I would look at the portfolio is through a core and satellite framework. Basically, divide your portfolio into two buckets. The first bucket is your core portfolio, which is 70 to 80% of your total portfolio. This is your main portfolio where you get your long-term compounding from and that you don't touch much. The composition, the exact composition would be determined by your asset allocation of debt, equity, and then equity further broken into large, mid, and small cap. The second component is the satellite component, which is a 20 to 30% of the portfolio. This is where you can take tactical exposure to sectors and themes that you can like. These are cyclical, so they should never dominate your entire equity exposure. And it's very critical to get the timing right on the way up and on the way down. I'd also like to highlight that, timing is not an exact rule. Markets can remain cheap or expensive for extended periods, and sector cycles are even harder to time. So the mistake that most investors make is taking tactical calls across the entire portfolio, which increases the risk, significantly. If you're deploying fresh capital today, from the options and some of the themes that you've mentioned, I would recommend looking at Nifty Next 50 versus specific themes, because themes and sectors tend to move in sharp bursts. So if you enter late into the cycle, then your returns can be substantially lower or even negative at times. If you're increasing exposure to these themes, then again, I would recommend doing it within the satellite bucket rather than, rotating your entire portfolio.
Okay. So, satellite portfolio where you should look at instead of themes, because they are cyclical, you may see bursts of returns coming in there. If you enter at the wrong time, that would be a concern, is what Saloni is highlighting. So if you're looking at anything, then next 50 index is a better option, is what is highlighted. Let's move on then to the next query, Saloni. We have Gaurang Madani, who's writing to us from Mumbai. He says that he wants to start with 500 rupees SIP against his home loan, which is of around 40 lakh rupees. So he's asking which funds maybe is something that he could start investing in, maybe because there's a specific purpose that he has, Saloni.
Right. So if I understand the question correctly, I think the question is about whether he should even begin, whether he should even start investing when there is an ongoing EMI already that's there. A lot of investors wait to become debt-free before they start investing, but then that delay comes at the cost of compounding. So I think it's a very good idea to start the SIP, while having a loan. It helps to diversify your assets. So say if you're looking at 500 rupees a month and a 12% return, in 5 years, that would grow to around approximately 40,000. And in 10 years, it would be around 1.2 lakhs. So this corpus can help prepay the loan or offset the interest cost depending on what the rate cycle is. I think the important thing here would be if you can increase your SIP annually then your corpus would actually increase meaningfully. So the key here is to start early versus starting big, because time is the most powerful variable in compounding. I think since you're initially starting, you can look at an index fund like Nifty 50 or Nifty 100 to begin your journey.
Okay. Saloni, what if maybe an individual or an investor, they have a loan and they are starting the SIP journey as of now, right? A home loan or something on that sort. They want to maybe leverage the SIP or the markets to start repaying that. Then what should they look at? Is SIP an option, or should then the strategy be more lump sum?
So I think it would match the income that the person gets. Usually in most cases, because there is a salary income, it's easier to do an SIP versus a lump sum that happens. The lump sum essentially comes when there is a bonus or there is a one-time payout. So what I would recommend is matching your timing in terms of when your income comes to your investments.
Okay. Okay, thanks for that, Saloni. Let's move on then to the next query. We have Abhijit Jain, who's writing to us from Pune. He says that given the investing in most international mutual funds had stopped, how should he look at international exposure? Some of them have restarted again as well, Saloni. Could you help them in diversifying in the international market through mutual funds? How should that journey be?
Right. So international exposure is very important because, we don't have exposure to many sectors, especially global sectors in India via publicly listed companies. Currency movement also plays a role in the return. So, if rupee is depreciating, that will enhance your returns, and appreciating rupee would reduce them. So I think ideally around 10 to 20% of your portfolio, of your equity allocation can be in international funds. While RBI limits have restricted flows into many international feeder funds, exposure is still possible. There are a few domestic funds that hold international stocks in your portfolio, giving you indirect exposure. There are certain feeder funds as well, but unfortunately in that case, they keep opening and closing for depending on the limits that they've hit. So that may not necessarily be a very long-term option in that sense. Besides that, there are actually three routes that people can look at to get international exposure. One is ETFs listed in India. They're easy to buy on the exchange like any other stock, but sometimes they trade at a premium, and the options available are also very limited. The other option is looking at Gift City. There are multiple platforms, AMCs, and funds that are available on that. But it's again relatively new and still evolving. And the last option is direct investing, via US brokers. You get full global access with direct ownership. But it's important to remember US estate taxes will impact any investment that's more than $60,000. Now for Gift City and directly investing, you have to remit funds via LRS. So that process can be a little complicated. And TCS is also applicable on that. So it's very important to be aware of that. Also, when you file your taxes, you need to include that information on your tax returns. A lot of people tend to forget doing that.
Okay, important updates there, though. Normally, international mutual funds, what you invest through, but sometimes, if they reach the limit, then you stop. But Saloni has highlighted three options for us. Gift City, obviously, there are conditions that apply as well. A tax that is applicable, so keep aware and keep, your facts in check when you are investing here. As well as direct investing via US brokers is there. But again, in the US market, also something that you would look out for, as well as ETFs is something that you could look at in terms of listed side as well in India. Next query, we have Sajid, who's writing to us from New Delhi. He says that he's looking to make a lump sum investment for 6 months and asking if mutual funds are good options.
So I think when you invest, it's important to always match the investment product to the time horizon that you have. If you need funds in 6 months, then equity mutual funds would not be a suitable option. Equity is suitable only when your investment horizon is 5 years or more, because time reduces volatility. For such short durations, liquidity and safety of capital are needed. Debt fits the bill. So here you have two options, of course, where you have FDs and debt mutual funds. I would recommend debt mutual funds because, given the current interest rate environment, they may give marginally higher yields. In case if you're in a higher tax bracket, then arbitrage funds could also be a good option. Arbitrage funds are taxed at equity taxation, so that's 20% for less than 1 year and 12.5% over periods of 1 year. One important thing to note here is that debt mutual funds or arbitrage funds don't offer guaranteed returns and have slightly higher risk than an FD. So if I were to summarize, if you want absolute certainty of return, then FD could be an option. If you want a slightly better yield potential, then debt mutual funds like liquid or money market funds are a good option. If you're in a higher tax bracket, then arbitrage funds would be a great option. The idea is in the short term, the focus should be on protecting the capital rather than earning the highest return.
Okay. On that note, we're going to actually slip into a very short break, Saloni. Stay with us. Viewers, do stay with us as well, because we'll come back with more of your mutual fund related query after the break. Welcome back to Mutual Fund Corner on CNBC TV 18. We still have with us Saloni Sanghavi, who's the founder at My Wealth Guide, to answer all those mutual fund queries this afternoon. Saloni, we have the next query that is coming from Jagdishwar, who's writing to us from Hyderabad. He's asking if index funds is a suitable bet for a medium-term investment for a senior citizen.
So I think in this case, it would be very important first to define what is medium term. As I said, for equity to reduce volatility meaningfully, it has to be at least 5 years. So without knowing the exact risk profile and time horizon, I think a simple framework that we can look at For the equity component of the portfolio, I would look at maybe a 75% in a large cap index like Nifty 100 and 25% in a mid cap index like Nifty mid cap 150. This would give a good balance of stability and growth. In case the horizon is less than 5 years, then the equity allocation needs to be moderated substantially. So let's say if the time horizon is 3 to 5 years, then I would recommend looking at equity savings funds, which dynamically manage the equity component with a high allocation to debt and arbitrage. So effectively, they have around 20 to 40% of unhedged equity exposure, with the balance being in arbitrage and debt. So this reduces volatility substantially, but also gives you the benefit of equity taxation.
Okay, surely interesting there. Let's move on then to the next query. We have Rupesh Patel, who's writing to us from Ahmedabad. He says that he has invested through SIPs in more than 30 mutual funds in various categories: mid cap, small cap, large cap, flexi cap, gold, silver kind of ETF funds and funds as well. He wants to know the ideal mutual fund in his portfolio and is asking how often does he need to rebalance his portfolio. Seems like a bit of over diversification here, Saloni.
You're completely right. While diversification is important, holding 30 mutual funds is not diversification. It's actually replication because you've effectively bought the whole market multiple times. 90% of the returns actually come from asset allocation. Only 5% come from product selection and from timing. Yes, most investors tend to spend maximum time picking funds rather than looking at the overall asset allocation. I believe that there should be a maximum of 3 to 6 equity funds in any portfolio. So maybe 1 or 2 flexi cap or index funds, 1 mid cap fund, maybe 1 or 2 small cap funds in case they need that allocation, and 1 maybe in international. You can also add gold and debt allocation to that. Now, the allocation amongst each category again would depend on how comfortable you are with risk, or whether you're more aggressive or conservative as an investor, and how long you want to hold the investment. What I would recommend in your case is first to categorize all the funds in the different categories that they're in, identify the overlaps between funds within each category, and then consolidate those gradually. So the idea is to exit underperformers and over time, and then consolidate into 4 to 6 funds totally.
Okay. Thanks for that, Saloni. Clearly, over-diversification is not the way to move forward. Saloni has given you the strategy that you should move around as well with. Next query, we have Usha Silvaraj, who's writing to us from Pune. She says that she wants to invest an amount of 5,000 to 10,000 rupees monthly, and adds that she can increase her investments every year for 5 to 10 years. She says her goal is to accumulate a good corpus for her daughter's further studies. Clearly, there is a goal for this. So, Saloni, how should she go about it? What sort of funds maybe she can look at to start with this goal journey?
So let's look at the numbers. If you invest 10,000 per month, in 5 years, assuming a 12% return, she'll have approximately 8 lakhs. And that would be around 22 to 23 lakhs in a 10-year period. If the SIP is lower, then obviously the amount would be lower than that. I think the first step would be not choosing funds, but determining what is the corpus needed for your daughter's education. For example, if the goal required is 25 lakhs, then we will reverse calculate and then accordingly adjust the SIP required. I would look at investing in an index or flexi cap fund and then gradually move that to debt around 2 years before the goal, before the money is actually needed. Also, given that inflation in education is high, as you said, annual increments would be extremely important, and increasing the SIP will substantially increase the corpus.
Absolutely. So maybe can look at index and flexi cap funds to start off with. But first is the amount that you want to look at. And inflation, obviously, for education, inflation also is much higher. So that is the way maybe to go forward. Saloni, is that something of a possibility that one could look at children funds as well if they are so decided in terms of the goal then?
Children funds can also be a good option, but of course, versus other funds, there are certain restrictions in terms of when you can withdraw. Certain funds allow you to do it when the child is 18, and certain have a lock-in of certain years. I believe that when we look at flexi cap or index fund, it gives you a lot more flexibility and liquidity. So in case if you need to pull out money for any chance in case of an emergency or anything that happens, it will give you room to do that. Whereas in a children's fund, it would be locked in.
Okay. Thanks for that, Saloni. Next question for today we have is coming from Sriram, who's writing to us from Chennai. He is asking about multi-asset funds and multi-asset fund of funds. Which category provides a better diversification for the long-term, risk-adjusted returns? How should one be viewing both of these?
This is a great question because both categories actually aim to solve the same problem, which is diversification across asset classes. But structurally, they are very different. As per SEBI regulations, a multi-asset fund must invest a minimum of 10% in each or in at least 3 different assets. So this could be equity, debt, gold, can also include REITs, InvITs, or international exposure. Since these assets are negatively correlated, combining them reduces volatility. A multi-asset fund of fund invests in other mutual funds or ETFs rather than directly buying the stocks or securities. So you're indirectly holding multiple different schemes. Because you're holding multiple different schemes, you're paying the expense ratio of the fund of fund plus of the underlying funds. So your effective cost can actually be higher. Another point to note in a fund of fund is that they need to be held for 24 months before they qualify for long-term capital gains. Unlike equity-oriented multi-asset funds, which incur long-term capital gains only after 12 months. So that's another benefit that you get in a multi-asset fund. I would prefer to manage the asset allocation through separate funds, within different asset classes. But what happens in reality is not a lot of investors end up rebalancing when needed. So these multi-asset funds are suitable for investors who need asset diversification without constantly rebalancing it. And they work very well for moderate risk investors and those looking to invest for a 3 to 5 year time horizon. Fund of funds, I think, are only useful if you want international exposure, a specific strategy. Then maybe they could be a good option.
Okay. Saloni, just a quick one. We are absolutely out of time, but this is the last query. Sridhar is writing to us from Coimbatore. He's invested 86,000 rupees in HSBC multi-cap fund. Now the value is standing at 87,748 rupees. What should he do? Continue to hold this mutual fund?
So I assume that this investment was made a few years back, but in any equity fund, you should evaluate it over at least a 5-year period and not such a short period. Multi-cap funds give you good diversification because 25% has to be invested in large, mid, and small each. So they tend to do well when the markets rally beyond large cap. On the flip side, of course, because of the mid-cap and small-cap exposure, the volatility is much higher in this. And the other thing is that exposure cannot go below 25%, even if the segment's overvalued. So, if small case may be overheated or overvalued, you cannot reduce exposure below 25%.
Sure.
This is a great fund for people, again, who are not able to rebalance themselves and who don't really land up doing that. Otherwise, the asset allocation may not be suitable for all. So I think that needs to be determined first.
Okay. Saloni, thank you so much for joining us this afternoon, helping answer all those mutual fund related queries. And viewers, thank you so much for tuning in as always. But we are absolutely out of time on this edition of MF Corner. Thank you so much for tuning in. Up next, you have Closing Bell.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
It's a gap down start. At least for now, 110 points lower is what the implied open is currently suggesting.
US President Donald Trump has warned countries against backing away from recently negotiated trade deals.
Bigger overlay the markets are worried about is AI. And markets are continuing to punish companies that could be losers in the AI revolution. 1/3% lower on the Sensex and the Nifty respectively, around that, right? 25,600 on the Nifty.
There's going to be a 50% reduction in RoDTEP. That is, what is it? Remission of duties and taxes on exported products. So Bharti Airtel has said that they plan to, push forward with their NBFC plan.
They say it'll accelerate into job losses, etc. And they say that displaced workers shift into lower paid roles or reduce consumption.
The markets as of now, a bit of a dull day coming in here, down almost 0.9% in the trading session.
Yes, exports has been our most standout vertical over the last quarter.
The Nifty IT index is down 20% in the month of February, and February so far is turning out to be the worst month on record since the global financial crisis. The Nifty has now breached the 25,400 and inching lower.
Okay, well, I think 300-point cut on the Nifty. It's closing bell. That was the day so far. And I don't think there has been dramatic swings from the morning. It started low, it started weak, and then it only accelerated on the downside, so to speak. We are, of course, coming to you from the CNBC TV 18 Motilal Oswal studios. Last hour, trading action coming up on a, red day. I'm Prashant. With me, my colleague Nigel. Nigel, hi.
Well, I'm expecting a big swing in the final hour, Prashant. It's the monthly expiry, and we saw a bit of a demo in the last few minutes. I think around 30 minutes or so ago, we were around 80, 90 points lower from where we are as of now.
Yeah.
So I think the last hour is going to be full of volatility. Either we go back to the lows earlier, or we'll be 80, 90 points higher from here. So let's see how that goes. But I think we're bracing ourselves for an exciting 60 minutes.
Well, let's hope so, right? On the positive side, because I think you're already down 300. The only way to go, direction to go is maybe
hopefully,
up, right?
hopefully. We were down
Let's
400 a few minutes ago.
Yeah. Okay, well, let's just quickly tell you what's lined up here in the last 60 minutes of trade. So it's, of course, the monthly expiry, and it's red across the board. AI disruption fears assuming center stage once again. IT, of course, is the focal point as far as that sell-off is concerned. And we got Rima joining in with some more numbers, some more stats, and what's the market making of it, because it's like a moving target out there. In terms of textiles, it's a bit negative, and there is a notification basically which says 50% reduction in some RoDTEP tariff rates across some lines immediately, and that is the reason why Gokul Das, Arvind, Wellspun, etc. are reeling under some selling pressure. So that's the view, and that's where we are at. You know what we're going to do is just get you the F&O set up before we go any further. It's the monthly expiry, as Nigel said. So where do the numbers lie, and what's the positioning like? Nigel, take it away.
The rollovers are taking place both on the Nifty as well as in the Nifty Bank, and both of that is pretty much in line with what we have seen. So we'll keep that aside. The IT sector, now that's getting very, very interesting. The index itself is down more than 20% in this series, in this month itself. In February, the Nifty IT index is down close to around 25%. But I'll tell you what, it's getting a little bit very excessive on the downside. And I say that the open interest is up between 50, 60, 70, 80% as well. So we're seeing aggressive shorting on the index itself, with stocks down anything between 25 to around 35%. You'll require to see some kind of positive news flow that comes in there, or maybe excessive cash market buying to push the stocks further lower, because otherwise it's getting very, very excessive. When you see open interest swell up by around 50 to 90%, and you see an index, the headline index itself down by 20%, I think something's got to give on this one. Let's see how that goes. The PCR, that's come down to around 0.81, but that's getting to expiry, so we'll keep that aside. But now giving you the two strikes that are fairly active. 25,400 call. The premium is down by close to around, I think, 80-90% approximately. Start of today, it was more than 200 rupees. It's come down to around 33 rupees. Very, very important. And that's why, we went dancing away to around the 25,460 and we did a bit of a U-turn in the last few minutes. So that's the important mark to look at. On the downside, 25,350, the put as well is fairly active. The premium was around 20 rupees. That's come down to around 7 rupees. So, your important level to track on the downside, coinciding with the writing that was seen at around the 25,350 put, is ballpark today's low, which is 25,328. Very, very important. On the upside, 25,500, 25,460 is the important mark in terms of resistance. So I think we are in that range. If you see a break off either of those levels, you'll see a quick 50-80 points move just in the last 60 minutes. Just quickly to run you through a few stocks. Eternal, that stock is coming for fresh shorting. Polycab, beautiful move out there, big recovery. Talk about the markets being under some pressure. That's making a fresh 52-week high, and there's clearly a short squeeze that's coming out there. Remember, shorts were rolling over their positions. I think there is some long build-up, and we are seeing fresh buying on Chola investments as well. So brace yourselves. The final 60 minutes, I think it's going to be very, very interesting. Brace for an 80-point move from here in either which direction.
Well, it's pretty exhaustive, and that's the positioning as things are. So exciting next 60 minutes, as Nigel put it. Well, let's just quickly run you through what you should be doing in the last hour or so. Mitesh is with us with that advice. Mitesh, good afternoon. Good to have you here. 2 steps forward and 3 steps back, but in the range firmly. What's the sense, Mitesh, and what should one do?
Yeah. So, Prashant, I think, right, saying that, we have been going up and down, and I've been maintaining that we'll possibly just chop around between 25,400 to about 25,800. Now we are at the lower end of the range, which means that there's danger of breaking below that. If that happens, then I think, we might go around to about 25,100, maybe in the worst case scenario, 24,950, 900 zones. But I think, the overall trend on the medium charts is still not very clear. So my sense is that it could yet be a bearish push, but we might get, we might get support around this 24,950, 24,900 level. So I think that's the downside which traders can pencil in the negative case scenario. Of course, 25,400 still is not broken on a closing basis, but the way it's shaping up, and also given the fact that the Bank Nifty is slightly negative today, showing first signs of profit booking, you might see some deeper pullback. Having said that, I have one buy and one sell call right now. On the selling side, I have a position on, or I have a call on Hoodco, which I would recommend selling with a stop just above levels of 190 to 193 and a target of around 180 or just below that can be looked at. And on the buying side is your FMCG name, which is Marico. It was a call earlier as well, but even now is showing strength in a falling market. So Marico is a buy with a stop at 798 for targets of around 830.
Okay, got it. Mitesh, very quickly, wanted to get your view with regard to Polycab. I recall the promoter entity came and sold. You had fears that there's excessive competition. The stock actually has done very, very well. Levels you're looking at on that one?
Yeah. If you look at the chart of Polycab, this is one stock which has done well in this entire corrective market and has made a fresh swing high. The earlier highs were around levels of 7,800 to about 7,750. Now, getting past that typically means that one, that level becomes your key support area, so should not be broken. And two, I think that should give you fresh upsides. The extended targets over here come at levels of around 88 to 8,900 with a minor pivot at 8,500. So I think these are the two targets, but I suspect the stock has the strength to go to about 88, 8,900.
Okay, all right, got that. Thanks a lot for that, Mitesh. Let's focus, I think, on a couple of those, on the tech stocks, I think so. Rima has gone across to the big ball, and she's going to run us through what's going on today and why particularly these stocks have come in for a bit of a knock. Rima, take it away.
Thanks so much. For the Nifty IT index is now down more than 20% in the month of February, putting the index on track for its worst monthly fall since 2003, April of 2003. Year to date, heavyweights have taken a very sharp hit. TCS, Infosys down close to about 20-odd%, Wipro 24%, HCL Tech is down about 17%, Tech Mahindra is lower by 15%. Here you've got some valuation comfort. Look at mid-cap names, large mid-cap names like a Persistent, 26% down, LTM down 25%. And several names now are trading at their 52-week lows. Just putting out a few, but you've got a TCS, Infosys, Wipro, HCL, Hexaware, Cyan, Tata Tech, First Source. These are all companies which have hit fresh 52-week lows today. The narrative is the same. Will AI replace IT software and services companies? And yesterday, it was IBM, which saw its biggest single-day fall in the last 25 years, down 13%, as Claude released an update which can modernize COBOL. And Indian IT companies do play a role in terms of COBOL maintenance, application, and some modernization work. But, despite the sharp correction despite the sharp correction, IT valuations are at 16, 17 times more expensive than global peers like an Accenture and Cognizant. But the opinion that we're now getting is that the sell-off may be overdone. Let me take you through a global HSBC report. And they say that foundation AI models are not suited for lift and replacement of major software platforms. There are limited use cases of that where you can simply lift and replace it, like for an image creation program, for a small software app. But it is not realistic to expect it to do this at an enterprise level for enterprise software, which is far more complex. And therefore, they see actually software companies to be beneficiaries, because if enterprises need to unlock the full potential of AI, you will need these enterprise companies. There is Sandeep Agarwal of Suvilo, and we've been chatting with him for the last so many months with this derating in the Indian IT companies, and he's always been bearish. But today he said 70 to 80% of the pain may be behind us. We also chatted with Kawaljeet Saluja of Kotak Institutional Equities. His view is that the sell-off looks overdone. Markets are pricing in barely a 3% long-term growth to perpetuity for some of these large-cap IT companies. He believes there is value at the juncture. He said the risk right now is the timing gap, because at the moment what you are seeing is deflation fears, which is directly impacting revenues. But the future demand, the new opportunities due to AI are still yet to play out. So, Kawaljeet believes the problem is the timing gap. Back to you.
All right. Thanks a lot for that, Rima. Well, earlier on Finding Alpha, I caught up with Abhishek Bhandari of Nomura. He gave us his bull as well as his base case scenarios based on revenue growth. He also shared his top picks. Let's listen in.
If you look at the bear case, which is the topical theme in the market right now, the bear case is this company's business models becomes obsolete. They're not able to replace the deflation in revenue with a new stream of revenue on AI. And they struggle on growth. They may possibly have a negative growth, or in the best case, very early single-digit 2 to 3% growth. They keep margins stable, by optimizing on the workforce. You work in a scenario where the EPS growth becomes zero or close to, -1, -2%. Now, those kind of companies, X growth, in our view, could trade at 10 to 12 times. Okay. So that's the extreme bear, assuming these business models will become extreme. The base case is, the IT companies, I would say, adapt themselves, which they have done in the past tech cycles. Right now, we are going through the valley, as I call it, where the deflation of revenue is hitting first. The ascent into the mountain, which is the AI-led revenue, is taking longer than expected. But it will come. Ultimately, the AI models have to get monetized. If somebody has to monetize the model, somebody has to implement the model. And the implementers are nothing but the system integrators, which are the IT services companies. In that case, I think the growth will come back towards mid to high single digit in the range of 5 to 7, 5 to 8%. The bull case, is the IT companies pivot completely from just being, service providers to become value creators. What I mean by that is, the service model changes from labor, intensive work towards more like a platform, yes, where the company starts selling services as a software. This is, I would say, a low probability event right now because we don't see too much of evidence of it right now. But if this were to turn out to be true, you could see a lot of non-linearity in revenue and the margins, and the multiples, in that case, could range even up to 30 times, for the good large cap IT companies. I think in the large caps, we like Infosys and Cognizant the most. We think they will continue to gain market share. They'll grow at a rate which will be higher than the peer average. Okay. In the mid cap, Coforge is the preferred pick. We think the company's ability to deliver mid-teens growth exists, and some of the large recent acquisitions will help it become bigger in size and get access to more number of clients, the relevant ones. On the small cap, we like eClerx the most. It's a BPO company, but I would just like to clarify here the perception that BPO companies will all get disrupted, which is true partly on the BPO, voice side. The voice component for e-clerks is quite low, is below 10%. So I think they will be a beneficiary on the platform side of the BPO, and we see them sustaining close to 15% revenue growth in the medium to long term.
Interesting one. Top picks, Infosys, Coforge, as well as e-clerks, and giving us various scenarios in terms of growth and what multiple they should get. Dharmesh Kant, Head of Research, Chola Security, joins us. Dharmesh, what do? You wake up every morning, bad news for tech, and the stocks get slammed. I don't know whether, you could give us your view, actually. Is it time to actually sell some of these stocks, try to prevent further losses, or do you think it's got too exaggerated on the downside? Time to actually dip in. Your take?
Yeah, Dr. Nigel, thanks for having me for the show. I mean, the tech space, barring tactical plays in between. So the view remains the same. I mean, most of the people now are pricing in technology stocks based on terminal growth rate. So 3 to 5% if you're assuming a growth rate going forward. So that's basically you are trying to arrive at an intrinsic value based on the current balance sheet and the size of cash which is sitting on the balance sheet and terminal growth rate. So to my mind is that next 2-3 quarters will definitely be good because the committed business will flow in. But 27, 28 onwards, you will see this difficulty of deflation and lesser operating margins, depletion in the operating margins playing out because value addition, value creation for the services being offered will be done by AI, and we will be more of a system integrator kind of a play. So that is the challenge which IT companies are facing. If there is any tactical bounces, the idea is to sell off, barring we are bullish on one stock, that is Orient Pro Solutions Limited, for IT for quite some time.
Okay, I think you just mentioned that you like Orient Pro Solutions. Okay, all right. And from the frontline names, we didn't get, if you like any of them, Infosys, there's a valuation gap out there. As you said, there'll be various needs of Indian tech companies, even in the post-AI world. In case we missed a name, or you just like Orient Pro itself?
So again, we are only liking Orient Pro Solutions, so that being a product company, it's an individual stock picking bottoms-up approach. Otherwise, largely, be it Infosys, TCS, or any actual tech, things will be difficult for them going forward. I'm again saying next 2 quarters will be better for them because of the committed business which is already there in place. But going forward, the traction will shift to low single digit kind of a growth, maybe 2% or 1%. And that too helped by currency depreciation is again relative from you're valuing what and for what the valuation is there, what kind of a growth rate we are talking about. Historical is history, that's the resetting has happened. And Raja, I will give you one more perspective. FY19, Nifty 50, the IT company's total PAT was around 70,000 odd crores. FY25, these Nifty 50 components of IT companies delivered a PAT of 110,000 odd crores. So the weightage reduced from 21-22% to 12% as we speak. So that's being reflected. Anthropic came now, but last 4 years they have been struggling to come to a growth term. So that's caused a challenge with IT companies. And I think I'm afraid we are late in addressing the challenges.
There is this audio issue which is coming back. Dharmesh, we'll just try and fix it, right? And come back to you. But just want to play out this exclusive chat we had with Rajiv Bajaj, Managing Director of Bajaj Auto, one of the most well-spoken CEOs, and just sort of explaining very simply what he expects exports at Bajaj to really be at. And there is a little bit of conversation around the electric two-wheeler production numbers as well. Listen in, and we'll come back with Dharmesh.
Exports has been our most standout vertical over the last quarter. As you mentioned, after a long time, we crossed an average of 200,000 vehicles per month. Biggest market, Nigeria, that used to average at its best 60,000 a month, had gone to zero. And now back to 30,000 a month consistently, and I believe looking at 35,000, 40,000 a month in the near future. doing very well. This month, despite a shorter month in that sense, this quarter we will still finish at 600,000. Having done 215,000 in Jan, we are set to repeat that number this month, and then the balance will come in March. But from first quarter of next year, we should certainly be doing better. I am hopeful that with the spillover from March into April, we should be edging towards 250,000 in April. We have now stabilized at about 30,000 vehicles a month. Having overcome the supply chain issues and other operating issues, and our capacity will be up to 40,000 across the supply chain from April. So that's what we've set our eyes on as the next target.
Okay, we're trying to fix that, as Rajiv Bajaj, trying to fix that audio issue with Dharmesh Kant. We'll try and do that in just a bit. Mitesh is with us still. Mitesh, the number one volume-led loser is Eternal, is down 15 bucks. 250, 253. Any thoughts on this one?
Eternal, it's been a stock which is corrected along with Swiggy. And the last time the stock corrected, we had a closing low of around 254. It's right there actually. It's also a weekly pivot. And if we start breaking below that, I think this correction could even extend about levels of 235, 236.
Any thoughts on InfoEdge, Naukri? One way kind of fall, right? I mean, from 1,400 about a month ago to 1,000 bucks.
That's right. In fact, Naukri had very strong support around this 1250 mark. And if you look at the last 6 months of data, I think about 6 or 7 times this 1250, 1270 range came into play, and now it's broken. It's done the target which I was looking at, which is around 1050, but the next support pivot, if I can mark it on the chart, is around 980. So maybe some more decline still left. It's extremely oversold, so around 980 I would expect that some kind of corrective, movement could happen. Corrective pullback could happen on the upside.
All right, one more quick query with regard to HUDCO. You had a sell call out there, but that is only for today because it moves out of the F&O from effective today itself. So you're seeing weakness on that counter, right?
Correct.
Yeah. I'm just looking at some of these rates, right? I mean, this is eye-watering. Look at car trade. Car trade, if you can pull it up, was 3,300. Maybe just put all these charts up for the year, say over the last 1 year. High was 3,300, and it's basically fallen 40%, right? So 1,800 rupees now on car trade, looking like strong momentum names and looked like a one-way kind of price action. Look at something like a Ixigo. Ixigo was 340 bucks. It's halved, 160 rupees now. So this is like, just incredible amount of damage across the board. And some of these, of course, I mean, things like Ixigo, again, the fear is that all this AI-related development will eat in, and started in the US and Make My Trip, etc. Saw similar corrections. It's, of course, shown up here in a big way as well. Mitesh, thank you very much. We'll come back to you with more questions in a bit. Dharmesh is with us. Dharmesh, sorry, you just finish what you were saying because the line was a little bad, but I think now we got you on a solid one. Just finish that last point you were making.
Yeah, Prashant. Good afternoon. So we were talking about the technology stocks and what is the difficulty I find out there. So the last point which I was making was Anthropic came now, but if you look at the Nifty 50 constituents of IT stocks, in FY19 the total aggregate earnings was 70,000 odd crores. FY25 it ended with 110,000 odd crores of net profits. So the weightage came down from 21% in the Nifty 50 basket to 12%. So there was a problem already there. They were struggling with the growth momentum. Narratives kept on changing. First it was interest rate cut, then the discretionary spend, and the pickup in new software which they were developing for the AIs. But now I think it's a bigger challenge for them because they will now be just a system integrator, and the value addition part will evaporate, and that will lead to bleeding in the margins. So what we are valuing IT companies now is on the basis of terminal growth rate, and if that is what you are paying for, then I think further downside is there for the IT companies. Next 2-3 quarters may still be good because of the committed business which will play out, but the real challenge and problem will start from FY28 onwards.
Okay, all right. Dharmesh, Thanks a lot for joining in, Dharmesh, giving us your view.
Nigel, one more question. Dharmesh, just, this, I was talking about Ixigo, right? Things like, again, it's not IT services, but these are platforms where, the first leg of sell-off started in the US because, people hypothesize that maybe Google, you'll be able to, you want to book a hotel, Google will help you with that. So, and that's the first leg of the correction. Now, of course, you've got these agentic applications, etc., which are the pain point here. Look at something like a physics wala is the other one, which is of course a recent listing, completely bombed out now. Again, here, incredible amount of advances. You're talking about. I was looking at a blog. I think it was Anthropic, or I think one of the Google Gemini. It was talking about the full IIT JEE examination papers, corrections, everything available for free on Google Gemini. And of course, there's of course the course, etc., which is also anyway there. So I'm not sure. Any thoughts, Dharmesh? Have you thought about these areas? This is not IT software, but these are all AI casualties in that sense.
Yeah, Prashant. The disruption is very disruptive and very fast. So what used to happen earlier was if you're an early bird with a new technology or a platform or an application, and there was challenges because other people could not develop them. Copying the same platform application technology would take time, and that is why we gave humongous valuation to all this new age kind of a company, the so-called new age companies. What has happened now in the disruption which I see playing out will be this agentic AI will make it very cheap, and as you are saying, maybe a free evaluation of everything. Then what's the difference? Why will someone pay for services which is available at free and are much faster and a better pace? So this disruption.
But let me Dharmesh, let me allow a counterpoint, right? Say you want to order food, right? Eternal is also selling off because of these fears. Now you can use agentic AI and you tell it that, okay, I want to order this food. It'll search across platforms, look for the best price and tell you. But the point is, it's got to connect the last mile, right? It has to tie up with restaurants. There has to be a rider which will get the food to you. Creating the app is not the moat here, I'm assuming. It is essentially managing the entire back end of it, which is the real trick, which is where companies like Zomato, Eternal have excelled. So is it so easy to replace all this?
No, Prashant, it's not easy to replace that. You will need people to do the groundwork, and the ground job has to be done. The endpoint delivery, the human part of the work will always be there. But what it will eat out is the margins which you used to take for being only few players in the market who are doing the same kind of a delivery. So, if you are giving, say, a payout to a gig worker, and this payout can go for a disruption and for a competition out there, huge amount of money is chasing the entire market. So, and they're already working at wafer thin margin, 2%, 1% kind of a margin is there. So any hopes of getting to 4.5% to 5% is being ruled out. Now you have to contend with 2 and 2.5% kind of a margin. So we are seeing the competition in the kind of equity inflows is there. So the limited point is, human work will still be there where you need a last mile connect. But the margins, because of the technological advantage which you are having, will go out of the window. That won't be there. In fact, it will become more cheaper and more competitive.
Okay, great. Dharmesh, thanks a lot for joining in and giving us your take on the markets and a couple of those stocks as well. By the way, Centum Electronics, they're bagged an order from HAL. The stock up closer around 4% as we speak. I think the last 6 to 8 months, the stock has moved very swiftly from 1,500 to around these levels of around 2,500. It saw a sharp correction and now it's pulling back. So keep an eye out on that particular name. A quick word on the metal index. It's not the heavy lifting index, but the metal index has now moved to the high point of the day. And I tell you what, ferrous, actually this quarter could look quite good because of the price increase that have come about. China is producing less. And in all, you're seeing some operating leverage as well playing out. So that's the index to track. Slip into a short break, come back. Pashupati Advani will be joining in of Global Foray. Stay tuned. Well, markets doing a thing of their own. We're 100 points off the lows of the day, which is good. And we're getting into final expiry hour. So let's see how that goes. NTPC is the stock that spiked up from the frontline names. Pull up the individual chart. Some of these stocks will start moving as the rolls take place right now. NTPC, boom. But Hormuz is the guy. He puts the spotlight on all the big movers. Hormuz, tell us today it's an exciting bunch, I believe.
Indeed, and that's what the kind of market has thrown up, right? And beyond all the IT names that we've been talking about, the one name that has taken a bit of a backseat is L&T Tech, LTTS. That is among the worst performers on the IT sell-off today. 8.5% lower on the stock now, the biggest single-day fall since March of 2020. And this is turning out to be the second straight month that the stock has had double-digit losses. The last time something like this happened was way back in 2022. Now, today's session, over 4 lakh shares have been traded. The 20-day average is around 80,000 shares. And out of these 4 lakh shares that have been traded, close to 60% have been marked for delivery, at least as of now, is what the data on the NSE is showing up. And L&T, being the promoter of the company, that the sell-off that you're seeing since the start of the year, the stock is down almost 30%, as a result of which the value of L&T stake has declined by over 12,000 crore rupees so far. Now, Eternal is the other one, is among the top losers on the Nifty today. The sixth straight day of losses for the stock, 5% lower here today. The market cap has now slipped below the 2.5 lakh crore rupee mark. And in the last 10 trading sessions, the stock has gained only once, sometime in between last week. And since then, it's been on a losing spree. The stock is among the most traded today on the Nifty 500. 6.5 crore shares have been traded today on Eternal, the 20-day average being around 3.6 crore shares. And even here, close to 60% of those shares are marked for delivery. And even on the F&O side, the premium on the 260 put option has gone up by almost 87%. That's for the March series is what I'm talking about. That's gone up by almost 87% in today's trade. The HAL, we were talking about this in Bazaar this morning, that holding 4,000 is very crucial for HAL. It's now below those levels for the first time since April of last year. It's the second straight day of losses, but mind you, today's fall is on volumes that are less than half of the volumes that were seen yesterday. Now, yesterday's session, we saw close to 40 lakh shares being traded. Today's volumes are even lower than the 20-day averages. 13.5 lakh shares have been traded so far on HAL. The 20-day average is 20 lakh shares. So, fall on insignificant volumes, and even these insignificant volumes, around half of those are marked for delivery. And here too, the premium on the 4,000 put option is up around 20% for the March series. And among these sea of red, there is one name that has done well through the session, and that is Vishal Megamart, which is doing well. It's the second straight day of gains for the stock, still holding on to a 3% advance. The volumes are at the highest in the last 1 month. Close to 2 crore shares have been traded today on Vishal Megamart. 63 lakh shares is the 20-day average. So almost around about 3x the 20-day average on today's volumes. Close to 40% of these shares have been marked for delivery. The stock did well after its listing. The post-listing high is 157, which is exactly 100% from its IPO price of 78 rupees. But from those levels, the stock is down 21%, but one of the top among the outperformers in what has been an otherwise red screen.
All right. Thank you very much for that, Hormuz. So interesting set of stocks as always. Pashupati Advani is with us of Global Foray. Pashupati, good to have you with us here. Thanks for joining in. I don't know if you got a chance to listen into some of the early discussion which we were having with Dharmesh Kant. And I was asking about all these companies, not just IT software, but across the board, where there is these. I mean, it's almost markets in a bit of a deep anxiety, right? What all this is going to do. There's something like a physics fella selling off. There is a OTA platform like Ixigo, which is down sharply, it's halved basically from the highs. And so on and so forth. Eternal, for example, food delivery. Just your perspective. I think there's only one conversation to be had. Go on.
Well, I've been saying for the last God knows how long about what was happening in the IT stocks and the fact that we were not able to move our business models fast enough. So obviously those stocks are down a lot, and particularly since Anthropic dropped the bomb last weekend. About Claude being able to, you saw what happened with Anthropic and IBM. They just announced that they'll be able to redo COBOL, and IBM lost 33% and some $30 billion in one shot. So, I mean, those are scares, but these are the realities of what AI can do The question is how long it's going to take and who's going to actually do it. But the reality is it is capable of doing these things. And we are seeing the brunt of it because all our big IT names, whether it's TCS or Infosys or, HCL Tech, are all getting the brunt of it. They're all down. They've not yet found the solution, how to get back more business. And they've been skating, giving guidance, but the guidance seems to be not there. And certainly with the immigration policy in the US and also general cost cutting across the world and AI coming in, the combination is hurting them in all directions. So they have to be reevaluated. And they are a big part of our index, which is why they're also taking the index down with them. That being said, there are obviously things that we can look for, but I'm also not very wild about the banking sector, even though the banking sector seems to have held up, because it's my belief that a lot of people in the IT sector have taken, white good loans and housing loans, and once they start losing their jobs, that's going to have a trickle effect into the banks. So I think it's only a matter of time before banks will also start following suit, and that's gradually pulling our market down. On the plus side, the IPOs seem to have cooled down a little bit because obviously there's not that much demand, and that's good for the market because it means less money is going out of the market into IPOs. Yes, Prashant.
Pashupati, just to get it correct, you're not interested in tech or even the banking names as of now, right? I mean, you don't like the top two opening batsmen. You'd rather go somewhere down the order.
Yep. So I think in that space, that obviously the government is continuing to spend. So metal, cement, those sectors are still coming in. Defense, obviously, they are spending some money there. So those stocks. But then again, you don't know where they're going to give the orders next. Today it's Centum Electronics. So tomorrow it'll be something else. So to be able to pick those is the key. But the defense sector is getting some business, particularly since we are committed to buying weapons from all over the place and tie-ups for those weapons, and some sort of trying to have exports basically also based on those defense. There's some word for it which escapes me. They've got to give some export commitment against the technology. So all that is happening, but you have Mr. Trump on the TV right now in the other box. So I think he's the one who's moving the world, and he's moving us with him.
Where is he now?
He's sleeping.
Well, he should be asleep.
He's snoozing, I think. So there must be a recording. Let him rest, Pashupati. He requires some rest, No tweeting and too much of action from him is okay.
6:30 a.m. on Truth Social. That's where you'll see him. 6:30 a.m. Eastern.
As someone said, that he's built different. Doesn't require very much sleep or food or, so anyway.
I think he's enjoying himself. He is enjoying himself. He is having a ball. Okay, there's no question about it.
I don't know anymore. Approval ratings of 32%, midterms coming, bit of political backlash from Republicans. So he was enjoying last year. Now I'm not so sure. But that point that you said, the dominant driver, Pashupati, is it? I don't think Trump and what he's doing is the dominant driver anymore for financial markets. It's this AI-related anxiety, isn't it?
No, for sure. I mean, AI-related anxiety is driving it. But I mean, again, even on the other side, which is textile exports, stuff that we've been sending into the US. The only thing that is up this year in terms of exports is cell phones, and Apple, I guess, has been a big part of that. But how much of that is real export, and how much of that is just assembly and a little bit of a little bit of value add is good, but it's a huge number. I thought I saw a number which was like 23 billion or something of exports of phones this year. So that's a lot.
Pashupati, just two ideas before you go. Two nice ideas. Yeah. Two stocks that you have recently bought and you believe they're good for more. Please go ahead.
You're really putting me on the spot here because...
One, Pashupati, go for it.
So, no, honestly, I'm actually a little bit... I'm going to change the subject slightly and you can get angry with me for it. I've seen this new thing on the government trying to call back the gold bonds, because obviously they've become very expensive for them because they were issued when gold was at much lower levels, half of what it is now. So they're obviously hurting because they have to pay them back. So they're trying to call them earlier. And and one of the things, they've done some switching in the sense that if you bought in the secondary, you don't get the same tax treatment. Gold still seems to be chugging along upwards, but I think the tax treatment on gold in India is going to hurt people and maybe get some people to sell. So yes, I think I was fortunate enough to buy some gold stuff, some of the bonds particularly till they stopped issuing them. So I'm trying to figure out what's happening in that, because that's been announced, but there's nothing being talked about over there. And as to what's going to be the treatment for the bonds, except that they took away the tax holiday if you bought in the secondary market. So that's a bit of a challenge. Regarding other things, I mean, there will be a turnaround at some point, but I still feel that there is going to be consolidation in cement. There's going to be consolidation in metals, and I think those are where the places to be, and particularly the sort of different metals, not the steel, more like aluminum and maybe, I don't know which companies are in rare metals, but those are the ones also to be looked for and searched.
Yeah. Oh, all right. Thanks very much, Pashupati, for that. Appreciate your time here. Have a good one, and talk to you soon again. Well, I think we'll talk about chatter, right? What's on the chatter list? Let's get an overview first. Nimish is here with what he's picking up. Nimish, take it away.
Hi, Prashant. Another down day and another very bad day for the IT names, right? The IT index is down another 5%, massive selling. My sense is there is a lot of institutional selling in the IT stocks, even in today's market. So the FI number may look large, but that's largely because of aggressive selling in the IT names. Now there are fears of the IT impact into other sectors as well. So consumption is down, the real estate sector is down. The last when I checked, the real estate index was down nearly 3%. So it's not only left to IT now, but spreading to the fear is spreading to the other sectors as well. So that's a broad sense. As I said, the institutional number may look large, but that's largely because of a couple of sectors, including IT and the platform businesses in today's market. So we've broken some crucial technical levels as well. Need to see. We've seen a small pullback in the last 30 minutes of trade, but could be just a tactical pullback. But broadly, the sense is the sentiment is very weak now, and especially for IT names, it's largely a sell from large institutions across the board, whether it's domestic or the FIs.
Yeah. What are the stocks, Nimesh, on the list today?
Well, a couple of interesting names, Prashant. So the first stock is Blue Jet Healthcare. The stock is buzzing in the last couple of days. Yesterday, the stock was 10% higher. Today, the stock is up 5%. But having said that, the stock has actually fallen almost 60-70% from the recent peak. If I'm not wrong, the QIP was done by this company at 900 rupees, and the stock had fallen to almost 320, 330 level. So, been a big damage there. But in the last couple of days, I understand at least one large AIF has been a buyer, and that's why there is delivery-based buying happening, and the stock is buzzing in a weak market. So that's the first stock. The second name is Rallis India. Again, it's been this quarter numbers were good, but the stock has actually come off from those highs under pressure of late, largely on the back of overall selling in the broader markets. But the street is anticipating some corporate development in Rallis very soon. Remember, it's a Tata Group company, and Tata Chemical, the listed entity, owns close to 55% stake in Rallis India. The third name is E2E Networks. Again, an extremely volatile stock. We've seen 20% up one day, then 10% down the second day. And I believe the management was in town in the last couple of days, and there could be a QIP in E2E Networks very soon. A small QIP, close to 400-500 crore is what my sense is they're going to raise in this QIP. And the last is Urban Company. Again, under pressure, part of this whole IPO stock which are under pressure of late. But in Urban Company, my sense is there could be a large block deal very soon. A non-promoter entity is likely to sell, so it's not that the promoters are going to sell, but some larger funds are looking to sell a large chunk via block in Urban Company.
Right. Got it. Okay, all right.
Just one thing. UPL we discussed yesterday as well, right? Anything new, anything else? Big correction yesterday, down another 3% now. You were saying that perhaps we need to wait for the finer details, etc. But are you hearing I don't know, is there a rethink of sorts or on those lines, anything you're picking up?
Not sure. Not sure, Prashant. So, even if you hear the Kotak analyst yesterday at the conference, he was very clear. He's mentioned the note as well that there is a holding company discount now. That's a big fear. Now, whether they will reconsider that particular decision and give the shares of the demerged entity UPL SAS to the investors, that's something to be known. That's again a bit of speculation. But I guess what the street would be anticipating and watching out for very closely is the valuation reports across all the three businesses as to how they are valued at and what's the valuation that they're putting in that report. So that's something to watch out for. It's going to be officially announced in the next couple of days. That's something which they've disclosed in the press release as well. So in the next couple of days, you'll hear the valuations and all for all these companies in the official release. But beyond that, I guess the street is fearing that, while it's a good deal or whatever, there is a holding company discount in the very near term, and that's putting pressure on the stock.
Nimesh, any sector, theme, etc., which is hotly debated as an attractive area at that conference? The time that you've spent there?
Prashant, it's only IT which people are talking about. So IT and IT related sectors. So that's been a big pain point for all the investors, right? I mean, whether you're running a IT fund or a flexi cap fund, there is an IT exposure, platform business exposure for sure for all these investors, right? So it's been a pain point, and that's been the big talking point as well. In fact, I got a very interesting feedback at HCL Tech management at the quarter conference today. The first time they did mention that yes, we were behind the curve, we should have invested more in AI and other stuff. And now at least, there is a bit of recognition from the companies as well that yes, we have been slightly behind the curve, and maybe we'll have to up this ante in terms of investing in R&D and in AI as well.
Yeah. I think it was the HCL Tech management yesterday, because I think we had someone join us from there who said, who told us that he heard the HCL Tech management kind of sort of reflect that. No, absolutely. Thanks very much, Nimesh, for that. More later. So that is the D Street chatter today. We'll take a break. We're back with some short-term trading ideas with Mitesh on the other side. I think there is 15 minutes to go for market closing. Okay, welcome back. Well, we got Mitesh back with us with what he wanted to do in terms of short-term ideas. Mitesh, anything on your list?
One PTSD and one STBT, Prashant. IOC, I think, in a weak market is holding out very well. The pattern is good as well. So take a BTST here with a stop just around 178.75 and a target of 183 half for tomorrow can be looked at. While ICICI Bank, and within the banking space also, the private sector banks are slightly underperforming. So ICICI Bank is having a slight negative kind of a move on the hourly and 2-hourly chart. So estimating here, keep a stop at about 13.95. Look for targets of 13.70, 13.65.
Got it. Okay. All right. Thanks a lot for that, Mitesh. Well, IDFC First Bank has put on the exchanges that even though there is an investigation that's underway, they have paid 100% of the principal as well as interest to the Haryana government as of now. The 500 and I think 90 odd crores is what they're saying they're paid. And that's why the stock had a bit of a spurt from the day's low, where the Haryana minister that's saying first that all the money has come back. And that's because IDFC First Bank has made that good, though the investigation is underway. But let's focus back on tech, because that's the big burning question right nowadays. What to do with tech? Well, Yash is giving us another angle. He's breaking it down how IT rout is affecting FPIs, mutual funds, and insurance space. Yash, take it away.
Well, if you look at these three large categories of investors, FPIs, mutual funds, and insurance companies, just alone in about the Nifty IT constituents, these three categories of investors together have lost nearly about 2.5 lakh crore rupees. If you have to break it down in terms of individual categories, FPIs have lost more than 1.1 lakh crore rupees. The value of holding is down about 21% on a year-to-date basis. Mutual funds have lost over 74,000 crore rupees. The value of their holdings is down 21% again on a year-to-date basis. Insurance companies, they've been one of the large investors when it comes to IT stocks. They've lost more than 60,000 crore rupees, and their value of investments is down about 20% on a year-to-date basis. Now, important and an interesting figure, out of the total 60,000 crore rupees lost by all insurance companies put together in this big IT fall, LIC alone has lost about 42,500 crore rupees in the IT index constituents on a year-to-date basis.
Thanks a lot for that, Yash. Well, let's welcome Jay Bala, cmtcashkiosk.com. Jay, on the tech index, let's get it out of the way. How low can we go?
Hi, Nigel. I pointed out last week that if it were to break 30,900, it has bottomed all the way to 26,000. So there's no interim support beyond 30,900. So today's break below that, even if it's on intraday basis, that's not a good sign.
Okay, 26,000. So another, closer on 15% even from here is what we could drop, correct?
That's right, Nigel.
How much pressure is it going to put on the Nifty? Actually, the Nifty has been very resilient, Jay. Imagine a month where you have the tech index down close to 20% and the Nifty is still holding its ground. Pretty impressive, I would say. That's because the Nifty Bank Index has been doing that heavy lifting, and Reliance Industries as well. We saw in the last few minutes as well, that one has spiked up. Where is the Nifty headed? Go and test the recent low and then pop up?
That's right, Nigel. Nifty IT could be probably trying to play a spoil sport to a bullish view. Still, the markets are managing to hold above the critical 25,148 level that I pointed out, and but the price action isn't that encouraging. But let's see if Reliance and banking sector can outlast what the Nifty IT index is trying to do. Maybe some other sector needs to join these two. Probably Nifty Auto and Nifty Defense are on my watch. But if 25,148 were to get printed even on an intraday basis, I would go back to my earlier view that the markets are first heading to 24,000 and then coming back to 29,000. So the short term could get choppy if could get negative if 25,148 were to break. So long it's comfortably holding about it. There have been 4 sessions that's been supporting 25,300. So we'll watch 25,148 as a very critical support.
Got it. All right, Jay, I think we'll try to fix that line. We'll take a snappy break, come back, get your views on the other indices as well as individual stocks. Stay tuned.
Expiry is playing out, but keep an eye out on the bottom of your screen. You have the Tata Sons board meet that's currently underway, and there's no decision on clearing N. Chandra's reappointment as chairperson as of yet. So there was some speculation doing the rounds. So we're just trying to clear that point. As of now, there's no decision that yet be taken. We keep getting you updates on that front. Getting back to the markets, though, we've seen a bit of recovery from the low point of the day. We're 120 points off the lows, and there is a recovery in individual stocks like Coal India, Adani Ports. Both of them have seen a bit of a spurt up, and even in the broader markets, not expiry related, but development, that stock is now up close to 13%, 25% for the week itself. So big move is what we're seeing on development, and Vedanta is the other one. Yesterday there was some speculative news about some guidance cut. We at CNBC TV had done a quick check, and there wasn't any big matter to that. Stock had corrected intraday, and I think the shorts got trapped out. That's why the stock again has moved up. But Jay Bala of Catch the Chaos is with us. Jay, let's keep it simple. You believe that the Nifty is going to, visit lower levels and then continue its uptrend. We got that. What about individual stocks? Two ideas first.
Yeah, see, it's better off holding back cash, Nigel. And if you want to be selective about it and extremely, you have to make a trade. It can be in the FMCG names. Stocks like Britannia, Colgate, they are likely to see a short-term bounce. This is not a multi-month hold and for like an investment bet. It's a say multi-day to multi-week hold. So I'm expecting a short-term bounce to come through in the region of 2,400, 2,600 for Colgate and fresh 52-week highs for Britannia.
Okay, got it. Tata Sons board has deferred a decision on taking the extension of N. Chandra. That's the latest that's coming in there. We'll try to get in a bite from Mr. Chandra as he steps, out of Bombay House very, very soon. Our colleague Santya is there. She'll keep getting us updates on this front. But Parikshit as well as Shireen, that's the information that they're picking up with regard to what's flashing for you on the screen. Jay, just, since we've got just a couple of minutes to go, the Nifty Bank, I missed the level over there because that will clearly need to hold one end up, and Reliance Industries. The bulls will turn to both these two since the IT stocks are in a flux.
Yeah, Reliance, it cannot afford to drop below 1380. It's a very important support. And when it comes to Nifty banking, the upsides are getting quite limited. But, it's reasonable. It's not yet done, I think. The 63,000 is the resistance for the Nifty banking index. And as long as the sector can hold about 57,500, I don't think it's getting into trouble.
Okay, 57,500, and that's on the Nifty Bank. And on Reliance, I missed that level?
1380.
1380. Got it. All right, Jay, short but effective chat. Thanks a lot for joining in and giving us all of those details. Well, let's wind down the markets. It was a tough close to the February series, which wasn't so bad. Though it was really bad for the Nifty IT index. That lost close to around 20% in this series itself. In today's trade, though, the Nifty actually came up 120 points from the day's low. And that was the point we were making at the start of the show as well, that we could expect a bit of a swing. That's precisely what's happened. So a big swing out there. It's actually 25,450. That's the rate on the screen. Individual stocks, Tech got pummeled in today's trading session yet again. Tech Mahindra, HCL Tech, as well as TCS, both of them under pressure. The problem was even a stock like L&T that is actually holding quite strong for the last few days. That stock, in fact, did come in for some profit taking. Trent as well, the stock is half from the top, but that as well did take a bit of a knock. What did well? JSW Steel was up, Coal India was up, Hindalco was up, and NTPC. It's a pity that the metal index doesn't have too much weight. Otherwise, that could have held one end up. From the broader markets, individual stocks were doing a thing of their own. There is a fear with regard to stocks like Physicswala, as well as Eternal, as well as Ixigo. What's going to happen to their business models? So for the time being, those stocks did sell off in trade in today's trading session. On the flip side, development did well. You had Blue Jet that was up and about in trade today, as well as Bank of Maharashtra. All those stocks did pretty well in today's trading session. And you had the number of stocks advancing, close to around 1,000 in comparison to around 2,000 stocks that were declining. Not too bad on that front as well. But I think my colleague Parikshit Luthra is joining to get us the latest from the Tata Sons board meet. Parikshit, take it away.
Well, yes, this was a very important board meeting at Tata Sons. It was taking place in Bombay House sometime after 11:30. So you had all the board members, Noel Tata, N. Chandra, Venu Srinivasan, Harish Manvani, Anita George, Siddharth Sharma, all of them were present during this board meeting. We hear that Noel Tata had disagreed with or raised certain concerns about the reappointment of N. Chandrasekaran. So there was a disagreement about the reappointment, because of which a decision has been deferred. We'll get to know very soon whether it has been deferred till the next meeting, but this meeting was very important to build consensus on that. We believe that all members were on board with the decision to reappoint N. Chandrasekaran for another 5 years, but there was disagreement and certain concerns, certain issues raised on the part of Noel Tata. Let's see what happens, but he was supposed to get a 5-year term extension. Many thought that this is taken for granted. It's bound to happen, but clearly there was certain issues raised regarding losses in certain Tata Group companies during the meeting. So the meeting went on for about 2 hours. It spilled over after lunch as well. And this meeting, in a way, will also be very important in terms of how the Tata Group companies function from here. Of course, the Tata Group is at a very important stage right now. We've seen a lot of tussle between different trusts of the Tata Trust as well, the Ratan Tata Trust, the Dorabji Tata Trust as well. So just when those issues were getting sorted out, we've seen some disagreements in Tata Sons as well. So let's see how this plays out over the next few weeks.
Got it. All right. Thanks a lot for that, Parikshit. We'll keep getting you the latest on that front. For the time being, we'll wrap up on this edition of Closing Bell, but the team of Markets Forward is waiting for you on the other side.
Indian markets end sharply lower, weighed down by weakness in IT stocks and negative global cues. Benchmark indices underperformed with both Sensex and the Nifty falling over 1% each.
IT shares remain under pressure after Anthropic reveals another tool to automatically upgrade legacy COBOL systems. The index is on track to log its worst month in over 2 decades, with TCS, Infosys and Wipro declining more than 20% in the month of February itself.
Textile stocks end lower after the government cut incentives under remission of duties and taxes on export products scheme by 50% for the rate. Brokerage Elara Capital says that move could force exporters to reprice contracts in an already highly price-sensitive market.
And the board of Tata Sons has deferred the decision to extend the tenure of Group Chairman N. Chandrasekaran. According to sources, his tenure ends in February next year. You're with us here on Markets Forward, your go-to show where we aim to get you all the key data points to gear up for the next trading day. I'm Hormas Patakia, with me Vinny Motiwala. Vinny, well, it was a forgettable day for the Bulls, but the only positive, if you would want to call, is that we managed to defend last Thursday's low.
Okay, that is good at least, right? I'm going to take that positive sign that today markets were down almost 1%. Nifty Sensex not doing anything great. Look at IT also, right? It was down almost 4 to 5% in the trading session. More than 5% at least through the intraday day mark that we saw. But at the end of the day, it was 4.7% down. So a slight bit of a recovery from that day's lowest one. Very, very slight bit. But at least that is what we're seeing. Broader end of the market, Hormas, that still saw at least better in terms of a recovery that we could say?
We could say that there's some stocks that managed to ensure that the Nifty at least ended by just around about 100 points of the lows of the day. So we have managed to defend last Thursday's low. We've closed above the 25,400 mark. And of course, it is the end of the February series. So we wake up tomorrow morning, we come back with an absolutely new series and start off on an absolutely clean slate. But here's what's lined up for you over the next 20 minutes. The next movers and shakers with Sudarshan. We get you the reasons why IT and textile stocks were under pressure today. And of course, Bharti Airtel's 20,000 crore rupee bet on credit that led to double market cap erosion. And last but not the least, we delve into the key market events to watch out for going into midweek trading. But to our first segment of the day, Sudarshan is here at the big wall with the top movers and shakers. Sudarshan.
So before we talk about the bad part of today's session, good part was Nifty managed to hold on to levels above 200 DMA of 25,332. And bad part is, like last few days, there can't be a single day when we do not talk about the IT sector, because this is the sector which has been dragging the market. Today also, besides Eternal, if you take a look about the top Nifty losers, Tech Mahindra, HCL Tech, Infosys, TCS, all these stocks were down in the range of 6 to 7%. And if you talk about the mid-cap names also, there also LTI, Mindtree, KPIT Tech, Persistent, Coforge, all these stocks have been seeing a big fall with healthy volumes. Now coming to the top volume-led losers. In the Nifty, it was Eternal, down more than 5%. Come to the mid-cap, another name, Swiggy, and it has been following Eternal. Eternal in the morning started with a cut of 3%. Following that, Swiggy also started falling, and at the end, both these stocks closed with a cut in the range of 2 to 5% with healthy volumes. Now coming to those stocks which have reacted to the news flows, Vari Energy, even in a week day of trade, it closed with a gain of 3% on the back of order win of 500 megawatt. AU Small Finance Bank saw a big up move in the last hour of trade after the clarification we have got from IDFC First Bank and Haryana Chief Minister related to the fund they have got from IDFC First Bank of almost 583 crore. That's the reason both these names have seen a sharp up move from day's low. One, MobiKwik has got BSE's approval for trading business, and that's the reason this stock at one point was up almost 8%, closed with a gain of 2%. And last week, Bajaj Auto, there was a positive commentary from Rajiv Bajaj of hitting export volume of almost of 2.5 lakhs from the month of April. That's the reason the stock closed with a cut of 1% but recovered almost 3% from lows.
Okay, thank you so much for that, Sudarshan. But like Sudarshan was saying, right, Nifty IT, there's not a day that we go without talking about it, especially in the month of Feb. Now, when you look at it, it's headed for its worst month since April 2023 as AI-led concerns continue to weigh on the sector. Wipro is the biggest loser, down 24% in February, followed by Infosys, TCS. Rima is joining us now to give us more details on this one. Rima, over to you.
Thanks so much for that. Well, it all started in early February when Anthropic released the Claude update via which AI agents can do legal work, wealth management, and so much others. And the entire narrative towards Indian IT, change. And February has been such a brutal month. The Nifty IT index is down more than 20% in 1 month alone. And this makes it the single biggest monthly fall since the global financial crisis. We need to go back till September of 2008. And if you look at the individual stocks, these are large companies. TCS, for instance, it's a $30 billion revenue company, and that's seen a fall of 20%. Similarly for Infosys, HCL Tech, Wipro not getting spared. Some of these large mid-cap companies no longer a part of the Nifty, but at one point, an LTI, Mindtree, Tech Mahindra were a part. Persistent is bleeding 23% lower. Now, yesterday, the culprit was that one Anthropic Claude's update can modernize, analyze, and translate a very old programming language called COBOL. Now, this was a language which was written in the 1960s, 70s, and it became the language of banks, financial institutions. According to some estimates, even today, 95% of the ATM transactions in the US happen on code which is written in COBOL. And because it was so risky to modernize this, no one touched it for so many years. And then yesterday, Anthropic's Claude update showed that they can now modernize it, which suddenly once again questions the business model of IBM in hardware and software, and then even Indian IT companies, because they have IBM as a client or a customer for themselves. They provide maintenance work, application work. They will have an opportunity if indeed this whole COBOL modernization takes place, but that opportunity could be back-ended. For now, the fear is of revenue deflation. And the second thing is that analysts point out that even after a 20% price correction, massive PED rating, Indian IT companies are still trading at a premium to global peers. For instance, a Cognizant is at 10, 11 times. Accenture is at 14 times, while an Indian IT company is, Indian IT companies are trading at 16 to 18 times. We've seen massive price damage. Everyone's selling first and then asking questions to see how the operating and business model is going to evolve. But there's a lot of anxiety which is now being built into the narrative surrounding Indian IT.
Rima, thank you for summarizing that for us. Another forgettable day for Indian IT. To take the conversation forward on the IT and of course on the markets as well, Jay Bala from cashthechaos.com and Deepan Mehta from Elixir Equities joining us on the show. Gentlemen, good afternoon. Thank you for joining in. Deepan, to you first. They say you don't catch a falling knife, but here the question is how much more that knife is going to fall for IT. Do you want to even try, or being a brave heart and look to bottom fish?
Good afternoon. Thank you for having me on your show. You're right. I think there seems to be no respite for software services companies. And from whatever I can understand, what I gather is that AI will be an opportunity, definitely, but it will not be uniform. Maybe mid-cap stocks, which are more nimble, which have more specific offerings, they may be able to ride the AI wave better than some other large cap software services companies. In the interim, next 6 to 8 quarters can be extremely challenging. Maybe even longer or so, and that certainly puts a lot of uncertainty around their growth prospects going forward. And overall, I think the kind of damaging sentiment which is there globally in software services companies, that is being translated to Indian IT services also. In a situation like this, all I can say is that in my opinion, I could be wrong, the time to sell Indian IT companies is gone, but I wouldn't like to buy them. I want to wait for maybe 2 or 3, maybe even longer, to understand how they are dealing with the challenges and what is the exact impact of AI. I think that not be evident at least for 3 or 4 quarters. So just remain put over there, wait and watch. As I said, I think, if you had the wisdom to sell earlier, well and good. But on the whole, I think at these levels, I would say that it's just maybe the downside can get capped sooner or later.
Okay, downside can get capped sooner or later, but wait before you enter, at least see what the impact of AI is. That's a word from Deepan. Jay, what is your word coming in for Nifty IT? Also, in terms of today's Nifty move, right, we managed to hold on to 25,400 levels, but anything concerning there?
Definitely, Vinny. And like you pointed out last week on Markets Forward, that 30,900 on the Nifty IT index was a very crucial level. If markets had held that level and turned up, I would have turned bullish on the markets, or particularly Nifty IT in specific. But given the fact that the markets has broken through 30,900, now it raises the potential. The next support is only at 26,000 for the Nifty IT index. So that's about another 10% downside potential. I don't think it's going to go down in a straight line. We could see some chop, but I think the next important support is around the 26,000 mark. Around that market, that will be the market for me to see if the markets are turning around there for me to turn bullish. So right now, it's still an avoid and continues to be an avoid for me for the next few sessions. So when it comes to the impact on the Nifty as such, 25,148 on the Nifty is very important. If Nifty IT index were to drop another 10%, we need some heavy lifting coming from Reliance, banking sector, and one more sector, probably autos or defense. So if that happens, then this negative in the Nifty IT could need not play spoil sport on the Nifty and the broader market. But that looks a bit of a stretch. But let's see. Markets are always suppressing. So let's wait and see.
And hope for a positive surprise after all the negative ones that we have had in the recent times, Jay. But stay on, gentlemen. There's a lot more to talk about. But the other major story developing is the fact that we're learning from sources that the Tata Sons board has deferred its decision on N. Chandrasekaran's reappointment. The current tenure of Chandrasekaran, who's been at the helm of the conglomerate since 2017, ends in February of next year. Parikshit is here with more details on this. Parikshit, tell us more.
Well, we hear from sources that this board meeting, which took place at Bombay House, the official headquarters of Tata Sons, was a rather dramatic one. There were disagreements between board members, which led to this proposal, the decision on the proposal to extend N. Chandrasekaran's term for 5 years from February 2027 onwards to be deferred to another date. What exactly happened was this. There were concerns raised by Noel Tata, who is a key member of the Tata Sons board, about losses in certain Tata Group companies under N. Chandrasekaran. Noel Tata also said that somehow N. Chandrasekaran has to agree and give it in writing that Tata Sons will never be listed. Now, this was a guarantee that N. Chandrasekaran could not have given. Secondly, when it came to losses in a certain Tata Group company, other board members came to the support of N. Chandrasekaran and said that just because there are losses in one company, you cannot overlook the performance of the Tata Group in general and overlook the strong contribution of N. Chandrasekaran over the years. And therefore, he should be reappointment for another term of 5 years. Considering there were differences, some of the board members said, let there be a vote. To which N. Chandrasekaran suggested that because the Tata Group as an institution has two pillars, Tata Sons and Tata Trust, and both of whom have to be united. If there is disagreement right now and lack of consensus, it is best for the decision to be deferred. So it was on that unpleasant note that a decision on reappointment of N. Chandrasekaran was deferred till the next meeting. Now, what happens in the interim? There is no change. N. Chandrasekaran continues as chairman of Tata Sons till February 2027. That is the time till which his reappointment is legally valid. We will have to see what happens in the next board meeting. Will everyone be on board or not? That remains to be seen.
Okay, Parikshit, thank you so much for that. Important will be what happens in the next meeting as well. As of now, he will continue to be as the chairman over there. But yes, thank you so much for that. Let's move on and talk about textile stocks which were under pressure today. Gokuldas Exports, Arvind Limited, Vardhaman Textile. These were some of the names that came in under pressure, especially overall textile as a pack also was under pressure. Why? What did DGFT do? DGFT said that I'm going to be reducing the road tap rates by 50%. So that means road tap is what? It's actually a benefit that is given to these textile players who are exporters, especially of these export products. So on that, now that rate is reduced by 50%. So the rebate or remission that they were getting, that is something that the companies will not get. Now, what was Elara Capital's view on this one? Elara Capital specifically said that, yes, this rate reduction is going to impact some players. Some of them would be significant, whether you talk about yarn and fabric players, because the market, global market for them is highly competitive and as well as it's price sensitive. So if this rebate goes in, they'll have to reprice their contracts, new contracts at different price. Shipments which are already gone, there's no worry on that front. But newer shipments or what in terms of orders would come in, that would become a concern. So Vardhaman Textile, Arvind Limited saw a sharper fall through the day. Slight bit of a recovery that came in for Vardhaman Textiles as well. Arvind Limited continued to be under pressure. Apart from that, Nitin Spinners also did see some bit of a pressure. They have cotton and cotton yarn as well as fabric export as well. So again, that was also under pressure. And that was the main reason that we saw most of these textile stocks under pressure. Analysts also believe that normally there's a rebate that is of state and central government taxes and levies that could also maybe see a reduction in rate. Do not forget, Union Budget had already reduced this, expenditure that they had on this front. They'd already reduced it, and the absolute budget was brought down by almost 45 to 50% for the ROD, TEPD, RODTAP, as well as the rebate for state and central taxes and levies. So maybe that could follow as well. But as of now, the remission for duties and taxes for export product has been reduced by 50%.
Indeed, a reason why some of these textile stocks were under pressure in today's session. But just taking a bit of a detour for Deepan, we've spoken about textiles a lot, especially considering the tariff-related uncertainties. But Deepan, what I wanted to ask you was a lot of these well-hyped names from last year, the urban companies and the physics walas. Urban company made a post-listing high of 200. It's back at its IPO price. Physics wala has slipped below its IPO price already. Now, is this the actual valuation reset that is actually taking place for these names, or do you believe that these stocks are still overvalued? It needs to show numbers a lot more consistently before you try to nibble into such names.
I think, see, first of all, new generation tech companies need to be understood better by the street. And in my opinion, all of these companies had a premature listing. Maybe if they'd waited for 6 months to a year, when they were solid in the black, or when there was a proper roadmap to profitability, it would have been better for investors. But nonetheless, I think, you cannot ignore such companies, whether it's urban company or physics. These are the companies of the future. If you're building a portfolio for 2030 and beyond, then that's where the growth is going to come through. The challenge, of course, is to find which stocks will really outperform and which are the ones that are going to flounder. And that's the big challenge over here. In my opinion, I think investors should be allocating a portion of their portfolio into such a new generation, maybe loss-making companies, and track them closely. Now, if you do a quick back of the envelope calculation, these companies, if they grow by say 24% compound for next 3-4 years or so, and their costs go up only by 12% or so, then you can easily say that 3-4 years from now, they would make solid profits, very decent profits, and yet continue to grow by 12 to 14% thereafter. So I think one has to be selective. But just because they have corrected as much as they have, I wouldn't just write them off. Discovering the value in such loss-making companies is a bit more difficult. But I would remain invested at these levels also for some of these companies. Best idea is to buy these companies as a basket. Even if 1 or 2 winners emerge from there, it will cover the losses in the ones which have failed.
Okay, Deepan. Thanks for that. But let's move on and talk about another stock or other name that was in focus today. That's Bharti Airtel. Was one of the top Nifty losers, and this came in after the telco announced its 20,000 crore rupee foray into the NBFC business. Rima is joining us now to give us the announcement details. And the announcement didn't fare well for with investors, right, Rima?
So Airtel Money received its NBFC license from the Reserve Bank of India on 13th of February. Now, Airtel Money was operating in India, but it was operating as a lending service provider, which means it couldn't directly lend, but it could facilitate loans. And via this lending service provider, they had disbursed about 9,000 crore. Now, after they get that NBFC license, they can directly lend, which means they're competing with a Bajaj Finance, a Jio Finance, etc. Now, what is spooking the street today is the fact that Airtel is saying that we're committing 20,000 crore in terms of capital for building Airtel NBFC, Airtel Money over the next few years. 70% of that will come in from the listed entity and 30% from the promoters themselves. Now, so this is what is known. Now, analysts point out that overall 14,000 crore for a Bharti Airtel is not very large given its size, given how prudent it's been in terms of the capital allocation. But this capital commitment will keep going up as the company scales in size. So that is one. And secondly, the benefits. It's not that Airtel NBFC will make money, but that is going to be a bit back-ended. So I think that is just the fear which is built in the market. 20,000 crore is what they've committed, and the market capitalization of Bharti today has fallen double of that at close to 40,000 crore rupees.
Rima, thank you for that update. Before we thank our guests, Chair, very quickly, Bharti Airtel, levels of 2,000 now correcting slightly. What the chart's indicating?
Yeah, it's had a stellar run from 2023, Vivek, and it's due for a short-term correction, and the next supports comes at about 1840. But it's from a medium to long-term perspective. I don't think it's completed the top at about 2170. It's probably got one more record highs to come through. But before it sees that, it could probably drop all the way to 1840 to 1800.
Okay.
So be a bit patient.
Okay, Jay as well as Deepan, thank you so much for joining us on the show as always and helping understand the markets as well as individual stocks. But on that note, we're going to step into a very short break. We'll get you some sound bites from exclusive chat with Bajaj Auto's Rajiv Bajaj along with key market events to watch out for on the other side.
Welcome back. Now, Rajiv Bajaj, the managing director of Bajaj Auto, has said that the company will fare better in the first quarter of the next fiscal on the exports front. Now, in an exclusive conversation with us, Bajaj added that the company has overcome supply chain and operating setbacks. Listen into a slice of that conversation.
This month, despite a shorter month in that sense, this quarter we will still finish at 600,000, having done 215,000 in Jan. We are set to repeat that number this month, and then the balance will come in March. But from first quarter of next year, we should certainly be doing better. I am hopeful that with the spillover from March into April, we should be edging towards 250,000 in April. We have now stabilized at about 30,000 vehicles a month, having overcome the supply chain issues and other operating issues. And our capacity will be up to 40,000 across the supply chain from April. So that's what we've set our eyes on as the next target.
Okay, and before we wrap up this edition of Markets Forward, let's bring you the key events to watch out for in tomorrow's trading session. For that, we have Upasana joining in with us. Upasana, over to you.
Well, first up, let us look at some of the key results for tomorrow. Companies like KSB Limited, Sanofi India, Sanofi Consumer Healthcare India will be reporting its Q3 FY26 numbers tomorrow. Now, let us look at some of the key stocks that will be in focus on the back of corporate action. Company like Vedanta will be in focus as the board will consider its fundraising plans, and also SBI Life will be in focus as the board will consider interim dividend for FY25-26. Now let's move on to the IPO front. Omnitech Engineering IPO opens for subscription, while on the flip side, CleanMax Enviro Energy Solution opens for subscription. Now let us look at some of the key global economic cues. US API weekly crude oil stock data will be out tomorrow, and in Japan, Bank of Japan core CPI data will also be out tomorrow. Now, mind you that the today and tomorrow marks as an important event, as there is NASSCOM Technology and Leadership Forum, which is taking place in Mumbai itself. And the most important event for tomorrow will be President Donald Trump State of the Union address, which begins at 7:30 a.m. tomorrow morning. So we'll be keeping an eye out on that as well. So all in all, looks like quite a power-packed day tomorrow.
Yes, we'll be up and early to bring you that State of the Union address from Donald Trump. All eyes of the global markets will be on that. Take your leave on this edition of Markets Forward. From Vinny and me, thank you for watching. More news and updates continue on the other side.
Good evening. Thanks very much for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The board of Tata Sons defers the decision to extend the tenure of Group Chairman N. Chandrasekaran. Sources say Noel Tata was the one who opposed the reappointment. Chandra's tenure ends in February next year. The IT sell-off continues on Dalal Street. The Nifty IT index is on course for its biggest monthly decline in 23 years. The Sensex and the Nifty end with sharp cuts, erasing all the gains made in the last two sessions. The AI scare trade resumes on Wall Street. A viral blog post by Citrini Research sparks a major sell-off across software and IT stocks. President Trump's reworked 10% global tariff kicks in days after the Supreme Court rules that his sweeping tariffs were illegal. Trump vows to raise the rate to the legally permissible 15%. Wall Street Journal reports that the Trump administration is considering additional tariffs on 6 industries under the garb of national security. Textile stocks remain under pressure after the government halved benefits under the export support scheme. RODTEP exporters urge the government to restore the benefits. Rajiv Bajaj plays down the impact on Bajaj Auto but warns of negative impact across other businesses. Says RODTEP is not a subsidy but a tool to negate the inefficiency of our own ecosystem. Rajiv Bajaj bets big on exports for growth. Expects to ship around 2.5 lakh units from April. Plans to increase electric two-wheeler production from the next fiscal. That's an exclusive. Well, let's go straight to the top story this evening. The board of Tata Sons has deferred the decision to extend the tenure of Group Chairman N. Chandrasekaran. Sources say Noel Tata was the only board member who opposed the reappointment. Parikshit Luthra standing by with more details. Parikshit, almost 10 years since we saw that last very bitter public battle as far as the Tata Group was concerned, with Cyrus Mistry taking on Ratan Tata. N. Chandrasekaran was brought in post that. Now, what has transpired at this board meeting today? What are you picking up?
2017 was when N. Chandrasekaran had taken over as executive chairman. This was supposed to be a very routine board meeting, so to say, where the extension for N. Chandrasekaran was to be granted for a 5-year term starting February 2027. But it became a rather dramatic meeting, according to our sources. While there was consensus among a section of the board members that N. Chandra must be reappointed for his contribution to the Tata Group, Noel Tata raised concerns about losses and excessive capital expenditure in certain Tata Group companies. He also sought a guarantee that Tata Sons will never be listed. Remember, there are RBI guidelines which mandate that upper-layer NBFCs must be listed, and Tata Sons falls under that category and that definition. Tata Sons in August 2024 had surrendered its NBFC license and sought an exemption from mandatory listing, and that matter is still resting with the RBI. And therefore, when Noel Tata said that you must ensure that Tata Sons never gets listed, N. Chandra was of the opinion that this is not something which is in my control. When it came to losses in Tata Group companies, board members like Anita George, Venu Srinivasan and others said that just because there are losses in certain Tata Group companies or one Tata Group company, you cannot overlook the positive contribution of the individual, that is N. Chandrasekaran. Now, there were differences among board members, because of which N. Chandra finally sought a deferment of that decision. We must tell our viewers that the board meeting is still on. It began at 11:30. There was an hour-long lunch break, and the board members met again. They're still meeting right now. But what led to the deferment was this. When there was disagreement between Noel Tata and others, some of the board members suggested that let there be a vote now on the decision to decide the way forward. But N. Chandrasekaran was of the view that when it comes to the Tata Group, there are two pillars, the Tata Sons and the Tata Trust, and both the institutions must work together in a united fashion. And therefore, if there is disagreement, then it's best to defer the decision at this stage till the next meeting. Now, what happens in the interim? N. Chandra will continue as chairman at least till February 2027, because that is the legal term that he has. What happens in the next meeting, that remains to be seen. Hopefully there will be consensus, but it was indeed an unpleasant exchange that we saw in this meeting. According to sources, we're still awaiting a final word from Tata Sons.
All right, Parikshit, many thanks for joining us. We're now going to go across to Senior Supreme Court Advocate H.P. Ranina and Shailesh Haribhakti. Senior Chartered Accountant. Gentlemen, appreciate you joining us here on the program. Mr. Ranina and Mr. Haribhakti, 10 years on since we saw that previous boardroom battle at the Tata Group, at Tata Sons, when Cyrus Mistry went up against Ratan Tata. What do you make of this development, the decision to defer N. Chandrasekaran's reappointment, Mr. Ranina, and where this now leaves India's most diversified, largest conglomerate?
This has come as a great surprise, Shireen. I'm really surprised at this development because N. Chandrasekaran has done a fantastic job. And most of the profitability has come from sectors where he has been instrumental in getting the main business. Now, there may be a few companies which make losses like Air India and others, but that's a legacy issue. And you can't blame him for that. And that will take time to sort things out. But as things stand today, I think Chandrasekaran has done a fantastic job. And I'm surprised that his appointment has been deferred. There's no reason to do that at all, because I think it's very difficult to find somebody who can fill in his shoes, considering his experience and his handling of the Tata Group companies. Even companies like Tata Motors, Tata Steel have turned around the corner, all because of his own leadership. So really, I think it's a very unfortunate decision and makes me very sad to see that this appointment has been deferred, reappointment has been deferred.
What's also interesting to point out, as Parikshit was also reporting, is that the deferment itself was something that N. Chandra himself proposed, is what we're given to understand. Mr. Haribhakti, coming to you, sir, it was N. Chandra, we're given to understand as per sources, who said that let this decision be deferred since there is no unanimity and there should ideally be unanimity on a decision as significant as this. Now, to Mr. Ranina's point, where does this now leave the issue of succession at the Tata Group?
So, in my view, this is a symbol of the very high standards of professionalism that Mr. N. Chandrasekhar represents. And I admire him for it, salute him for making sure that in such an important succession decision, consensus is what should actually drive the decision. And so I would say that he has acted in an extremely professional manner and in the long-term interest of the Tata Group. I don't know what factors there are, and there would be many factors that the board will consider. And I would say that we hold off on any opinion until the next board meeting happens, and in a cool, collected, calm manner, as I would expect the board to reflect on the contributions of Mr. Chandrasekhar, and then a final decision will be taken on what needs to be done to his request for deferment. I don't think we should treat this as a decision one way or the other. We should only treat this as a symbol of his professionalism and an important time interval during which full consideration will be given by the board in a mature manner in terms of what ought to be the future leadership of the Tata Group.
Yes, you're right in pointing that out. There is a deferral that has taken place today. By the way, the Tata Sons board meeting is still underway. And so, as you pointed out, Mr. Haribhakti, this is not the final decision. There will be another board meeting, perhaps. We don't know when that is going to be scheduled, that will pick up on this issue once again. But Mr. Ranina and Mr. Haribhakti, coming back to you, one of the points of contention, which of course has been debated publicly as well for some time now, is the issue of taking Tata Sons public. Now, Mr. Ranina, the RBI has put guidelines in place. The Tatas had sought an exemption from those guidelines. But the possibility of an IPO sometime in the future, that clearly seems to be an issue as far as Tata Trust is concerned, because this is an unusual structure that we have as far as the Tata Group is concerned, and the concerns around a possible listing. I mean, nobody can give any kind of a guarantee because this is a matter that rests with the regulator. But that seems to be a point of contention. What do you make of that, Mr. Ranina?
Well, that is certainly an issue because, as you rightly pointed out, this is a matter which the RBI will have to decide. But one point which I would like to emphasize is that Tata Sons has repaid all its loans taken from the public. And it is really today become a private company in the sense that it has no public borrowings. And the real reason for the RBI asking the companies like them to go public is where there's a public exposure. As far as Tata Sons is concerned, there is no public exposure at this point of time because they have repaid all the loans. But nevertheless, the rules have to be construed by the RBI, as you rightly point out, and we'll have to wait and watch what the decision the RBI takes. But at this point of time, the matter has been deferred. The RBI has been sitting on this for quite some time, and no decision has been taken.
Yes, Mr. Haribhakti, I wanted you to come in on this as well, sir.
So, Reserve Bank of India will have a broad set of considerations in taking its final decision because, as Mr. Ranina very correctly out, the debt that they owed has been repaid. But because they are owners of public limited listed companies, there is an element of public interest which is to remain. And I think ultimately what will turn the Reserve Bank's decision is their comfort that the public limited company shares that Tata Sons own can continue to remain in a private kind of holding structure. So this is something that we will have to wait for the regulator to take a call in wider public.
And again, I don't mean to speculate, but Mr. Ranina, the last time we saw friction, we saw tensions escalate, we did see the government get involved. There was a meeting that took place at the Home Minister's residence in the capital. Do you foresee, some role that the government may play in trying to de-escalate this situation?
Well, I think the government will obviously ask them to come to a consensus. And that is the view of the government, that this is a group which really represents corporate India in a sense, and therefore they should have a united view. I suppose that is also the reason why Mr. Chandrasekhar has asked this decision to be deferred, because he believes in unanimity. And therefore, I think things will be sorted out in due course. But one has to also consider that the consequences of Chandrasekhar in not continuing, because then to find a new person who will fill in his shoes, who will have to take over the mantle, it's very difficult in this technological age to find somebody who will be able to take on the mantle of the chairman of the Tata Group of companies. So one also has to look at the other possibility that if he doesn't continue, who else? And where will it lead the Tata Group to? And are there such people and how much time it will take to have a reappointment, to have an appointment of a new person who will be completely new to the Tata Group? So all those consequences have to be considered before the board takes a final decision.
Yes. Mr. Haribhakti, before I let you both go, sir, what would the expectations now be? As I said, the board meeting is still underway. This is, of course, source-based information. It has not been made official yet. But what would the expectations be from the board, given the situation? I mean, there are myriad companies involved with different stakeholders, different shareholders. What would the market also like to hear from the Tata Sons board?
Well, I think the board will have to be very careful about what statements are made. But I would think I'll emphasize the fact that this was a decision taken based on the professional conduct and the professional opinion of the person concerned. And this is an attempt to bring issues to the fore and take the decision with full consensus and with full due consideration. And I think this is something that only all the people who are around the board table are into and in a position to take a call on. And therefore, I think the public should simply wait until the final decision emerges.
Yes, we will wait till we have an official statement from the Tata Sons board on what has transpired and what the way forward will be when the next meeting is likely to be scheduled and how they intend to deal with this deferral of N. Chandrasekharan's reappointment as the chairman. Mr. Ranina and Shailesh Haribhakti, always a pleasure. Many thanks for joining us here on CNBC TV 18 to make sense of this developing story. We'll head into a short break, but up next, the IT sell-off continues on the Lal Street. The Nifty IT index is on course for its biggest monthly decline in 23 years. That and more when we return. Weak global cues, a big sell-off in IT stocks and expiry day jitters weighing on the large street today. Markets erased all of its gains in the last 2 days, dragging the Nifty below the 25,450 mark. The Nifty and the Sensex fell 1%, but the broader markets fared mildly better. IT stocks were the worst hit after an AI-led disruption. Fear continued to intensify the sell-off that started earlier this month. The Nifty IT index hitting a 2-year low and is on course for its biggest monthly loss in 23 years. Every single constituent of the index is now down more than 10% since the start of 2026. The AI scare trade resumed on Wall Street after a viral report by Citrini Research. The report described a future in which technological change inspires a race to the bottom in white-collar knowledge work. Prashant is standing by with more on that research report that seems to have caused mayhem or additional mayhem for the stock markets and for the IT stocks. Prashant.
It's rare for a blog to be blamed for moving markets, but that is exactly what has happened in the last 24 hours or so. A long-form piece titled The 2028 Global Intelligence Crisis went viral, absolutely viral in the investment community globally, not just here in India, over the last 24 to 36 hours. And this morning, global mainstream publications like the Wall Street Journal blamed it partly for the sell-off we saw last night. Now, the note is written by analysts at Citrini, which is a US-based top-down macro thematic research house. What does the write-up actually say? It's a very long one. The thesis is simple, but quite unsettling. And I guess that's the virality. It's asked the question, what if AI productivity gains are too successful? The paper argues that AI drives massive GDP growth, explosive productivity growth, but no corresponding growth in consumer demand. Why, you'd ask, right? Because machines don't consume. They don't spend either. It goes on to say if automation displaces workers or pushes workers into lower paying jobs, household income falls. And when income falls, so does discretionary spending. So basically you get output rising on paper, but demand collapsing in reality. So it maps out like a cascade, right? Job losses, lower wage growth, falling velocity of money, and of course stress showing up everywhere, including stock markets and credit markets, etc. It flags, a few sectors, specifically food delivery, payments, IT services, and private credit is particularly vulnerable to AI-driven disintermediation. The article is well written, it's extremely long, but it's not uncontested. Lots and lots of pushback from investors, CEOs, techies, and just normal folk out there. And I'm going to just use two arguments here which people are making, right, in terms of pushing back against what the arguments which are being made. One is the idea of new jobs being created, which we can't imagine yet. B, the idea that markets are reflexive in nature. But I'm going to not make these arguments by quoting people who are on social media, but going to the original source behind both these ideas. The first one actually is Joseph Schumpeter, who is an Austrian economist and is best known for his theory of creative destruction. He hypothesized that technological revolutions don't just eliminate jobs, they create entirely new industries we can't yet imagine. The second one comes from the Austrian-British economist. He was a political philosopher, Nobel laureate, Friedrich Hayek, who argued that markets self-correct. And the argument is this, right? If equities fall 40-50%, credit tightens, capital expenditure slows, prices will act as a brake. Companies will not continue to spend hundreds of billions of dollars in a vacuum, right? Prices will reflect the reality and that cycle will stop. So I guess the real debate here isn't whether AI disrupts. It certainly will. The extent is debatable. But the question to ask is, does AI create a productivity boom without consumers, or does it trigger another cycle of economic reinvention? History suggests the latter, but for now, markets are deeply anxious of which is the next sector AI will disrupt.
Well, anxiety at peak. Many thanks, Prashant, for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. Gold and silver have been volatile in trade amid rising tensions between the United States and Iran, along with uncertainty around tariffs. So far in 2026, silver is up 23%, while gold has gained 20%. Other factors weighing on gold prices include Europe halting confirmation of a trade deal with the US and the postponement of India-US negotiations to finalize that interim trade deal. However, UBS expects gold demand to hit a new high in 2026, with prices projected to reach $6,200 an ounce on the back of strong investment demand and continued support from central bank buying. It is silver, meanwhile, which is expected to see strong global demand remaining steady. This is as per a report from the Silver Institute. Joining us now to take that discussion forward is Rahul Mehta. He is MD with Silver Emporium, and Varghese Alucas is Managing Director with Joss Alucas Group. Gentlemen, hi, thank you so much for joining in. Let's start with gold first. And Mr. Alucas, it does seem to be holding quite strong therein. While we have seen $5,600 an ounce of an all-time high, it seems to be holding around that 5,000. One, what is your sense on the prices from here on? And would you say most of the consumers are now kind of adjusted to this new high?
Yeah, last 2 weeks back, there was a dip in gold price, which was again coming back to 5,000 levels. If you see last 3-4 days, it is again picking up above 5,000, which reached 5,200. So customers are really looking to a stable gold price where they did like to buy jewelry, but sometimes when the correction comes, there is a little confidence is going whether there is a chance of again falling, and again last week it has gone up. So customers, few are still waiting for the stability in gold price, even though there are a lot of exchange happening on the present purchases what have been done by the customers, and looking into a price point product to stay with the present price scenarios.
What's your sense on the gold prices? Where do you see them with a view of next 3 to 6 months?
After
perhaps?
a small correction, and again when we see all the report and because of this war tension, tariff issues, which has crossed 5,200, we're still looking if it goes up at least to 5,500 or 5,600 where it has earlier reached. But we hope things have to get settled at least after this month for a new upcoming year from April, where the season start, actually the start. So a stable in gold price, always it is good in the mind of customers who can be very assured and confident in buying jewelry.
Absolutely. Mr. Alucas, also, what has been your sense on what people are buying? Because while 2025 was a record gold buying year at 5,000 tons therein, how are you looking at buying as we're starting a new year right now? Is it more about investment buying, or do you think the jewelry buying is coming back as well?
Yes, there was an investment buying when the prices were shooting up so high, if you look into gold or if you look into silver. But we jewelers are trying to create more design, the lightweight designs, making the product little more aspiring to the customers. So we always jewelers like to make customer to buy as an ornament. We try to give more choices, making more designs, preferring customers to make this jewelry wearing a better option other than going for investment where they only can buy it and later on selling on the profit, where there is not much profit percentage from the jewelers to look into. So we always try to create with new designs, moving away the old designs which are not moving that good, or which was very high in weight, has been reduced in a lower weight, lightweight designs. So we still feel that there is scope for customers to buy into ornament, where our carriers or our suppliers, vendors are trying to create latest designs with more lightweight jewelry, with more studded jewelry, with more options available in the market.
Until this time, as we've started the new calendar year, Mr. Alucas, when we look at the month of Jan and Feb, what would you say has been the jewelry demand till time? The general consensus is that there has been a decline anywhere between 20 to 30% in jewelry buying between these 2 months. What is your sense?
If you look into last year, there can be a 20% decrease because that much prices has gone high. Because last year, if you look into the gold price from last financial year, it started from 8,000, which has reached almost double, which is around 14,000 to 15,000. So generally there is a 20% dip, but again, the revenue buys, when you see in the revenue, where it has been reached with the same expectation from the last year. But still, we are waiting for the new financial year, which is from April, because this month is coming. March is almost year-ending, accounting closing year, and exam seasons and all that. So coming month, in the Akshaya Tritiya, or what you call a festival season, season where people start to buy, weddings happen from April in the south.
Oh,
so we are expecting for more stores to come up, around 4 to 5 stores before the Akshaya Tritiya, and tap more buying from the customers in the ornamental way rather than the investment way.
All right, to add 4 or 5 stores before Akshaya Tritiya and looking at strong buying before that time. Rahul, let me get you into this conversation as well. And while Mr. Alucard spoke about gold in great detail, it is silver which continues to be very volatile as well. Half the prices of what we saw at peak at one point in time. One, what is your sense on prices? And also, how are you looking at demand right now? Is it about bullion buying? Is it about still investment, which is more?
So even if you say the prices have corrected 50%, if you see year on year, last 2025 to 2026, in last 2 months, there is a net increasement of silver prices by about 20%. That's a very interesting number. But if you see in terms of ground reality, the volume has dried up. Investment demand as well as consumption demand both has dried up because people look at stability. See, irrespective to whatever prices, even if it's the higher prices, stability in the market is very important for consumer to come back and buy gold or silver or any commodity. So I think so what we are looking at is a stability in the prices that will definitely help in getting consumers back to buying silver jewelry, silver articles, and definitely the investment demand that we see in the market is currently tied up. On the higher side, when the prices were trading above 3,50,000, 4 lakh, even that time the consumer demand was not, the investment demand was not there. What would be interesting to see if the SIP, there is an increment in SIP in silver, because I think some lot of demand may have shifted physical demand to in a mode of electronic form through SIP.
Oh, yes, absolutely. What's your sense on prices, Rahul? Where do you see that heading?
See, in terms of prices, but definitely I look at maybe silver price is a very good buy between 190 to 2,30,000 is a good buy for a long-term basis. But in these kind of volatile market, I always see SIP is a very good mechanism to buy silver on a consistent basis. If you see right now the way silver is behaving, it is more about traders. I would say paradise. I think the kind of range which is going on, traders can make big money. But in terms of when you look at investors, is definitely there's a chances of investor getting stuck. So it's a good idea to invest through SIP on a regular basis. So what happens is your maybe the cost of acquisition is spread over a period of time, and also you get a better average of the rate.
How are you also looking at hallmarking pushing through? Because while it is not mandatory, but do you see more and more silver sellers now getting to that direction?
See, in terms of when you see marketing, a lot of players in terms of articles and jewelry have already moved towards getting their products, silver jewelry, silver articles, hallmark. But mandatory is something which we need to see how long it may take. But in terms of when you look at consumer protection, definitely we see the silver hallmarking should be mandatory. But there are regulatory challenges in terms of number of hallmarking centers, number of pieces which needs to be hallmarked. So those are on the challenges which we can see. But when we look at the consumer side, a lot of jewelers, a lot of manufacturers are voluntary hallmarking silver jewelry and articles and give it to consumers.
Fair point that. Mr. Alucard, Rahul, thank you so much for joining in, making sense of what really is the reaction of consumers on these current prices and expectation that as we end the current financial year and move into the next one, there will be demand that could be coming back into this space as well. But with that, let's go for a short break. When we come back, we will be joined by Dhruv Goyal, who joins in from Big Mint to talk all things metals after this break. Welcome back. You're watching Commodity Champions. The ongoing tensions between the United States and Iran are heating up the overall markets there. If you look at the prices, well, we have seen steel prices gain up quite strongly. Well, it is about Section 122 and Section 232 that the markets seem to be dealing with at this point in time. But there's a bit of a pause right now in prices. And where do we see the scenario from here? For that discussion, let's go to Dhruv Goyal. He's CEO at Bigman Technologies. Dhruv, hi, thank you so much for joining in. First of all, on the steel prices itself, because the last 1 month was all about bullishness, but the last couple of days have seen a bit of a pause, even some profit taking, especially after China markets have opened. How are you looking at that?
Thank you, Manisha. So to answer your question, definitely there is a pause in the steel prices, but I would not say that this is specifically due to the US tariff, the Supreme Court order, which has recently come. What we understand that prices have already gained momentum quite significantly in last couple of months. Again, if I have to give the context, prices in Indian context, the prices were trading at 7 years low in the month of October. Then from there, prices started moving up, and from there, the prices have gained approximately 15 to as high as 20% in different types of the steel. So at this level, we see that there is some resistance from the buying side, and there's some profit booking taking place. People, stockists or traders who have taken position, they are trying to liquidate the material. So that has put some pressure on the steel prices at the moment.
Oh, absolutely, Dhruv. I was reading a lot of reports from the Indian construction houses as well, suggesting that the higher steel prices in some sense are making raw material costs go much higher. From where we stand right now, how would you look at the steel prices play on from here?
So as we say that prices were subdued in the month in FY26 till October, November, then prices we saw some kind of rebound in the prices, especially from the restocking and increased input cost. So we feel that prices will sustain till March. Mills have sufficient booking. We do not see very significant price drop from here, except that there could be some profit booking taking place at the trader level. But from a mill level, they're still oversold. So I think March prices will sustain, but going forward, there will be some rationalization seen in the steel prices.
How are you looking at the international cues then, especially with China coming in? And well, yes, it doesn't really impact so much in sense of the Indian markets, but with all these critical mineral list and Section 232, Section 122, do you see the global steel prices getting impact from that?
Very difficult to comment on that because there's a lot of uncertainty in the market, especially the your ruling by the Supreme Court, which has installed all the tariffs being imposed by Trump. So I think we have to wait and watch that what implications will it have on the global trade market, because every country now has approximately 15% of duties. So we need to actually see that how the trade flows will shape up. But from an Indian context, we do not see a lot of China opening up or the trade barrier or the tariffs will have direct impact on the steel prices. But globally, yes, I said that we have to wait and watch.
I was looking at the international indexes there in Dhruv, and super tanker prices, the freight prices that has surged to almost 2015 highs. The Baltic dry index is trading at a 3-week highs as well. The big tankers are doing quite well in there. How would you look at the global trade overall?
So as I said that, after the tariffs have been rationalized or it has been, withdrawn from the Supreme Court table, and then again there is a news that tariffs will be at 15% against Section 122. So every country now wants to go back to US and then try to sell their material. That is why the freight rates are increasing. But again, if you have read the recent, update from President Trump that in case if any country tries to become over smart, they have to pay the penalty for that. So I think countries will also be very cautious and specific about this thing. But technically, there does not exist any abnormal tariff to US. So there would be some exports taking place from all across the countries.
How would you also look at the iron ore as availability and prices in the current financial year as it is ending in another month or so? How are you looking at also the markets going forward from there?
This is from the Indian context or from
Indian
the global?
context. Indian context.
In context, so prices are quite stable. Having said that, steel prices have increased in last couple of months. Mills are making some margin. So there is still some room to increase the iron ore prices for all the miners, and especially as you rightly said that we are ending the financial year, and most of the mines end or finish their mining capacity, which is from April to March. So there is some room for improvement, some room to increase the prices. But let's see how does these miners take a call in the month of March.
Dhruv, across board, when you look at the raw materials, while steel and iron ore have been the steady ones, we've seen coal prices do quite well. They have seen a very strong gain come in there. The other metals like copper and aluminum also are, when you look at the YTD basis, are much on the higher side. When it comes to just about raw materials, the longer term, of course, is still about EVs and AIs and etc. But the construction, the kind of work that we see happen on ground as well, with China, with most parts of Asia as well. How are you looking at the narrative building on from here for many of these?
So I think, as you rightly mentioned, that demand for all these new age material, be it copper, be it aluminium, wherein the application of the new emergence or new applications are being defined. So demand for these materials will remain strong for years to come. Steel is more conventional, material which is being used in construction, auto, and engineering. So they are growing at their own pace. So I think that the other material will perform better than the steel in coming time.
And would you say the same for coal?
Coal is a different story, depending on what coal I'm talking about. If it's coking coal, so coking coal has a different market dynamics. If it's a thermal coal, so thermal coal has its own dynamic, a different dynamic, because thermal coal is largely dependent on Indonesia. Now there are different mining rules, norms coming in Indonesia that will impact the global trade flows.
Point taken, Subali. Absolutely. There's a lot of uncertainty in the international markets and each country driving its own prices and fundamentals as well. But thank you so much, Dhruv, for joining in with that sense on steel, iron ore, and of course, the international cues, Indian demand as well. With that, it's a wrap on this edition of Commodity Champions. Thank you for watching.
Bajaj Auto has seen a strong rebound in exports in Q3 of FY26 with 200,000 export sales per month since October, and the numbers crossed the 600,000 mark after 15 quarters. The company expects this export momentum to continue. In fact, the Bajaj Auto leadership has said that the company is on the path to deliver its highest ever top-line performance in dollar terms this financial year. Continued leadership in the three-wheeler segments is also supporting the growth of the company. Bajaj Auto emerged as the #1 player in the electric auto segment in Q3. In electric two-wheelers, TVS, Bajaj Auto have consolidated their position as the top two players, followed by Ather Energy, Hero MotoCorp and Ola in the 5th place. Bajaj Auto has said that for electric two-wheelers, the company has emerged out of supply chain disruptions and is working on a rapid scale-up of sales and production. While Bajaj Auto's two-wheeler sales in the domestic market were up 25% at 214,000 units in January this year. Overall, between April to January, the domestic two-wheeler sales for the company were down by about 2%. To drive domestic growth, Bajaj Auto has taken 7 initiatives in the form of upgrades recently, and 8 more interventions or products are expected to come out in the next 4 months. Increasing growth in the 125cc plus segment and the 150cc plus segment will be a priority for the company. Joining us now to talk about all of this is Bajaj Auto's Rajiv Bajaj, the Managing Director of the company. Mr. Bajaj, thank you very much. The export performance has stood out in the last quarter. How do you see the export momentum continuing?
Hi, Parikshit. Yes, exports has been our most standout vertical over the last quarter. As you mentioned, after a long time, we crossed an average of 200,000 vehicles per month. In the last quarter, we are set to repeat that in this quarter and hopefully do even better in the next year. Let me, just share some data points with you, starting with our oldest markets. Sri Lanka, for example, from complete collapse, say 2 years ago, is back to over 10,000 a month. Nepal, also very troubled in recent times, now over 5,000 a month. Our biggest market, Nigeria, that used to average at its best 60,000 a month, had gone to zero, and now back to 30,000 a month consistently. And I believe looking at 35, 40,000 a month in the near future. Doing very well in Kenya, Uganda, DRC, but the star really is LATAM, as Rakesh has been telling you, not just, again, the older markets like Colombia and Central America, but the relatively newer ones, Mexico, Brazil, where we are up to now over 3,000 a month, and I believe in the top 5 in the market in terms of number of players. Parikshit, I never thought a day would come when I would be saying to you that in just 1 month of January, we recorded a sale in LATAM alone of over 50,000 motorcycles, most of which are Pulsar and Dominar, and over 5,000 three-wheelers. I never thought this would happen, but it has.
All right, so that's a strong performance in Latin America, as you pointed out. 50,000 two-wheelers in January, 5,000 three-wheelers. So if the numbers, export numbers crossed 600,000 in Q3, would you expect similar numbers, or could you give us a growth projection for this quarter, for Q4 and going forward?
This quarter should be very similar. Also because the month of March, as you know, in terms of accounting term, for us ends by 20th of March in terms of exports, making sure that all the bill of lading, etc., is available to close the books. So this month, despite a shorter month in that sense, this quarter we will still finish at 600,000, having done 215,000 in Jan. We are set to repeat that number this month, and then the balance will come in March. But from first quarter of next year, we should certainly be doing better. I am hopeful that with the spillover from March into April, we should be edging towards 250,000 in April.
All right. Also to ask you about the recent trade deals, how are you encouraged by the FTA conclusion with the European Union? It's going to come into effect next year, and we will be getting zero duty access for our two-wheelers. How does this help you, and how does it open up new markets?
Well, I'm very positive, Parikshit, obviously, because, fundamentally, let me tell you this from our recent experience with so many European suppliers that are supplying to KTM that I have been speaking with. And it's very clear. They say to us that in the pursuit of China +1, They evaluated India, they evaluated Thailand, and they evaluated Vietnam. These are the three sources that most people are looking at, and almost without exception, everyone says that so long as there is scale, you cannot beat India. India is more competitive than all these alternatives, including, at least in our industry, what I've heard from them, even China on both quality and cost. Ours is a business where we have tremendous scale. Unlike, for example, the car industry in India. So, this deal is going to be great for the two-wheeler industry.
All right. And what about the United States? We're seeing a lot of uncertainty with the trade deal there. Yes, it has been agreed upon at 18%. Then, of course, the Supreme Court struck down the IPA tariffs. Then Donald Trump increased tariffs to 10% and now to 15%. How do you see the uncertainty there? How does the company and your export push get impacted?
That story is we've done very well, Parikshit. As someone said, you can't control the wind, but you can adjust your sails. And it's a real testament, as I told you the last time we spoke as well, to Indian engineering and Indian engineers, that when the 50% tariff was imposed, Bajaj Auto absorbed most of that. For the export of both KTM and Triumph out of India to the US, a volume for us about 15,000 per year. And let me tell you, despite absorbing most of that 50% increase, our EBITDA on those products was over 20%, over our corporate average. That just tells you how competitive India is. Now, of course, we are shipping not at 50% tariff, but at 15% tariff. We've just changed FOB in that context. So obviously, the volume has been protected and the EBITDA is going to be very, very strong. So again, US is looking great for us.
Right. Now, just to ask you about certain measures that the Indian government is taking to support exports. But at the same time, the ROTTEP scheme, the government there has slashed duty benefits by 50%. Now, exporter bodies have expressed concern. They've urged the government to rethink. How does this impact the two-wheeler segment especially?
Well, it can only have a negative impact. I've always said that more than anything, the government just in this regard has to ensure greater and greater ease of doing business. In terms of what I like to call the 5 L's, labor, legislation, land, logistics, and electricity. And it's true. Again, if I compare with markets like Thailand and Vietnam and some others that we have some experience of, it is still harder to do business in India than it is to do out of those places. And ROTTEP, as everyone knows, is not a subsidy or an incentive. It is basically trying to negate exporting your inefficiencies or the inefficiencies of the ecosystem in which you have to perform. So frankly, for an exporter like Bajaj Auto, whose export EBITDA is way above its corporate EBITDA of 20%, and the way the rupee is depreciating, it is not the most significant thing. But for a lot of the other people who are especially in a B2B kind of business, who do not have price elasticity, I can imagine that this is not a trivial issue. And I just don't understand, it could not have been more ill-timed.
All right, just to ask you about EV sales, the company has been looking to tackle supply chain issues. EV sales, as per Vahan numbers for January, they were in the range of 26,000 units. Bajaj Auto was in second place after TVS Motor Company, and somehow both companies have consolidated their position over the last 1 year. How do you look to drive sales going forward, and how do you expect the sales and production to increase?
Well, let me tell you, Parikshit, as much as we remain India's #1 automotive exporter by volume, we are actually, we have been for some time, India's #1 EV company. This year, our PLI claim in that regard will be of the highest slab, and I think will be to the tune of almost 1,000 crores of rupees, of which recently I told you a couple of months back that the first tranche of 642 crores or so that we applied for was granted to us by the government without any modification. Coming more specifically to your question, I'll start with the three-wheeler, where, as you said in your introduction, we are now the market leader in E3 wheelers. We've been in the top two with Mahindra for a long time, but in recent months, we are clearly pulling away to the number one position. We are close to the 40% market share at which we hope to close this month, representing 10,000 vehicles a month, which is not a small volume. But our ambition is very clear. In the ICE three-wheeler market in India, we have 70% share. And we are not going to stop till we get this 40% to 70%. In the e-two-wheeler market, where our brand is the Chetak, again, we are in the top two, as you mentioned, but there I must admit that TVS has been ahead more months than we have. We have now stabilized at about 30,000 vehicles a month, having overcome the supply chain issues and other operating issues. And our capacity will be up to 40,000 across the supply chain from April. So that's what we've set our eyes on as the next target. The answer to your question, what's the way forward? The way forward in this business is always, product as strategy in the wider sense of the term. And I feel very confident that we will continue to be a very significant EV company, if not the largest EV company in India for some time.
So you said, sir, that you will increase electric two-wheeler production to 40,000 units by March, by next month?
By April, that will be our capacity. And of course, we will be ready to make that. Hopefully, Rakesh can stir up demand in line with that.
On that note, we take a short break, but don't go anywhere. This conversation with Rajiv Bajaj continues on the other side. Welcome back. You're watching CNBC TV 18 and we are in an exclusive conversation with Rajiv Bajaj, the Managing Director of Bajaj Auto. EV subsidies, especially the central level subsidies, are going to end in March this year. How is that going to impact electric two-wheeler segment?
Well, my view on subsidies, Parikshit, is diametrically opposite to that on ROTTEP. As I said, ROTTEP is the antidote for some of the negatives here. In terms of subsidies, I've said this to you before, I believe subsidies mask realities, subsidies slow innovation, and subsidies cushion inefficiency. So, frankly, in principle, I have to say, I'm not for subsidies. I'm glad the subsidy on three-wheelers, electric three-wheelers is gone. I hope it is not going to come back. I believe that it is set to end with electric two-wheelers also on 31st March. I hope that happens because I think, that's really not sustainable for the way forward. Plus, let's ask ourselves fundamentally, what is holding consumers back from electric vehicles? Why isn't penetration rising as quickly as we would like it to? There's fundamentally three issues. There is the issue of safety, which I think now is more or less behind us. There are concerns around the replacement of the battery as and when battery life is over. Well, we'll cross that bridge when we come to it. But for now, the third most important criteria is range. And I think all the money that's been given to OEMs or to customers as subsidies should actually have been put into infrastructure for supporting the EV ecosystem. That's a bus we've missed. But anyway, what's happened has happened. Let's move forward from here without subsidies, with more innovation and more efficiency.
Also, when it comes to state-level subsidies, have all states been at the same level in terms of disbursing subsidies on time? Have you had issues with any state government?
No, state-level subsidies have varied, in amounts. But I must say this, that whenever we have received any support from the center or from most states, sometimes that's a little late in coming for various reasons. We don't have time for that today, but eventually it does come. So, you lose out on interest, cash flow, etc. But you know that you will get what was due to you. But I must say, in my 35 years, this is the 36th year at Bajaj, Parikshit, I have never witnessed anything that I could call as policy failure of government. But I think it's about to happen with the Maharashtra government EV policy. It is really unfortunate that what is due to us, I'm talking about Bajaj Auto, but I know that this is true for most, if not all of the industry, what is due to us in terms of the subsidy that was announced, which was disbursed up till April 2023. In the last almost 3 years, we have received a very tiny fraction of what was due to us. And in discussion with let's say, the grapevine there, we understand that most of it will not come. And again, in the context of ease of doing business, I would like to say that the ease of doing business is important, but it rests on something far more critical, which is the trust of doing business. And it would be appalling if there was a trust deficit in this regard, that tomorrow a Maharashtra government puts out a scheme or some kind of a offer, and industry doesn't have the faith to take that on. I hope it doesn't happen, but after 3 years, as you can tell, I'm rather pissed off.
Important point there. Let's hope that the issue around subsidies with the Maharashtra government is resolved. I would also like to shift focus to the domestic two-wheeler market, where we have seen Bajaj Auto struggling a bit this year. What's going to be your strategy? And first of all, let's ask about the current market share in the 125cc plus segment right now versus what it was at the end of December 2025.
You're absolutely right. That's been our one area of weakness in terms of business verticals. But let me share the good news first, Parikshit. 350cc GST cut that took place has worked to our advantage as well, although we are not such a big player in that space like Royal Enfield. But our domestic KTM sales, for example, in which we have several models that are above, but many more that are below 350cc. We are now growing in the last few months at 50 to 70% a month. KTM is now striking 10,000 vehicles a month in India, which is fantastic. Triumph, we have moved up from 3,000 to 4,000 a month, as you may have seen the last couple of months. And I'm happy to say that the 350cc Triumphs are ready to go to market by April, which means that I think we can move further to maybe 5,000 or even higher per month of the Triumph motorcycles. Coming now to the Bajaj brand and your specific question on the 125cc plus segment. The good news is that we have gained share there. As you know, this share is not readily available from Vahan. It's a kind of derived share, as Rakesh has explained in the past. We believe our share has moved up by a couple of percentage points to somewhere in the region of 22 to 24%. It depends on the month, how you measure that exactly. And this is basically because, the core of the Bajaj motorcycle portfolio in India is the Pulsar. And you referred to several upgrades and refreshes that have come and are due to come into the market. They are coming in at least 3 waves in the near term. The first wave is already underway. You are already seeing some impact of that. I think some green shoots in terms of volume, in terms of mix premiumization, in terms of better share, better EBITDA. We are already witnessing internally. I think in the next quarter, we will have the second wave, and in the second quarter, the third wave. I think the green shoots you see now, you will see a green sapling in the first quarter and a little green tree in the second quarter, well before the festive season. So we are feeling rather confident about that portfolio, thankfully, finally.
All right. So could you give us a sense of how many brand new products or upgrades from Pulsar are we going to see, and how could this drive up the Pulsar volumes?
Well, I was myself a little boggled when you mentioned that 7 or 8 are in and an equal number are expected. I guess this comes out of a conversation with Rakesh. So it must be something like that. But what I'm also happy to share, and I know that the street is expecting this, is that there will also be at least one new brand, if not more than one, between now and the festive season in this space, by which I mean in the 125 to 250cc space. That is so critical to our portfolio. And I think that will help us to cast the net wider in this catchment area of 125 to 250cc. And fingers crossed, let's hope new brands and new products work well for us.
All right. So let me also ask you about the ABS issue that many companies have been taking up with the central government. How do you think this is going to impact? Has there been any headway in talks, in dialogue with the government on that front?
Let me respond in 2 parts, Parikshit. First of all, these kind of regulations that create fault lines within an industry, between segments, I think are really inimical in many ways, right from the product development plans to the, business planning of a company. But we won't dwell on that. What's been done has been done. We all know that ABS is required in motorcycles 125cc and more. And they were proposed to be implemented, if I remember right, in those that are below 125. That means 125 and 100cc. And in my opinion, I believe that should be done. Because, I really don't see that if you are going to have a regulation that impacts only about, let's say, 25% of the market, how that's going to help improve our dubious record for the highest number of road fatalities in the world. Now, this is not always the fault of the car or the motorcycle. It's a lot to do with our road conditions, most of all, I guess. And also, if I may say so, with our poor discipline as people on the road. But having said that, if we really want to sort out the product angle, then the 75% of the industry at least of the motorcycle industry that I know, scooters I don't know so well, which rests between 100cc and 125cc, also needs to adopt the same technology. I mean, people who are riding those bikes are also riding at very similar speeds with similar load to the one who's riding, let's say, a 150cc motorcycle. So I really don't understand why this regulation was not, uniform across the industry in the first place. And now that it was finally announced, months ago, why it hasn't been implemented, what's holding it back, frankly, that's something Nitin Gadkari ji has to answer.
Right. Now, when it comes to higher capacity motorcycles, 400cc plus, clearly there has been an impact there. What's going to be the strategy to grow the market going forward? Because are you having to pull back on your plans for bigger motorcycles?
No, not at all, because, as I said, we are India's #1 exporter. The market for motorcycles over 350cc is far greater outside this country than in this country. I do hope, as Siddharth and I had both appealed at that time in September, but that was too late perhaps, that the GST there would be reviewed downwards from 40% to 18%, because, that's the last 2% of the domestic market by volume. And to hobble that volume domestically is to hobble the Indian OEMs globally, because it becomes very hard to create product and to make investments for business overseas if you have headwinds in your own domestic market, however small but promising it is. So I do hope the government will review that at some point of time. To your point made earlier of government doing stuff that enables industry to export. But having said that, in terms of Bajaj, particularly in the brands KTM, of which we are now a 75% plus owner, as you know, and also for the brand Triumph, both these brands have extensive worldwide distribution. They have, huge existing base of consumers who are looking for bigger motorcycles over 350cc. So there is absolutely no change in our plans as far as such motorcycles are concerned.
My final two questions, Mr. Bajaj. You've been generous with your time, but speaking about consolidation in the EV segment, considering that there are only 3 or 4 top players which are able to deliver growth right now, do you expect consolidation to take place once the central government subsidies come to an end?
I think it is less dependent on subsidies, Parikshit. It's a very well-known marketing axiom that over time, every industry matures into really a maximum of 7 players, with the top 3 players being the most significant. The EV industry has been a relatively nascent industry in this country, but now after having existed for, let's say, almost 7-8 years, we are now seeing already, we have witnessed this consolidation. In the electric two-wheeler space, the electric scooter space, as you yourself mentioned, TVS and Bajaj together are 50% of the market. Put in another 18% for Ather and 10-11% for Hero, and you have almost 80-90% of the market. Ola and the rest are just non-entities on the periphery. As far as the electric three-wheeler is concerned, again, between Mahindra and Bajaj is over 70% of the market. Again, at 10% plus for TVS, and you have over 80% between 3 players. So in terms of volumes, and definitely in terms of revenues, and absolutely in terms of profitability, the industry is already consolidated.
All right. Thank you so much, Mr. Bajaj, for joining us with a comprehensive outlook on how you see the two-wheeler industry growing in FY27 and the export growth that you're also looking at. Thanks once again for being with us here on CNBC TV 18.
Thank you, Parikshit. Always a pleasure. Thank you.
Hello and welcome to the CNBC TV 18 exclusive. I'm Shireen Bhan, and we've got probably one of the biggest headliners here at the India AI Impact Summit, OpenAI Sam Altman. Sam, great to have you join us on CNBC TV 18. It's wonderful to see you here back in India. You were sharing the stage with the Prime Minister just a few moments ago, talking about how important India is. But how significant is India for OpenAI specifically? It is your second largest market today.
It is our second largest market, and the energy here that people are what people are building with the technology is just amazing to watch. We have more than 100 million weekly active users of ChatGPT. This is the fastest growing market for Codex. And it's amazing to see the energy here. Every time I come, it feels like it's gone up another level.
You know, Sam, you've also shared the stage with Pratyush Kumar of Sarvam. The last time you were here, there were questions being asked on whether India can do an LLM. Have you had a look at what Sarvam has been able to put out?
India's, yes, but more generally, India is just building incredible AI, the entire AI stack. From like data centers to models to applications, and I think there's no country in the world quite matches India for total AI energy.
Sam, can you give me a sense of what we can expect now from OpenAI for India? How much can you customize OpenAI and ChatGPT for India? What should we expect?
The number one request we get is better support of local languages and dialects, which is something we're hard at work on, and we're open to taking any other requests if you have some.
Is that something they're going to double down on?
Yeah, we're hard at work on that already now.
Okay. You've just announced a partnership with TCS, and of course, you're going to be one of the first clients as far as TCS's data center is concerned. What do you envisage as far as that relationship and that partnership is concerned? And do you believe you're likely to ink more partnerships here in India, especially on the enterprise side?
Totally. Hard to overstate, as I mentioned earlier, how much energy there is for building AI and building with AI in India. And I think you should expect to see more partnerships and much more activity here as we try to work with the Indian people to bring AI to the rest of the world in all of these amazing ways.
You know, you talked about democratizing AI. You also talked about AI and the need for regulation, or at least a watchdog akin to the nuclear watchdog. You talked about the IEA. That's an interesting comparison or an interesting analogy that you made.
Well, I think all historical analogies are imperfect because every technology is new, every moment is new. But the thing that I like about the nuclear analogy is it was something that the world really did come together on, even countries that normally don't like each other very much, and figured out how we could address the serious concerns of misuse of the technology, but also figuring out how to share the benefits and get nuclear energy out into the world. So IEA has been imperfect. Nuclear technology is an imperfect analogy for AI, but it was a moment of real global cooperation.
Well, you know, you're expecting countries to cooperate, but companies are unwilling to cooperate at this point in time. It's a war out there in the valley, isn't it?
In some ways, yes, but around AI safety and AI alignment, I find the companies to be pretty collaborative.
Mm-hmm.
Same way for countries. I think countries will economically compete, but when it comes to safety and stability, I expect they'll collaborate.
You know, those are big issues, but the number one issue being asked of leaders like you, how sustainable is this business model? The gargantuan spends that companies like yours are making, is it code red at this point in time?
I think, I may be wrong, but if AI stays on the trajectory that it appears to be on, I think we will say, man, we wish that people had invested more earlier and built out more infrastructure earlier. Clearly, the industry is making a very big bet, but when we look at the economic utility of these models, as these models start to be able to create such value on their own, you know, we are again kind of running out of capacity, and I expect that to happen many more quarters into the future.
But, you know, what kind of investments do you believe are going to require? You're saying that this is not enough. What we're already seeing is not enough, and that's trillions of dollars being poured in at this point in time.
You know, in some markets, you can say, what's the total market? What's the total market? What would be enough? And then there's some other markets where demand is very correlated to price. If we can make intelligence very cheap and very abundant, I think there will be huge amounts of demand. If intelligence is limited and very expensive, there will be less demand. So I think you can talk about how much would be enough at a certain level of capability relative to a certain price, but in the abstract sense, it's hard. On this mission of democratizing AI, that's part of why we think we need to invest so much, and we need to make AI so inexpensive, so abundant, so good, such that people can use a ton of it for whatever they'd like.
But what is it going to eventually mean as far as your own bottom line is concerned and monetization? I mean, you've brought in ChatGPT ads with the purpose of being able to monetize and make the business model more sustainable. I know you had a comment to make on the ads that Anthropic put out, calling them crazy dystopic, but that is a fear that people have with what OpenAI can potentially do on that front.
Yeah, if we were, well, there's two parts of the question. There's sort of ads and then business models. I'll do ads first. I think if we were doing what those ads said of, having the AI response and give you a different piece of advice based off of who was paying, that would feel really bad. So our first principle of ads is we won't do that. But like a lot of other, most of the rest of the consumer internet, I think ads in a certain way, in a certain place can make sense as a model and helps democratize it to people that otherwise wouldn't pay for the subscription but still want to use a lot of AI. On the business model question more broadly, I think we're really starting to see enterprises realize how much they should be willing to pay for AI agents that can help do part of their workload. And my sense is we will see phenomenally huge growth there pretty quickly.
So do you feel comfortable where you find yourself financially today?
I wish we had more compute. But yes, I feel...
Will you have more compute, and what's the latest as far as the deal with NVIDIA is concerned?
We are building compute as fast as we can. Yes, we'll have more compute over time, for sure.
OpenClaw and the pivot towards more agentic future for you specifically, are we likely to, A, how do you use that? B, are we likely to see more acqui-hires from you?
So the models are getting good enough. We still have a lot of issues around safety and sort of security to solve with an OpenClaw-like approach, but I think OpenClaw is the most exciting thing to happen in the AI space in quite some time. And this vision of the models getting good enough that you can have a local agent running for you on your computer or a different computer and do all of these amazing things is really quite remarkable. It feels to me like one of these moments where we unequivocally get to see the future. In terms of will we do more deals like that? Yeah, probably. I mean, not a lot, but I would expect there'd be some more in our future.
IPO in 2026?
I don't know.
The visibility for that?
Presumably, OpenAI will be a public company someday. In terms of timing, there's like a lot of factors at play, and obviously this is a super dynamic world.
GPT-6?
Presumably that will happen at some point too. I don't have a date to share with you yet.
In the first half of the year?
I don't know when we're going to call something GPT-6, but the model improvement trajectory remains extremely steep. If you look at the progress from 5 to 5.1 to 5.2 to 5.3 in Codex, what I would say is, names aside, you can expect a trajectory like that to continue.
You know, you said in your speech that there's a lot that we know, but there's a lot that we don't know. Yeah. What worries you about the stuff that we don't know?
Well, I'll stick with OpenClaw as an example because, again, I just transfixed with how exciting it is. There was a really interesting example of emergent behavior there where you would see people's agents interacting and doing things together in a way that many people didn't predict or didn't have good intuitions for. And I think there will be a broad set of emergent behavior around very complex multi-agent systems in the economy, in society, and new kinds of social networks. And I don't know if I'd say worried about that, but I feel like the fog of uncertainty there is very thick.
Jobs, and I think that's what regular people are worried about, and that's the #1 anxiety at this point in time. And every day you pick up the newspapers, and there's tech CEOs like you saying that it's going to be the end of jobs, at least in some sectors as we know it today. How much of this is, you know, AI washing of jobs at this point in time? How much of it is real displacement or on account of AI?
Yeah, I mean, obviously it's both. I don't know what the exact percentage is, but there's some AI washing where people are blaming AI for layoffs they would otherwise do, and then there's some real displacement by AI of different kinds of jobs. I expect we'll see more of the latter over time. Of course, we'll find new kinds of jobs, as we do with every tech revolution, but I would expect the real impact of AI doing jobs in the next few years to begin to be palpable.
Let me end by asking you, Sam, as a CEO running OpenAI today, you're obviously excited about the potential of this technology. As a parent, are you equally excited or are you also more concerned?
Well, I'm more excited to be a parent than run OpenAI, but those are the two great joys of my life in that order. But I think you meant, like, am I more excited or concerned about the AI impact on my kids?
And humanity in general.
Yeah. My kids will never grow up in a world without AI. They will never know that there was a time, I mean, they'll know about it, but only because of reading history books, that there was a time where every computer, every system they used wasn't smarter than them. And So I think it's going to seem very normal to them. I think it'll feel stranger to those of us that lived through the transition. I expect the future to get far better. There are real downsides. You can imagine things going wrong. We'll have to mitigate those like we have with lots of challenges throughout history. But the trajectory of human progress and the world getting better requires each generation to keep inventing new technology, to keep strengthening society. And then people can do more and build more stuff. And I'm excited for my kids to live in that world.
Sam Altman, a pleasure. Thanks very much for joining
you.
us here in India, and we wish you the very best of luck with the rest of your trip and your plans for OpenAI. Appreciate you joining us here.
Thank you very much.
Well, we are going to take a break. The headliners will continue here on CNBC TV 18. We're back in a moment with plenty more. Stay tuned.
how can I
Can
tell
you
you
give
what
us the
happened in the
outcome of the
meeting?
meeting, please?
Yeah.
We have been standing since morning.
I basically...
We have really worked hard while being outside.
So it's the news that your reappointment
No. I recommended it should be deferred because that was a request made by one of the directors.
And
how can I
can
tell
you
you
give
what
us the
happened in the
outcome of the
meeting?
meeting, please?
that-
We have been standing since morning.
I basically...
We have really worked hard while being outside.
So it's the news that your reappointment
No. I recommended it should be deferred because that was a request made by one of the directors.
Welcome back. The headliners continue here in the CNBC TV 18 studios at the India AI Impact Summit. It is my pleasure to welcome into our studios Dario Modi of Anthropic. Dario, many thanks for joining us here on CNBC TV 18. It's great to have you here in India. You know, you've been talking about the energy, the palpable energy that you've been soaking in here in India. Let me start by asking you about the significance of the India market for a company like Anthropic.
Yeah, well, thanks for having me. I mean, I think the way we think about it is, Anthropic is a company that tries to work with other companies, right? We're not primarily a consumer company, we're primarily an enterprise company. And so we succeed when our customers succeed. And those customers can be individual developers, they can be startups, they can be large enterprises. And all of those exist to a really great degree in India. I've gone to events for individual builders. I've gone to events for startups who are just starting out, and of course we've met with both here and on my previous trip some of the biggest companies in India. And in all the cases, our philosophy here is how can we work together in a way that not just benefits Anthropic but also benefits the companies we're working with. Right? Many of the companies don't have as much AI expertise, but they have a network in India. They have distribution. They know the Indian market. They have expertise that's complementary to us.
Dario, what we've seen starting the 6th of February February in the Indian stock market is a bloodbath. The Indian IT services companies have taken a large knock, really on account of what Anthropic is doing with Claude. Now, are you a bad dream or a nightmare for the IT services companies?
We certainly don't want to be. I mean, the stock market can move for all sorts of reasons, but, I think our intent is that if companies work together with us in like a positive way, they can gain a lot and we can gain a lot as well, right? We're not trying to like replace replace existing industries like.
But can you? You're not trying to, but can you?
I mean, again, there's different ways things can go. And our hope is that we can work with these companies. We build models, we build products on top of those models, but also companies can further build on top of those products. They can distribute those products. They can, I think of it as Lego building blocks, right? Like, we're not saying like, okay, we put together a few Lego blocks and that replaces everything. We're saying, okay, here are a few Lego blocks and you can continue to build. You can continue to extend on them and, build things that make sense for a particular industry or for the Indian market in particular. And, I think that's the vision we're going for. Now, inevitably, I think there's going to be some disruption, not related to any particular company or particular industry, but related to the technology in general because it's moving so fast. But what we aspire to, what we try to make happen is for there to be more examples of us working together with companies and enhancing the joint value than we produce together, then there is disruption, although inevitably there will be some disruption.
Inevitably there will be some disruption, but more partnerships. You've announced one with Infosys. Would you believe that more partnerships in India with enterprise customers like Infosys on the cards?
Yeah, we want to work with essentially, we want to work with essentially, all the companies in India. So, we're going to aim to get partnerships with, all the household names that you could think of. They're in different stages of discussion, and Infosys was the one that was announced just yesterday. We're very, very, very excited for the partnership. I visited Infosys the last time I came to India in October, and of course I was I just did a fireside chat at the Impact Summit with Nandan, chairman of Infosys. But we're excited to work with all the companies to again to work with them in a way that allows them to grow with us.
Dario, you've been calling out the risks related to AI, not just the disruption for the jobs market, but issues related to security and so on and so forth. But let's address the jobs question, because you believe that 50% of the entry-level jobs may no longer exist over the next 3 years. But there are others like Meredith Whittaker at Signal who believes that it's not so much elimination of jobs as much as it is displacement or an invisibilization almost of jobs at this point in time. How much do you believe that we're likely to see an elimination? How much of it is going to be displacement? And how much of AI washing are we really seeing when we talk about job losses today?
Yeah, so, I think it's really hard to predict. The economy and economics is hard to predict. So it's hard to say, will jobs go away or will they be downskilled or will they be moved in kind of a different direction? So the exact form that it takes, I don't know. What I do know is there will be potentially a lot of disruption because the technology is moving so fast. What is different about AI than previous technologies, it's not any different in that, there's some things humans could do before that, this new technology is now able to do, that's able to replace parts of it or all of it. What's different is it's moving quickly and it's broad because AI is a general technology. And so what we need to do, I think, more so than trying to figure out exactly what form the disruption will take, is help people to adapt. I will give an example. I can see the day when even within, say, Anthropic, we need less software engineers than we have today, because the models are better at automating software engineering end to end. But we've been thinking hard about, what are jobs that those people could do? And, one thing is, there's this notion of the forward deployed engineer. Someone who has technical skills, but who works with customers to enable technical systems and technical solutions with those customers. And as Anthropic grows and has more customers, there's going to be a need for a lot of them because the number of customers we need to talk to is large. And so that's one possible example where one thing goes away away, but another door opens to take its place. And, I can't guarantee that more jobs will be created than are destroyed. We have to make that true. We have to figure out how to make that true, and it's going to be a challenge. But the earlier we see it, the more we're honest about it, the better the chance we can address it.
I want to talk about the agentic revolution that everyone's sort of all in on at this point in time. And again, you call out the risks, and you believe that it's probably inevitable that we will start to see selfhood as far as these agents are concerned. Now, are we prepared for that future? You're stress testing agents at this point in time, and there are some pretty concerning things that have come up. Are we prepared to deal with that?
Yeah, so I would say things are going too fast and we are not yet prepared. And we need to ramp up, for all that. Every time we release a model, we have, 200 pages of analysis of these various stress tests that you mentioned, where we put the model in extreme situations, and see if it lies, if it blackmails, if it tries to gain power. It does that if you push it enough. I would think of it more as like, you're developing a car and you do a crash test of the car and you say, okay, well, let's make the car go really fast and let's put it on an icy road and let's make it turn a lot. And then, then you kind of see these horrific crashes. So these are not things that are happening in the real world, but there are things that could happen as the models get stronger and as they're put in extreme situations. And so we do everything we can to test for and to steer the models to not display these behaviors. But because progress is going so fast, I think we actually need to up our efforts even more than we have before to make sure that we are able to characterize and reduce these behaviors, and it is an area of concern to me.
Well, let's talk about the real world. IPO in 2026, working towards that?
I would say, our focus is on trying to serve our customers as best we can, build our models as best we can. As we've seen, financing in this field, requires a large amount of money, and there's different directions to get that money, but we don't have any definite plans for exactly when we will do or not do
You've
something.
just raised a significant amount of money, $30 billion. Is that enough runway at this point in time for the kind of growth plans that you have?
I mean, the technology is really, in part because the revenue is growing so fast, the needs for building data centers a year or two ahead of time are really great. And so, I would say, strange as it sounds, 30 billion helps with that, but the capital needs of this industry are actually, even in excess of that.
Making money. When are we going to companies start to make money?
Yeah, so, the economics of this field are interesting. What I would say is actually that every model we build, so, you imagine the company builds different AI models, right? Different versions of it. Every model that we build, if we take the amount that it costs to train the model and the amount that it costs to serve the model to customers, and subtract all of that from the revenue that the model gets, every model that we've made is actually profitable. The issue is that we're spending more money to train the next model. And so I think companies, including ours, will be profitable at the moment when we're no longer scaling up, the next model so much. So at some point, things will reach some kind of equilibration. And then I think us and perhaps the other companies in the space will be profitable.
I want to end by asking you about something that's in the news, the possibility of Anthropic being blacklisted by the Pentagon. Have you been in conversation with the authorities there? Is there an update on that you can share with us?
So we've been deploying our models for U.S. national security for quite a while. And, I think our basic position on it is, we've offered the models in kind of a very wide range of, for a very wide range of use cases. And, I think the main areas of concern that we have are, fully autonomous weapons where there isn't a human in the loop, and domestic mass surveillance of Americans. So those are the two areas where we have some concern, and we want to make sure the models are not used in that way. And we continue to have productive discussions about how to use our models for almost every use case, but while taking into account, I think these red lines are fairly important for, making sure that AI is used in a way that's compatible with democracy and in line with the culture of our company. We're just attempting to make sure that we deploy our technology, in a way that's compatible with and advances democratic values. The whole point is to defend democracy, and we continue to have productive discussions around this, and we're very excited to help national security of the United States and other democracies.
Dario, I'll end by asking you, 2026, the breakthrough that you expect to see?
I don't know that it'll be just one thing, but I do think that the models will continue to get more powerful. They'll continue to get better at a wide variety of tasks. We're going to see a bunch of abilities. The models, I think, may be able to do end-to-end tasks much more than they could before in software engineering. We'll see progress in finance. We'll see progress in biomedical. We'll see progress in cyber, which I think will bring some safety and security issues. But, I don't think there's going to be any one unlock. There's just a lot of momentum, and the models are getting better across the board.
Dario, it's been an absolute pleasure. Thank you so much for stopping by here in our CNBC TV 18 studios at the Impact Summit. We look forward to seeing much more of you here in India and hearing more from you about the partnerships that you intend to ink here in India as well. Appreciate your time. We are going to take a break, but the headliners will continue. That was Dario Amadi of Anthropic. We're right back with you after this. Good evening. Thanks very much for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The board of Tata Sons defers the decision to extend the tenure of Group Chairman N. Chandrasekaran. Sources say Noel Tata was the one who opposed the reappointment. Chandra's tenure ends in February next year. The IT sell-off continues on Dalal Street. The Nifty IT index is on course for its biggest monthly decline in 23 years. The Sensex and the Nifty end with sharp cuts, erasing all the gains made in the last two sessions. The AI scare trade resumes on Wall Street. A viral blog post by Citrini Research sparks a major sell-off across software and IT stocks. President Trump's reworked 10% global tariff kicks in days after the Supreme Court rules that his sweeping tariffs were illegal. Trump vows to raise the rate to the legally permissible 15%. Wall Street Journal reports that the Trump administration is considering additional tariffs on 6 industries under the garb of national security. Textile stocks remain under pressure after the government halved benefits under the export support scheme. RodTep exporters urge the government to restore the benefits. Rajiv Bajaj plays down the impact on Bajaj Auto but warns of negative impact across other businesses. Says RodTep is not a subsidy but a tool to negate the inefficiency of our own ecosystem. Rajiv Bajaj bets big on exports for growth. Expects to ship around 2.5 lakh units from April. Plans to increase electric two-wheeler production from the next fiscal. That's an exclusive. Well, let's go straight to the top story this evening. The board of Tata Sons has deferred the decision to extend the tenure of Group Chairman N. Chandrasekaran. Sources say Noel Tata was the only board member who opposed the reappointment. Parikshit Luthra standing by with more details. Parikshit, Almost 10 years since we saw that last very bitter public battle as far as the Tata Group was concerned, with Cyrus Mistry taking on Ratan Tata. N. Chandrasekaran was brought in post that. Now, what has transpired at this board meeting today? What are you picking up?
2017 was when N. Chandrasekaran had taken over as executive chairman. This was supposed to be a very routine board meeting, so to say, where the extension for N. Chandrasekaran was to be granted for a 5-year term starting February 2027. But it became a rather dramatic meeting, according to our sources. While there was consensus among a section of the board members that N. Chandra must be reappointed for his contribution to the Tata Group, Noel Tata raised concerns about losses and excessive capital expenditure in certain Tata Group companies. He also sought a guarantee that Tata Sons will never be listed. Remember, there are RBI guidelines which mandate that upper layer NBFCs must be listed, and Tata Sons falls under that category and that definition. Tata Sons in August 2024 had surrendered its NBFC license and sought an exemption from mandatory listing, and that matter is still resting with the RBI. And therefore, when Noel Tata said that you must ensure that Tata Sons never gets listed, N. Chandra was of the opinion that this is not something which is in my control. When it came to losses in Tata Group companies, board members like Anita George, Venu Srinivasan and others said that just because there are losses in certain Tata Group companies or one Tata Group company, you cannot overlook the positive contribution of the individual, that is N. Chandrasekaran. Now, there were differences among board members, because of which N. Chandra finally sought a deferment of that decision. We must tell our viewers that the board meeting is still on. It began at 11:30. There was an hour-long lunch break, and the board members met again. They're still meeting right now. But what led to the deferment was this. When there was disagreement between Noel Tata and others, some of the board members suggested that let there be a vote now on the decision to decide the way forward. But N. Chandrasekaran was of the view that when it comes to the Tata Group, there are two pillars, the Tata Sons and the Tata Trust, and both the institutions must work together in a united fashion. And therefore, if there is disagreement, then it's best to defer the decision at this stage till the next meeting. Now, what happens in the interim? N. Chandra will continue as chairman at least till February 2027, because that is the legal term that he has. What happens in the next meeting, that remains to be seen. Hopefully there will be consensus, but it was indeed an unpleasant exchange that we saw in this meeting. According to sources, we're still awaiting a final word from Tata Sons.
All right, Parikshit, many thanks for joining us. We're now going to go across to Senior Supreme Court Advocate H.P. Ranina and Shailesh Haribhakti, Senior Chartered Accountant. Gentlemen, appreciate you joining us here on the program. Mr. Ranina and Mr. Haribhakti, 10 years on since we saw that previous boardroom battle at the Tata Group, at Tata Sons, when Cyrus Mistry went up against Ratan Tata. What do you make of this development, the decision to defer N. Chandrasekaran's reappointment, Mr. Ranina, and where this now leaves India's most diversified, largest conglomerate?
This has come as a great surprise, Shireen. I'm really surprised at this development because N. Chandrasekaran has done a fantastic job. And most of the profitability has come from sectors where he has been instrumental in getting the main business. Now, there may be a few companies which make losses like Air India and others, but that's a legacy issue. And you can't blame him for that. And that will take time to sort things out. But as things stand today, I think Chandrasekaran has done a fantastic job, and I'm surprised that his appointment has been deferred. There's no reason to do that at all, because I think it's very difficult to find somebody who can fill in his shoes, considering his experience and his handling of the Tata Group companies. Even companies like Tata Motors, Tata Steel have turned around the corner, all because of his own leadership. So really, I think it's a very unfortunate decision, and makes me very sad to see that this appointment has been deferred, reappointment has been deferred.
What's also interesting to point out, as Parikshit was also reporting, is that the deferment itself was something that N. Chandra himself proposed, is what we're given to understand. Mr. Haribhakti, coming to you, sir, it was N. Chandra, we're given to understand as per sources, who said that let this decision be deferred since there is no unanimity and there should ideally be unanimity on a decision as significant as this. Now, to Mr. Ranina's point, where does this now leave the issue of succession at the Tata Group?
So, in my view, this is a symbol of the very high standards of professionalism that Mr. N. Chandrasekhar represents. And I admire him for it, salute him for making sure that in such a important succession decision, consensus is what should actually drive the decision. And so I would say that he has acted in an extremely professional manner and in the long-term interest of the Tata Group. I don't know what factors there are, and there would be many factors that the board will consider. And I would say that we hold off on any opinion until the next board meeting happens, and in a cool, collected, calm manner, as I would expect the board to reflect on the contributions of Mr. Chandrasekhar, and then a final decision will be taken on what needs to be done to his request for deferment. I don't think we should treat this as a decision one way or the other. We should only treat this as a symbol of his professionalism and an important time interval during which full consideration will be given by the board in a mature manner in terms of what ought to be the future leadership of the Tata Group.
Yes, you're right in pointing that out. There is a deferral that has taken place today. By the way, the Tata Sons board meeting is still underway. And so, as you pointed out, Mr. Haribhakti, this is not the final decision. There will be another board meeting, perhaps. We don't know when that is going to be scheduled, that will pick up on this issue once again. But Mr. Ranina and Mr. Haribhakti, coming back to you, one of the points of contention, which of course has been debated publicly as well for some time now, is the issue of taking Tata Sons public. Now, Mr. Ranina, the RBI has put guidelines in place. The Tatas had sought an exemption from those guidelines. But the possibility of an IPO sometime in the future, that clearly seems to be an issue as far as Tata Trust is concerned, because this is an unusual structure that we have as far as the Tata Group is concerned, and the concerns around a possible listing. I mean, nobody can give any kind of a guarantee because this is a matter that rests with the regulator. But that seems to be a point of contention. What do you make of that, Mr. Ranina?
Well, that is certainly an issue because, as you rightly pointed out, this is a matter which the RBI will have to decide. But one point which I would like to emphasize is that Tata Sons has repaid all its loans taken from the public. And it is really today become a private company in the sense that it has no public borrowings. And the real reason for the RBI asking the companies like them to go public is where there's a public exposure. As far as Tata Sons is concerned, there is no public exposure at this point of time because they've repaid all the loans. But nevertheless, the rules have to be construed by the RBI, as you rightly point out, and we'll have to wait and watch what decision the RBI takes. But at this point of time, the matter has been deferred. The RBI has been sitting on this for quite some time and no decision has been taken.
Yes, Mr. Haribhakti, I wanted you to come in on this as well, sir.
So, Reserve Bank of India will have a broad set of considerations in taking its final decision because, as Mr. Ranina very correctly out, the debt that they owed has been repaid. But because they are owners of public limited listed companies, there is an element of public interest which is to remain. And I think ultimately what will turn the Reserve Bank's decision is their comfort that the public limited company shares that Tata Sons own can continue to remain in a private kind of holding structure. So this is something that we will have to wait for the regulator to take a call in wider public.
And again, I don't mean to speculate, but Mr. Ranina, you know, the last time we saw friction, we saw tensions escalate, we did see the government get involved. There was a meeting that took place at the Home Minister's residence in the capital. Do you foresee, you know, some role that the government may play in trying to de-escalate this situation?
Well, I think the government will obviously ask them to come to a consensus. And that is the view of the government, that this is a group which really represents corporate India in a sense, and therefore they should have a united view. I suppose that is also the reason why Mr. Chandrasekhar has asked this decision to be deferred, because he believes in unanimity. And therefore, I think things will be sorted out in due course. But one has to also consider that the consequences of Chandrasekhar in not continuing, because then to find a new person who will fill in his shoes, who will have to take over the mantle, it's very difficult in this technological age to find somebody who will be able to take on the mantle of the chairman of the Tata Group of companies. So one also has to look at the other possibility that if he doesn't continue, who else? And where will it lead the Tata Group to? And are there such people who, and how much time it will take to have a reappointment, to have an appointment of a new person who will be completely new to the Tata Group? So all those consequences have to be considered before the board takes a final decision.
Yes, Mr. Haribhakti, before I let you both go, sir, what would the expectations now be? As I said, the board meeting is still underway. This is, of course, source-based information. It has not been made official yet. But what would the expectations be from the board, given the situation? I mean, there are myriad companies involved with different stakeholders, different shareholders. What would the market also like to hear from the Tata Sons board?
Well, I think the board will have to be very careful about what statements are made. But I would think I'll emphasize the fact that this was a decision taken based on the professional conduct and the professional opinion of the person concerned. And this is an attempt to bring issues to the fore and take the decision with full consensus and with full due consideration. And I think this is something that only all the people who are around the board table are into and in a position to take a call on. And therefore, I think the public should simply wait until the final decision emerges.
Yes, we will wait till we have an official statement from the Tata Sons board on what has transpired and what the way forward will be when the next meeting is likely to be scheduled, and how they intend to deal with this deferral of N. Chandrasekharan's reappointment as the chairman. Mr. Ranina and Shailesh Haribhakti, always a pleasure. Many thanks for joining us here on CNBC TV 18 to make sense of this developing story. We'll head into a short break, but up next, the IT sell-off continues on the Lal Street. The Nifty IT index is on course for its biggest monthly decline in 23 years. That and more when we return. Weak global cues, a big sell-off in IT stocks and expiry day jitters weighing on the Wall Street today. Markets erased all of its gains in the last 2 days, dragging the Nifty below the 25,450 mark. The Nifty and the Sensex fell 1%, but the broader markets fared mildly better. IT stocks were the worst hit after an AI-led disruption. Fear continued to intensify the sell-off that started earlier this month. The Nifty IT index hitting a 2-year low and is on course for its biggest monthly loss in 23 years. Every single constituent of the index is now down more than 10% since the start of 2026. The AI scare trade resumed on Wall Street after a viral report by Citrini Research. The report described a future in which technological change inspires a race to the bottom in white-collar knowledge work. Prashant is standing by with more on that research report that seems to have caused mayhem or additional mayhem for the stock markets and for the IT stocks. Prashant.
It's rare for a blog to be blamed for moving markets, but that is exactly what has happened in the last 24 hours or so. A long-form piece titled The 2028 Global Intelligence Crisis went viral, absolutely viral in the investment community globally, not just here in India, over the last 24 to 36 hours. And this morning, global mainstream publications like the Wall Street Journal blamed it partly for the sell-off we saw last night. Now, the note is written by analysts at Citrini, which is a US-based top-down macro thematic research house. What does the write-up actually say? It's a very long one. The thesis is simple, but quite unsettling. And I guess that's the virality. It's asked the question, what if AI productivity gains are too successful? The paper argues that AI drives massive GDP growth, explosive productivity growth, but no corresponding growth in consumer demand. Why, you'd ask, right? Because machines don't consume. They don't spend either. It goes on to say if automation displaces workers or pushes workers into lower paying jobs, household income falls. And when income falls, so does discretionary spending. So basically, you get output rising on paper, but demand collapsing in reality. So it maps out like a cascade, right? Job losses, lower wage growth, falling velocity of money, and of course, stress showing up everywhere, including stock markets and credit markets, etc. It flags, a few sectors, specifically food delivery, payments, IT services, and private credit is particularly vulnerable to AI-driven disintermediation. The article is well written, it's extremely long, but it's not uncontested. Lots and lots of pushback from investors, CEOs, techies, and just normal folk out there. And I'm going to just use two arguments here which people are making, right, in terms of pushing back against what the arguments which are being made. One is the idea of new jobs being created, which we can't imagine yet. B, the idea that markets are reflexive in nature. But I'm going to not make these arguments by quoting people who are on social media, but going to the original source behind both these ideas. The first one actually is Joseph Schumpeter, who is an Austrian economist and is best known for his theory of creative destruction. He hypothesized that technological revolutions don't just eliminate jobs, they create entirely new industries we can't yet imagine. The second one comes from the Austrian-British economist. He was a political philosopher, Nobel laureate, Friedrich Hayek, who argued that markets self-correct. And the argument is this, right? If equities fall 40, 50%, credit tightens, capital expenditure slows, prices will act as a brake. Companies will not continue to spend hundreds of billions of dollars in a vacuum, right? Prices will reflect the reality and that cycle will stop. So I guess the real debate here isn't whether AI disrupts. It certainly will. The extent is debatable. But the question to ask is, does AI create a productivity boom without consumers, or does it trigger another cycle of economic reinvention? History suggests the latter, but for now, markets are deeply anxious of which is the next sector AI will disrupt.
Well, anxiety at peak. Many thanks, Prashant, for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more.
Hello and welcome to Startup Street. I'm Arundhati Ramanan and these are the top headlines from the startup world. LAT Aerospace, co-founded by Dipinder Goyal and Surabhi Das, acquires a defense robotics firm Sharang Shakti in first step towards indigenous defense and civil aviation build-out. Canva acquires UK-based animation platform Cavalry and US video ad startup Mango AI to strengthen AI-led creation and professional design suite. Xflow raises $16.6 million in Series A, led by General Catalyst at an $85 million valuation, secures final PACB authorization as revenue jumps 10x in 2025. Wishlink raises $17.5 million in Series B, led by Vertex Ventures Southeast Asia and India, to scale creator brand partnerships and expand commerce tech stack. Paramount Skydance has submitted a higher offer for Warner Brothers Discovery, ratcheting up efforts to derail the HBO Max owner's deal with Netflix, says Reuters. The bidding war for one of Hollywood's most coveted assets, including the Harry Potter and Game of Thrones franchises, has raised the stakes for dominance in the streaming-led market. Chinese AI startup DeepSeek's latest AI model, set to be released as soon as next week, was trained on NVIDIA's most advanced AI chip, the Blackwell, a senior Trump administration official said, in what could represent a violation of U.S. export controls. The U.S. believes DeepSeek will remove the technical indicators that might reveal its use of American AI chips, adding that the Blackwells are likely clustered at its data center in Inner Mongolia, an autonomous region of China. On What's Brewing today, Dipinder Goyal's aerospace venture LAT Aerospace is making its first move into defense. The company has acquired Gurugram-based Sharang Shakti, an early-stage defense robotics startup focused on counter-drone systems. Shilpa Ranipeta joins us now with all of those details. Shilpa, LAT was originally founded with the idea of building short takeoff aircrafts for regional travel. But what does this move into defense sort of mean or signify?
Well, the acquisition of Sharang Shakti marks an expansion for LAT Aerospace into defense technology. Now, remember, Dipinder co-founded LAT last year with the intention of building short takeoff and landing aircrafts meant for short regional travel. To understand this better, let's look at what Sharang Shakti does and why this is sort of like, an extension into a different sector. Now, this startup was founded in 2023 and is an airspace surveillance and defense robotics startup based in Gurugram that builds integrated counter-drone systems. Now, the company has also raised 5 crores so far in pre-seed funding in September 2024 from AUM Ventures and from Venture Highway, among other angel investors. Now, the company has so far developed 2 products. One is called Vajra, which autonomously tracks and neutralizes hostile drones using kinetic force. And then there's also Hunter, which is spelled as HANTR, which are small UAVs designed to non-lethally capture and bring down suspicious drones which are at short range. Now, Goyal says that the acquisition is their first move towards building indigenous defense capabilities alongside the company's long-term mission of developing next-generation civil aviation platforms from India as well. Now, he adds that while both sectors are usually looked at very differently, this acquisition will help LAT build core capabilities in autonomy, in sensing, and in navigation, and all of these in-house. And these are technologies that are common to both defense and to civil aviation systems and the hybrid electrical regional aircraft that the company is developing as well. Now, remember, this also comes 2 months after LAT demonstrated an ultra-short takeoff capability in its first test flight. Even though the aircraft later crashed due to known structural defects, the company says that the learnings from that test will now go into the next version. But the bigger question now is execution. Is that whether LAT can build both a next-generation regional aircraft and a credible defense tech system at the same time, or does that mark a strategic broadening that could stretch focus when a company is still at an early stage? Well, the answers will now lie in how quickly both programs move from promise to proof. Back to you.
All right, Shilpa, many thanks for taking us through those details. Now, on What's Brewing, Vivriti Group is entering its next phase of growth with a major structural reset. The mid-market focused financial services platform has launched Vivriti Next as its new operating and holding company, bringing together Vivriti Capital's lending franchise and Vivriti Asset Management's private credit business under one unified structure. Founder Vineet Kumar is also putting in 200 crore rupees of his own capital into the new entity. A strong signal of conviction with a 15,000 plus crore rupee portfolio and ambitions that now go beyond lending into advisory, capital markets and ESG solutions. Is Vivriti now building India's next big mid-market financial powerhouse? Joining me now is Vineet Sukumar, the founder and MD of Vivriti Next. Vineet, thank you so much for taking time out and being here with us on Startup Street. You know, it's great to have you back on the show. Vivriti Group has now created Vivriti Next, right? And it's a unified operating and holding company. What was the reason or the rationale behind this move?
So, hi, Arundhati. Thanks for having me back. I think when we set the group up around 8 years back, our objective was to build lending solutions as a first step of accessing the mid-market ecosystem. Today, we've come a long way in that journey by growing to 15,000 plus crores of portfolio and lending and investing in more than 600 enterprises. It was time for us to reflect and think that for a complex ecosystem like mid-market, where the needs are well beyond just money, how could we leverage the ecosystem that we have built by offering advice, by offering capital market solutions, by offering technology, by offering risk, ESG, and other aspects of what we do, to enhance our portfolio, to build stickiness, to build profitability for our group, as well as to build much more relevance for the ecosystem that we are in. So I view this as a very natural evolution where we began with lending, we started investing, and today we offer a much higher bouquet of products. To bring it all together, we incorporated Vivriti Next. We went through a corporate reorganization, which goes live on the 1st of April 2026. And from that point of time, the set of services and products that we offer to our clients will just multiply, making us much more relevant to this marketplace.
So making you more relevant to this market. You know, you've personally invested 200 crore rupees into Vivriti Next, right? We're running out of time. So if you could quickly tell us, what message does this sort of send to the market? How does it change the group's capital strategy going forward? And how do you plan to use the funds?
So Arundhati, I think for the second time in 9 years, I've gone absolutely all in. I think that's the strongest signal to the market, that this is a business model that is going places. It's exciting. It's an amazing place to build great value. And therefore, my signal to all stakeholders, be it investors, be it lenders, be it our clients, is that this is a business I truly believe in. And I believe that for the next 10, 15 years, there's only one direction this is going, which is up.
So you're all in, and there's only one direction that it's going in, which is all up. But Vivriti began as this mid-market lender, right? With Vivriti Next, as you pointed out, you're expanding into advisory, ESG, and capital market solutions. How do you sort of ensure this doesn't dilute focus from the core lending franchise?
That's a great point. And I think if I express our focus a little better, on one side, the target market is mid-market, which does not change at all. And the second is that where we are competent is fixed income and credit, right? And therefore, even our advisory opportunity that we see is going to be oriented around mid-market and credit, which allows us to add value from the knowledge capital that we have built very carefully over the last 8-9 years. For example, we've had an ESG practice of our own for the last 4 years, right? We access capital markets very actively for ourselves for the last 5 years. And we are trying to therefore leverage upon capabilities that we have built for ourselves to address the needs of a much wider set of clients.
All right. And going back to Vivriti Capital, right? You've sort of built a 15,000 crore rupee portfolio over 8.5 years. What have sort of been the key growth drivers behind the scale, and how sustainable is that? What are you going to double down on going forward?
Yeah, so I think in every year, new themes emerge in line with how the government is looking at their priorities. For example, PLI, for example, sectors which we think are growing very well. For example, macroeconomic factors like the tariffs now building more clarity for the Indian macro ecosystem. So every year, new themes emerge on where we can deploy our capital. What's also helping us is that this entire space of mid-market private credit is becoming very interesting for Indian private wealth, which means that money is coming in to power us to be able to reach the kind of scale that we want to reach, right? So since the day we started till today, we've been running at well over 50% compounded annual growth rate. Now, naturally, scale is going to catch up with us. So I don't think we can aim for such high numbers going forward. But given the scope of what we can do, 30% is a fairly comfortable number for us to aim for the foreseeable future.
All right. All right. And in 20 seconds, with private credit gaining momentum in India, how do Vivriti Capital and Vivriti Asset Management sort of complement each other under this new structure?
Great question. So Vivriti Capital does what is vanilla, which is simple capital expenditure, working capital, leasing, bill discounting solutions for our clients. Vivriti Asset Management acts the structured credit element, which is, for example, shareholder corrections, which is, for example, mergers and acquisitions, strategic control transactions, flexible capital. So in a way, these two are complementary and operate side by side to be able to give our mid-market entrepreneurs what they need.
All right. That's a great, concise way of putting it. All right, Vineet, thank you so much for joining us on the show, and we wish you all the best as always.
Thank you.
And moving on, India's grocery market is at an inflection point as urban incomes rise and consumers shift from basic staples to healthier, premium food choices. A new breed of food retail is emerging. NCR-based Elixir Foods has just raised $9 million in a seed round led by 314 Capital and Incubate Fund Asia to build what it calls a destination-led tech-driven grocery platform for urban India. With veterans from Walmart, Metro and Titan at the helm, the startup is betting big on trust, private labels and farm-led sourcing. But can it crack the razor-thin margins of grocery and build the next category-defining food brand? Let's find out. Joining us now on the show is the founder of Elixir Foods, Arvind Medirata. Arvind, thank you so much for taking time out and being here with us on the show. You know, you and the founders have spent decades running some of the largest food and retail businesses globally, right? What sort of gap did you see in India's grocery ecosystem that convinced you that this was the right time to build Elixir?
Thank you, Arundhati, for having us on the show. So I will say, having spent more than 30 years in the food and grocery space in India, we are realizing that as the per capita income of India crosses $2,500, people are no longer looking for basics. They want to eat healthier food, wholesome food. They want to experience authentic cuisine, not just from different parts of India, but also from around the world. And they're looking for absolutely fresh food. So we want to position Elixir Foods as the most trusted destination for fresh, healthy, wholesome, and gourmet food. The important thing, though, is that we want to do this at wow prices so that this whole category is accessible to mass majority of the Indian population. So we think the total addressable market is almost like $100 billion. And the total customer segment that we're talking about is like 150 million customers. So it's a big market.
It's a huge market. Absolutely. It's a big market and you're looking to target this premium, healthier food segment, right? What sort of behavioral changes are you already seeing on the ground where you're convinced that consumers are moving towards this?
See, I will see that if you look at the onset of the D2C brands in India across different categories, whether it's ghee, people now are conscious about the kind of ghee that they use, A2 cow ghee, ghee cow ghee. People are looking at khapli atta. People are looking at minimally processed snacking options. People are looking at millets and ancient grains. Even if you look at customers from the point of view of, I will say, sourcing, they want green leafy vegetables sourced directly from their farms or from farms. So people want minimally processed, healthier options. And we're seeing a lot of plethora of D2C brands which have mushroomed in this space in the last 5 or 6 years. So we think there's a huge opportunity for a player which is basically covering all the categories, not just produce, but also meat, chicken, dairy, poultry, seafood, staples, which is all the attas, spices, cold press oils. I think that's a great opportunity. And we believe with our past experience that we have, we can make something affordable, accessible to customers without compromising on quality. The time has come for us to change the narrative from 10-minute delivery or 20-minute delivery and, brands for less to quality food. We cannot control the air that we breathe. Sometimes there's a problem with water, but Absolutely. At least our option is to make people in India eat healthier food.
So quality food, a healthier food at affordable prices is what you're looking at doing. You've raised this $9 million at the seed stage. What are the first 3 priorities for this capital? And how quickly do you plan to move from concept to meaningful scale?
See, I will say that we want to move ahead pretty quickly. Our focus is currently on Delhi NCR. We want to build a tech-enabled omni-channel platform. So we're looking at both retail stores as well as e-commerce capability to make the products available to the customers in Delhi NCR. And private label will be a very big part of our strategy. In the past, for many companies, private label has been a poor Me Too cousin of the leading national brands. We believe that private label will be really top in terms of quality. It will be far better than the quality being offered by some of the leading FMCG brands. And private label will be a huge chunk of our sales. It probably will be 60 to 70% of our total sales volume. And we will be sourcing directly from the farmers. We will also be setting up our own back-end facilities for private label manufacturing. We'll have very tight quality specs. We will get the products tested for pesticides, for being free from pesticides. So all the claims will be backed with solid data and technology. And I honestly feel that people in India are waiting for an opportunity like this.
People in India waiting for an opportunity like this. In 30 seconds, urban grocery is crowded. What's your moat here?
The moat is that, interestingly, nobody talks about healthy, wholesome food, fresh food. So we will be the gold standard in terms of fresh food, and we will be the gold standard in terms of healthy, wholesome food. At the same time, we want to be the ultimate party store. We have seen this trend that if you look at the millennials and Gen Zs, they will eat healthy food, they'll exercise a lot, but over the weekends they want to party. So if people are looking for authentic cuisines, let's say Malabar cuisine ingredients or from something from Kerala or Tibetan, it will be available in our store. So we want to position ourselves as the ultimate health store as well as the ultimate party store.
So the ultimate health store and the ultimate party store. You're trying to bring a balance to the lives of everybody. All right. Thank you so much for taking time out and being here with us on Startup Street.
Thank you so much. Thank you.
On that note, we'll slip into a short break. But coming up next, on the sidelines of the Founders Forum, CNBC TV 18 caught up with two key voices, Sudhir Sethi of Chirate Ventures and Karthik Reddy of Bloom Ventures, who have shaped India's startup landscape. Stay tuned to know more about their big bets. Welcome back. You're still with us on Startup Street. Profitability, public listing and longevity of the business are taking center stage for venture capitalists when they invest in startups. We spoke to two key voices shaping India's venture and startup landscape on the sidelines of the Founders Forum India. Here's Chirati Ventures and Bloom Ventures outlining their big bets in the startups ecosystem in India.
I think the market will get activated even more, especially for technology companies emerging out of India with patents, and in our portfolio we have so many of them. Miko is one, Kavli is one in IoT space, Miko in the air robotics space, and I can name many more as such. Pixis, Unifor, Aether in the robotic space again for prosthetics. So we've had a fair share of high-tech companies which we have funded, and I think that will grow more and more.
Is focus also shifting to like defense, climate, semiconductors?
We have companies in space. We are looking for companies in defense. We are looking for companies in the whole space of climate. We have a company in climate called Kebicol.
Of the over 140 companies, how many are unicorns?
8 so far, but I mentioned to you earlier, I think unicorn was an investor funding let's say achievement, which necessarily did not mean that there was enormous substance for longevity of a firm. Post-COVID especially, I think investors and founders have understood that unicorn label is not necessary. What is necessary is the firm really progressing.
When it comes to investing in these startups and when they go public, is it becoming harder for investors to exit after the IPO and after the listing?
I think when you exit, any investor has to have alignment with the founders, because exit is important to investors. There are many modes of exiting. IPO, for us, secondaries has been big. IPO is number 2 and M&A is number 3. We've accomplished 18 M&As in the last 14 years. As we move forward, I think that ratio will remain. Secondaries will continue to grow. IPOs will grow further. However, as technology investment takes place, deep tech investment takes place, and that's over the next 10, 12, 15 years, M&A will have primacy overall, because M&A success is not just revenue and profit. In a shorter time frame, it is patents, it is pre-monetization of a patent or a technology.
Almost all our investments for a 10-year cycle are made in the first 3 years. Everything after that is follow-on or exits. So in the 4th year, it's not a part of this fund cycle. It's a part of the next fund cycle. So when you tell me, have you built a well-curated portfolio, I have to think through it from a 3-year design perspective, not 3 months or not 5 years.
How patient are you when it comes to the growth of the company, particularly about profitability?
So some of this caution allows us to eat up the first 2-3 years of time that you usually used to take, where you'll run out of patience, because the founders are still figuring stuff out, the product market fit doesn't work, they pivot. A lot of that noise is there deliberately in a design of a startup for the first 3-4 years. In a lot of cases, we are entering after 2-3 years. So we killed that part. On the other side, if you didn't educate your founder ecosystem to say that the eventuality of this business model is profits, IPOs, M&As, public, giving capital back, then you would have been doing an injustice.
What is the timeline that you keep in your mind
7-8 years.
For a company to hit profitability?
Or public, one of the two. We've been more patient with the rest of the lot. And now for the first time, the Fund 2, Fund 1 companies which have hit a certain scale are planning to go public. So the Turtle Mint will be our first. So DRHP is approved. It's an insurance distribution company. It goes public in less than 2 months from now. So that'll be our first main board IPO. So it's a momentous occasion for us. We think Cashify, Intercity, Battery Smart, Purple, Spinny, potentially Ultrahuman, Class Plus, Leverage, maybe Exotel, IDFI, all in the next 2.5-3 years.
Do you discuss with founders about cost cutting? We're seeing so many job cuts across startups. So what are your discussions like? I mean, does it bother you, or do you want them to cut costs?
No, I'm not. You got to be just objective about it. I don't think you're emotional about it, right? If the business doesn't survive, so it goes to the classic analogy. If you're in the plane, they say you first put the mask on yourself, not on your child. right? And if you don't survive, there's no point of like trying to make the other one survive, right? And so, so the question for everybody, all stakeholders and job cuts feel harsh, but I think everybody knows the odds when they're coming into a job, that this is a highly volatile, high-risk environment. That's what you get paid for, right? If you wanted the predictable, sustainable, 10-year thing, you would be in a different company. You wouldn't enter startup land. Door says caution. So you can't have it both ways, right? If you're riding stock option value and you're riding a high pay, your intense environment, that's a trade that you made, right? So I'm not that sympathetic either which way.
And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
The third thing we look at really as how easy
The Nifty IT index is down 15% in 2026 amid growing fears that the rapid AI advances could disrupt both Indian IT services and global software companies. Bears warn that AI could erode SaaS demand and shrink the addressable opportunity for IT services, potentially pressurizing revenues. The bulls, however, believe that valuations have turned attractive and argue that the sector has navigated multiple technology shifts before and can do so again. Well, to break the debate down, we are joined by Abhishek Bhandari, the Executive Director, Technology and Internet Equity Research at Nomura India. Well, Abhishek, thanks a lot for joining in. Hello and welcome to Finding Alpha. I'm Nigel D'Souza. We're coming to you live from the Mumbai News Center. Well, Abhishek, you've been writing off late. It's been a very, very busy time for you. So we thank you for coming down to the Mumbai News Center, and we're looking forward to having a good chat.
Pleasure is mine, Nigel.
All right, Abhishek, let's get straight to the point then. Before we get to this entire AI disruption story, give us a broad sense about the size of the Indian IT services, as an industry, and if you could break it down for us, services, products, as well as platforms.
Got it. So NASSCOM pegs the size of the IT industry at around $280 billion.
Okay.
And the rough breakdown is 50% of that is IT services, 20% is ER&D, 20% is business process management, or BPO as we call it, and the remaining 10% is the hardware and the platform business.
Okay, all right. And if we had to put a point, which is the sector or the segment that is most under threat, the BPO part of it would be under threat. Everyone would be in different forms. But if you have to, say AI is going to be the biggest threat to which part of it?
Actually, entire IT services and BPO, because the fear is more on the deflation because of AI.
Okay, all right. Let's talk a little bit about that then. A large chunk of Indian IT revenues, they are linked to the SaaS players. Salesforce, ServiceNow, as well as Oracle, which many believe those companies itself are under threat. Does this create a dual risk for our IT companies, both on volumes as well as on pricing?
That's a good question, Nigel. What has been happening in the US market of late is, the people have written off the SaaS industry, saying that in the AI world, SaaS companies can be wipe-coded away by some startup.
Yes.
And that puts a lot of pressure on their high gross margins, which is around 70 to 80%. The per-seat pricing, which is on the subscription side, which could come under threat because of SaaS. In some extreme cases, people believe SaaS companies can become obsolete altogether.
Okay.
As you would know, IT services companies derive a lot of value by implementing the SaaS products into the client's, IT landscape.
Correct.
That's a fear. Having said that, I think it's too simplistic an assumption. The SaaS players actually have built quite a big moat around the data, the regulatory aspects. They gave a lot of comfort to the enterprises who are buying their products. And the real moat, what they have is the data, what they have created over the last 15, 20, 25 years of existence. In fact, they are also pivoting toward the AI world by creating AI bots and AI agents. And who will be the guys who will be implementing the AI agents into the IT landscape? It will be the system integrators like the IT services.
IT companies.
So I'm not as bearish, on the premise that SaaS companies going away or SaaS companies shrinking will be a bad news for IT. In fact, the scope of work will increase because the work will now shift from just implementing SaaS towards managing the bots, what the SaaS companies are creating.
And that's when our Indian IT companies as well come into play. The software is created and then implementation is upon our Indian IT companies. Okay, all right. Let's talk a little bit more into this now. Since you spoke about the annual deflation, if you could give us an example with regard to these IT contracts. How long or what's the time duration of these IT contracts?
Yeah.
And if you could tell us a little bit about this annual deflation. I understand that over a lifespan of a contract, there is some kind of deflation that takes place. So what has it been in the past? And in the time to come, will that deflation of, say, a couple of percent go up by another couple of percent? Give us an example.
I think this is the most pertinent question, what investors are grappling with in the wake of the AI disruption. Historically, if you look at it, the book of business for IT services companies typically has a duration of 5 years.
Okay.
So let's call it every year, 20% of the business comes from renewal. Pre-AI world, the typical discounts what IT companies used to give to the clients in a renewal used to range in the range of 15 to 20%. Okay. So the annual impact of deflation was 3 to 4% on your revenue per year in the pre-AI world. Now, what is happening because of AI is there is a lot of automation happening. A lot of automation means lesser effort needed for the same amount of IT work. So the deflation has now increased, from giving a 15, 20% discount to now giving 20 to 30% discount to the clients. And what is happening is, since the clients are seeing more savings upfront, they're also shrinking the renewal cycle from 5 years to a lesser amount.
Right.
So in total, we guess, we estimate rather, would be the deflation because of AI is now ranging in the range of 6 to 7% for the IT services company. That's almost 300 to 400 basis points higher compared to the pre-AI world.
So annual deflation could move from 3 to 4% to around the 6 to 7% mark, which will in turn put pressure on price. And not just that, the renewal time frame as well could come down. So it could be a double whammy out there. Got that. Let's focus on a couple of commentary, that we've got in the last 1 year or so. Nandan Nilekani, he said that around 60 to around 80% of IT budgets, they're locked in maintenance. But now he says that there's going to be a big shift from maintenance towards innovation. Can innovation, spending offset this potential pressure on maintenance? So as of now, when an enterprise or a client gives a particular contract, what is the mix between maintenance and innovation? And how do you see that changing? And do you agree with Nandan?
I think Nandan has made a very valid point that IT spends are more towards maintaining the estate rather than innovating.
Yes.
And the general psyche of any IT spender, an enterprise IT spender, would be to keep the tech spending flat, if not improving. Nobody wants to shrink the tech spending because it is very hard, once you drop the tech budget, to get a budget approval again for an increase.
Right.
What happens is typically the budgets are kept flat. Now, what it means is if you're saving some money because of cost savings, because of AI-led, automation, you'd rather reuse it somewhere else.
Yes.
So that's the, general thinking process of the IT, officers, the CISOs, and all those things. Now, since most of the spending is being hawked away right now by the maintenance, very little is left for innovation.
Yes.
Right. So if the maintenance cost comes down, definitely, even with the same tech budget being flat, you can actually spend more on the innovation side.
Right.
Do remember, tech is one of the few things in the humanity where people feel always dissatisfied or, unsatiated because of buying. You always want to buy more and more because the tech is improving constantly. The cycles are becoming shorter.
Yes.
So the spending, shifts away from maintaining. I think a lot of it will go away into the innovation part.
Right.
So actually, I agree with him. I think the way to think about it is, AI is also making innovation simpler and easier and less risky. As an example, many of the banks are still running legacy mainframe, which may have been written in 60s, 70s. The coders who have written those codes probably do not exist anymore. Or the risk of migrating them, from legacy to modern apps is very high.
Right.
And a typical enterprise buyer is a risk-averse person. He always optimizes his career to reduce risk, focusing less on cost and innovation. With AI, this can actually change. A lot of the mainframe or migration or upgradation may happen at a significantly lower price. and at a risk which is significantly lower compared to the pre-AI world. So I think AI definitely opens up a lot of opportunities. And I think the investments will definitely shift away from maintenance towards more on innovation.
So as of now, ballpark for the industry will be 70-30, 70 towards maintenance and 30 towards innovation. And in the time to come, innovation could move from around the 30% to 40, 45% or thereabouts.
It should go up. The pace of going up depends on the enterprise's willingness to adopt the new tech.
Indeed. And that's going to be quite interesting because as a customer, as a consumer, you're far okay to adapt to AI, but otherwise on the enterprise side it's going to be quite interesting to see how adaptation takes place. Since we spoke about Nandan, I also want to talk about Salil Parekh. He has pegged that AI first services opportunity could be $300 to $400 billion or thereabouts by 2030. How realistic is this? Because data sanitization or even cloud migration opportunity could be large, even in this sort of an AI world. Would you agree with this estimate, 300 to around 400 billion?
I wouldn't comment on the number, but the way to think about it is the typical IT landscape of any enterprise is very messy. They have been built over multiple enterprise solutions over a period of time. Data are often siloed; they don't talk to each other.
Right.
And the key raw material, as I say, to make your AI strategy successful is cleansed data. The data has to be cleansed, the data has to be sanitized, and data has to be harmonized across your enterprise.
Correct.
Who will do that work for you? A person who understands the context of your IT, none other than your IT vendor, who has been working with you for a long time, who's also a system integrator, by the way, who has implemented multiple solutions over a period of time, and he knows which is sitting where. So I think definitely the data migration and the cloud migration being the preparatory work for AI, for IT, for the enterprises to become AI ready will be a big opportunity. An IT services company will definitely play a role in that.
So data sanitization as well as cloud migration, there will be a role for Indian IT companies to play even in that.
Yes.
Got that. All right. But the counter view is that, enterprise tech is far more complex than, say, a consumer-led AI. So adoption and deployment will take time. Where do you stand on the pace of disruption? That's going to be quite interesting. Because there is a bit of a gap right now, between, an AI tool coming about and it's getting implemented. And at the enterprise level, it will be a little bit more elongated. So what do you think about that?
Sure. I think, AI in that way is slightly different from the previous tech. In the previous tech, we have seen first the B2B or the enterprise adoption being faster and higher compared to the consumer side.
Right.
It's just flipped, because in the AI world. And you and I, keep getting better models, in our GPT subscriptions or Gemini subscriptions every week. So the pace of innovation definitely is, moving very fast. Every model maker, every large, infrastructure developer on the AI wants to become top of the podium, and that's the innovation which is driving the models becoming better and better every day. The reality on the, the enterprise side is that enterprises, customers are very skeptical yet. They see multiple unanswered questions. What is the, the legal sanctity of these models? What are the guardrails around compliances? Copyrights issues, etc. So they're quite cautious and slow in terms of adopting AI.
Yes.
So what they're doing right now is, they're starting off with POCs. Give me a small proof of concept with a small project. If it makes sense, then I'll probably roll out a bigger project for my entire IT landscape. So enterprise companies are going slower, but nowadays we have started hearing comments regularly from the IT companies, not only from Indian, but the global companies, that the projects have started becoming a little larger. Yes. From POCs, now they're moving to enterprise-wide adoption. Still, from a number perspective, if revenue numbers of Infosys, TCS, or Accenture is any indicator, AI is still just mid-single digit, between 5 and 6%.
Right.
So still small, but rising. I think the real wave of AI adoption will come once the macro becomes a little stabler, because that's, I think, is the necessary requirement for any big invention and a big investment to be made into the AI from an enterprise side. And also once it's clear that AI can move just not from cost saving, which is the automation-led benefit, towards the revenue side, that's when enterprises will start coming through. So I think it's a matter of time. Even before AI becoming mainstream, the preparatory work of that will start. Again, going back to your previous point, in the previous discussion we had, the data migration and the cloud will be a prerequisite for any larger AI project to happen for any enterprise.
All right. The sense that I'm getting is, don't just throw in the towel with regard to these IT companies.
Yeah.
There still could be plenty of work for them to do, even in an AI-led world. So that's quite interesting. But the question is revenue growth, growth, growth. That's what the street looks at very, very closely. And you have outlined multiple growth scenarios. So if we could walk us through the key bull, bear, as well as the base scenarios. Depending on growth, what kind of multiple will you give our IT companies? They have come down a large deal, from the top. So highlight those three big scenarios.
Sure. If you look at the bear case, which is the topical theme in the market right now, the bear case is this company's business models becomes obsolete. They're not able to replace the deflation in revenue with a new stream of revenue on AI, and they struggle on growth. They may possibly have a negative growth, or in the best case, very early single-digit 2 to 3% growth. They keep margins stable, by optimizing on their workforce. You will work in a scenario where the EPS growth becomes zero or close to, -1, -2%. Now, those kind of companies, X growth, in our view, could trade at 10 to 12 times.
Okay.
That's the extreme bear, assuming these business models will become extreme. The base case is, the IT companies, I would say, adapt themselves, which they have done in the past tech cycles. Right now, we are going through the valley, as I call it, where the deflation of revenue is hitting first. The ascent into the mountain, which is the AI-led revenue, is taking longer than expected. But it will come. Ultimately, the AI models have to get monetized. If somebody has to monetize the model, somebody has to implement the model. And the implementers are nothing but the system integrators, which are the IT services companies.
Right.
In that case, I think the growth will come back towards mid to high single digit, in the range of 5 to 7, 5 to 8%, as you call it. In that case, I think the large cap IT may still go back towards early 20s in terms of multiple.
All right, that's the base case.
That's the base case. The bull case, is the IT companies pivot completely from just being, service providers to become value creators. What I mean by that is, the service model changes from labor, intensive work towards more like a platform,
yes,
where the company starts selling services as a software. This is, I would say, a low probability event right now because we don't see too much of evidence of it right now. But if this were to turn out to be true, you could see a lot of non-linearity in revenue and the margins. And the multiples, in that case, could range even up to 30 times, for the good large cap IT companies. So I would say we are more of the base camp. We think IT companies in the past have demonstrated their ability to navigate tech cycles. Of course, tech cycle always has a deflationary curve followed by a volume increase curve.
Yes.
We are currently more in the deflationary side, and the volume is yet to come. But we think volume will come because the AI has to be monetized and AI has to be implemented in the IT landscapes.
Well put, Abhishek. You're helping us out with that. With regard, if things really go bad and there is no growth, there could be a marginal degrowth, then 10 to 12 times. If they get back to their growing base, 5 to around 7, 8% odd, then maybe they get back to the early 20s. Yeah. And if it's all bombastic and things look very, very good, then maybe high 20s or maybe a 30 multiple as well. So we have got those three scenarios out of the way. Bear, base, as well as bull. But my argument is, Cognizant. That's the large name, right, globally? That trades at what? 10.5, 11 times or thereabouts its forward earnings. But Indian IT companies, historically, we know they have traded a bit of a premium. Do you think in this sort of a scenario, does this valuation gap actually narrow between, say, an IT company in India that trades between, 16 to around 24 times, very, very approximately, yeah, and a Cognizant that's trading at around 10 to around 11 times? Will that gap narrow, or do you expect India to continue to trade at that premium?
See, traditionally, the US market is more software and innovation market, where the multiples for software stocks have been higher and the services multiples have been lower.
Yeah.
And Cognizant is no different. Cognizant actually has gone through a patchy period of growth. We cover the stock. We have seen periods of low growth and now, coming back on growth under Ravi as the CEO. Having said that, the other services stock in US is Accenture, which trades at around 15 times Bloomberg consensus earnings. So definitely the gap between the Indian IT companies and the large IT companies in the US has fallen quite a bit. We have seen the gap almost being 30 to 40%. Now the gap is hardly 15 to 20%. Having said that, I think we have to look at the multiples of Indian IT companies in the context of Indian markets, because there are certain nuances of the Indian market which give a premium to the IT stocks in India.
Correct.
Mainly the high dividend yields they have, which is higher than the market average rate, extremely strong corporate governance, free cash flow yields, etc. And for the first time, in the last 4 or 5 years, we have seen the gap between the broader market and the IT stocks now falling down to zero.
Right.
And even IT on their own standalone basis, they have fallen below their long-term average growth multiples. So I think right now the market is more, tilting towards the pessimism, which is why the multiples are under stress. I think the global multiples on services, especially in US, always have a local nuance. So, I don't think it's right to compare the two.
Not right to compare.
Having said that, the valuation gap between Indian and US stocks have converged.
Right. And just to, since you mentioned, one of the factors that investors are holding on to is the dividend yield as well as the cash flow yield. What is it at currently?
5%.
5%. All right. Got that. Abhishek, request you to hold on to that thought. We got a couple of queries as well coming in there, and we want to discuss your top picks. For the time being, we take a short break. Come back. We continue our discussion with Abhishek. You'll get a lot of your answers to your queries. Stay tuned. Welcome back. You're tuned into Finding Alpha, and we have Abhishek of Nomura, who's helping us out with everything tech. And as you all would want to know, there are a couple of queries as well that have come in there, because you all want to know which stocks are best placed. So let's get straight to the first query that's come in. We have a query coming in from Rakesh Arora, who writes to us from New Delhi. He wants to know the top IT stocks to invest in. And he's broken it up into 3 buckets: large, mid, as well as small cap stocks. Abhishek, what's on your radar?
Sure. So I think in the large caps, we like Infosys and Cognizant the most. We think they will continue to gain market share. They'll grow at a rate which will be higher than the peer average.
Okay.
In the mid cap, Coforge is the preferred pick. We think the company's ability to deliver mid-teens growth exists. And some of the large recent acquisitions, will help it become bigger in size and get access to more number of clients, the relevant ones. On the small cap, we like eClerx the most. It's a BPO company, but I would just like to clarify here the perception that BPO companies will all get disrupted, which is true partly on the BPO voice side. The voice component for eClerx is quite low, is below 10%. I think they will be a beneficiary on the platform side of the BPO, and we see them sustaining close to 15% revenue growth in the medium to long term.
Okay, all right. So that's the top picks there: Infosys, Coforge, as well as eClerx, as you mentioned. All right, got that. We got another query that's come in there, so let's take that out of the way. Priya Datta writes to us from Kolkata. She wants to know the outlook on the Indian IT sectors over the next 2 years. That is an interesting one. Will the sector emerge as an AI beneficiary, or is it going to be an AI casualty? Tell us, Abhishek, what do you think?
I think, the IT companies are going to be AI beneficiaries in the medium to long term. Taking a step back, the IT companies are system integrators. They integrate your different types of software tools, or they innovate on top of it. And the need of system integrators even become more and more important in the AI world, where the pace of innovation will increase. That's one. And also, remember, IT companies have worked with their vendors, with their clients for a very long period of time. They understand the context of every enterprise, in a much deeper way compared to maybe a software company. And AI is all about context. AI for a bank is different for AI for a services company, or AI for a consumer company. And even in the same vertical, the need and usage may be different. So I think the context understanding of IT companies is a very big, positive asset they carry. And that's the reason I think, they will be beneficiary in the medium to long term.
Okay.
Just to, recap, I think we are going through a revenue deflation first, where people have written off, the potential revenue gains, only thinking about the near-term revenue deflation because of AI. But the reality is, tech brings down prices. Eventually, it gets compensated by volumes.
Yes.
The ones who will be able to pivot by changing their business models, their operating models, those will be the winners in the AI world.
All right. Very quickly, Abhishek, before we let you go, there's so much of talk about GCC setting up shop in India. Now, if this AI adoption is going to gain momentum, do you think that's at risk? Because the entire cheaper labor argument goes out of the window. What's your take?
I think it's a myth that all the GCCs in India are built only because of labor, cost reasons. Many of them actually are kind of a internal IT department, not in the US, but in India. They're often created for innovation reasons.
Yes.
So I don't, completely agree that, AI will, swing the, mass away from GCC into something else. In fact, the GCC's role will become even more critical. Many of them will become a very important, strategy implementer of the AI side of their respective organizations. The numbers may change, the number of hiring may change, but the strategy to open a GCC will remain, because India is still a very large talent supplier at scale, at quality, which not many parts in the world can offer.
Okay, all right, Abhishek, it's been a pleasure having you on the show. Thanks a lot for joining in on Finding Alpha, breaking down this entire tech tumble debate. And it appears you believe that, maybe tech still has a bigger role to play in the time to come. Thanks a lot for joining in.
Thanks, Nigel.
Well, on that note, we'll wrap up on this edition of Finding Alpha. Thanks a lot for watching. Stay tuned. More updates coming up.
Who is this guy?
These are quadruped. This is Tracker, which is a 5 kg payload robot,
Okay.
mostly for industrial surveillance.
This very comfortable job that you had at Asian Paints and decided to get into the world of artificial intelligence and robotics. Why?
There was this new field of robotics which was coming in, the mobile robotic field. We felt that there was not a single software enabling these technologies. So we thought, okay, if we solve this problem, we will solve it for the world.
Add verb. Explain the name to us.
Verb is action and add is adding intelligence to
So
action.
intelligent action. Now you've gotten to the humanoid space. We've got one of your humanoids right behind us.
Whatever humans can do with less dexterity, of course, these robots can do the repetitive tasks, the dangerous tasks.
When Elon Musk talks about the age of abundance, how do human beings benefit?
When we put this robot, there were 3 people who lost their job.
Yeah.
But then we created job for a technician, for a robo-operator, and at the vendor's end.
Reliance has made a very big bet on you.
They called 25 companies globally. We were small, but somehow we found that place in that room.
What is that one thing that you would get a robot to do for you?
Folding my clothes.
If you were to go into the engineering education system today, what would you train yourself for?
If you are mechanical, you know AI, but you also know electrical and other forms of engineering. And that is
So
what...
versatility is going to have to be key.
Yes.
Humanoid robotics is fast moving from science fiction to serious global investment. As artificial intelligence enters the physical world, companies are racing to build machines that can work, adapt, and scale in real-world environments. Elon Musk has called this one of the most consequential technological shifts of our time, but the real story today is execution, and increasingly, India is part of that story. Founded in 2016, AdVerb has grown from a warehouse automation startup into a full-stack robotics company, building both the machines and intelligence that powers those machines. Backed by Reliance Industries and now pushing into humanoid robotics, AdVerb is betting on physical AI built and scaled from India for the world. So, as governments debate capital flows, as budgets weigh defense, manufacturing, and AI, and as the world inches towards Musk's so-called age of abundance, one question becomes unavoidable. Can India not just consume this future, but also build it? Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. We're at the AdVerb's facility here in Noida. We are now going to talk to a guest of ours who believes that India could be on the cusp of a big inflection point. Joining me now is the co-founder and CEO of AdVerbs. Many thanks for joining us, Sangeet. It's great to have you on Young Turks Reloaded. I want to start by talking to you about the origin story, your origin story. IIT, you were working at Asian Paints with your now co-founders. You then decided that all of you are going to quit this very comfortable job that you had at Asian Paints and decided to get into the world of artificial intelligence and robotics. Why and what gave you the conviction to want to go it on your own?
So in Asian Paints, we were setting up world's largest factories and warehouses. And in these factories, and where these were really automated, it was not only large, but automated. And we used to buy a lot of these robots from Europe and US and Japan. And we thought, and every time we used to buy, we thought, okay, it can be done in India.
We can do it.
Yes, that was one thing. Second, as a customer, so there were two different kinds of automation which was playing in. One was the conventional automation which has existed for 30, 40 years. And there was this new field of robotics which was coming in, which was adding the mobile robotic field. And we were, as a customer of these two technologies, we felt that there was not a single software enabling these technologies to help customer get benefit of these technologies. So we thought, okay, if we solve this problem, we will solve it for the world.
Right.
And at the same time, because there is huge opportunity in India, and
we'll solve for India.
For India. So that is how everything began.
And the big breakthrough idea was really this combination of hardware and software, so becoming a fully integrated, full-stack provider.
Full-stack provider. So we were users of this technology, and we felt that software will keep on improving and keep on adding more value to these robotics. So robotics always used to be considered as high precision electromechanical equipment. But with software coming into picture, we thought that the software will be adding more value to the customers' usages. And therefore, we built a company which was hardware and software.
Okay, and the company is called AdVerb. Explain the name to us.
So AdVerb, so verb is action. And add is adding intelligence to action.
So intelligent action.
Yes.
That's the premise.
Yes.
So cut back to 2016 when you decided that this is going to be the baby, this is going to be your passion project, this is going to be your life's work. Investments, self-funded to start with, all of you pooled in your savings. How much did it take for you to get started?
So initial investment was in the range of 2 crore, 2.5 crore. That is what initially we put, and then later on we added something. But very soon we were out of money because hardware is, it requires money. And then we were working for Asian Paints, and Mr. Jalas Dani, who is one of the promoter of Asian Paints, we had worked with him. He trusted us. We trusted him. And so we went to him and we said, we need money to...
What an interesting twist of fate, right? You go to your former employer and say, write me a check for my current employment.
Yes.
And he was generous enough to do that.
Yes, he was generous enough. And from that day onwards, he has been one of the biggest mentor as far we understand technology, but building a business is a totally different ballgame. And he has been helping us. He is the chairman.
Yes.
Yeah.
But, how difficult was it? I mean, you and your co-founders clearly had a vision of what you wanted to do. But how difficult was it to get the team together, to get people to buy into your idea of building an robotics company in India for the world?
Okay, so first set of people were those people who knew us, who worked for us, or who worked with us in Asian Paints. Initially, we decided we will not take people from Asian Paints. So these were
Four
people,
was enough.
Yeah. These were people who had left Asian Paints and joined some other company. Okay. So we reached out to them, and they trusted us, and they came to us at a much lower salary than they were getting to a job which was almost not secure because the company would have closed any time. But
they believed in your vision.
They believed that we can do it in India, and we can do it for the world.
What was the vision statement that you started with?
So at that time, as I said, adding intelligence to action, but we said we will automate warehouses. We could have automated anything, factories, process industry, etc., because we had that experience, but we targeted warehouses that was coming up because of e-commerce and retail, which was changing during that time, and we targeted those.
So that was the starting point.
That was
now
the starting.
explain to me, because there's so much attention and so much focus on what is going to happen with AI as far as the workplace is concerned. What will robotics do? Will they replace human beings? How quickly will they replace human beings? Now you've gotten to the humanoid space. We've got one of your humanoids right behind us. Of course, still far from commercial deployment, right? How long will it take for you to be able to deploy this commercially?
We launched it 2 days back at Mumbai, and we will start taking trials with 4 or 5 customers and doing their job, all the dexterous work which humans
So what can this wheeled robot of yours do?
So wheeled robot, it can assemble, it can do hazardous work like changing the catalyst, it can be used in nuclear power plant, and it can move around, and whatever humans can do with less dexterity, of course, these robots can do the repetitive tasks, the dangerous tasks, the dull tasks. And which is what robots of other form has been doing. But these are robots which will be of human form factor, and therefore, because factories and warehouses have been built for humans to work. So these robots will be much more effective. And that is why there is so much of excitement about this technology.
There's excitement and fear as well. So let's address both those issues. What should we be most excited about in terms of what impact these humanoids, the advanced robots, can actually do as far as the workplace is concerned? What do you see as the use cases 12, 18 months down the line?
So humanoids, and why there is so much of excitement is robots earlier were designed for a specific task. And that task, they used to do it efficiently and with a lot of accuracy and lot of speed, etc. But today's robot is not designed for one activity. It is a generalist robot. So today it is doing one thing, but the same robot can go to some other place at the soft floor and do something else.
So the software and intelligence has added versatility.
Yes. And this robot, today it is trained on certain amount of data and it will be able to do something. But tomorrow, even if it is a totally new work, it will figure out based on what it has learnt in the past and then reason out how to do that work.
So it can reason.
Yes.
And that's the big difference.
That is the big difference. So like human beings, when you are doing it for the first time, even if you have not done it, you break it into subtasks and then you figure out which subtask has to be done first, so that by the end of all these subtasks, you achieve the goal what you want to do. Similarly, the robots will do it. And in the process, one of the things which gave huge advantage to human being was if it failed, it tried to do it in some other way, which was recovering. And
you're saying robots can recover?
Robots can recover from the failure while doing a certain task.
As of today?
As of today, for certain tasks. But it is a long journey. I would say another 5 years or 10 years to become 90% of what humans can do. But it is an important thing. It is in the right direction, and it will happen. That is what...
It will happen still maybe 5-10 years on, unless we see a big acceleration or some big breakthrough. But you know, we've got a bunch of these things walking around over here. Explain to us now, what are these being used for? Where are they being deployed? Who your clients are that are using some of these robots that are already in play?
So these are
Who is this guy?
These are quadruped. This is Tracker, which is a 5 kg payload robot. And so it came from MIT Cheetah or MIT lab. And then different companies started making it, some in China, some in Europe, some in US, mostly for industrial surveillance. For inspection in hazardous areas. And then lately it is also getting used in defense application, where they find out landmines.
Landmines, yeah.
Yes, yes.
Yeah.
And or maybe carry load from one place to another, digital mule kind of thing. But apart from these robots, the robots which we make, the mobile robots or collaborative robot, which is 6-axis robot, it gets used in e-commerce in a big way, hundreds and 200s of them in one place, and then you have at several places, in consumer goods, in new energy, which is battery and solar and electronics. So these are the places where we sell most of our robots.
What kind of regulations do you have to put in place to ensure that there is also a safety net for human beings?
Yes.
I mean, you don't have to pay this guy overtime. You don't have to give them weekends off or any of that. And I think that's where the concern stems from, that when Elon Musk talks about the age of abundance, how do human beings benefit from this so-called age of abundance?
See, there are two things. One is, some of the activities which we do as human beings is something which we do because we don't have any machine for that.
Correct.
Our body was not designed for it. And I'll give you an example. At Asian Paints, our people used to lift buckets from the packing line and put it on a pallet. And it used to create, it was for 8 hours, if you continue lifting something 30 kg and putting it on a pallet, it does create problem, sometimes health problem, etc. So we decided that we will replace it by robots. Now, and after we replaced it by robots, every time people used to say, you are replacing human beings and you are not doing good, and you are...
Well, you actually made the life of the worker better.
Much better in terms of, in fact, Jeff Bezos keeps on talking about MSD, which is muscular skeletal disorder, all the disorders which we get because we do repetitive tasks. And for that, now these robots, because they are flexible enough, they will be able to do these tasks. Yes, some jobs will get lost, and with any technology, that is what happens. So just to continue with the Asian Paints example, when we put this robot, there were 3 people who lost their job because not lost the job, they were deployed somewhere else, but these 3 people, the job went to a robot. But then we created job for a technician who had to take care of the robot, do the maintenance of these robots. We created job for a robo operator, and at the vendor's end, in the whole ecosystem, it was at our end, at the vendor's end, we created job for a person who could, an expert whom we can talk to, and these jobs were much more highly paid than the job of doing or transferring the. So eventually in the ecosystem, more job gets created. And that is what we are seeing everywhere.
Going back to the Musk hypothesis on what this is actually going to do in terms of cost of manufacturing, what are you seeing today in terms of cost of manufacturing on account of the deployment of AI, of robots, etc.? And what could we be talking about 5-10 years on?
So, so 2 things changes with deployment of these robots. One, the ability of the customer to deliver products at speed, and second, at scale, and second, the cost definitely reduces because you remove all the non-value added work, and those non-value added work, sometimes it goes out of the system because you are rethinking the process once again with these robots, etc., or this gets done by robot, and per piece work reduces. So to the tune, we have seen many customers gaining to the tune of 15%, 20% as far as cost of manufacturing or cost of delivery is concerned.
And that's not because of a manpower cost reduction?
No, never it is because of the manpower cost reduction. It is, so sometimes it is because of the capex which they deploy. So let us say if it is a completely manual system, you need 100,000 square meter. And for that, you need to have land, you need to have the construction going, etc. Same thing with automation. You can do it in 20,000 square meters. Okay. So maybe 5 times reduction
so the
in the area.
economics changes completely.
Completely.
Let's talk about your economics now. We're sitting here in your facility in Noida. This is one of the facilities that you have. You have about 900 people that are working with you at AdWorb. And it's been a very rapid expansion for you, all in a matter of 10 years. And this facility came up, about 6 years ago, right?
6 years back,
so,
yes.
And now you're servicing not just the Indian market, but you're servicing the world as well. What is the plan from here on?
Yeah, so today 60% of our revenue comes from, or used to come from overseas market. There is, last year was a thing because of American thing, but
yes, because of the US tariffs, and
US
that
tariff,
impacted your business.
Yeah, but otherwise, going forward, 50% revenue will continue to come from India and 50% from overseas market.